Jim.
It is 5 a.m. here at CNBC Global Headquarters. I'm Frank Holland. Here is your 5 at 5. Inflation inflection. Investors are growing more confident in a September Fed rate cut after yesterday's cooler than expected CPI report, with one more key data point on tap today. Small cap comeback. Stocks left behind in the recent rally did something. For the first time since the financial crisis, big tech sees a massive wealth wipeout. Now, a well-known Wall Street veteran says it could be the start of a hot new trade.
This is the day where investors are starting to rotate out of the magnificence of it and into the rest of the market.
Biden defiant. The president facing the press for the first time since his debate with former President Trump. Biden pushing back on calls to drop out of the race.
Most qualified person to run for president. I beat him once, and I will beat him again.
Whoa.
Plus, Tesla's rocket-like rally ends at 11 with more pressure on that stock today. Then later, the one big number to watch as big banks get set to report their results. It's Friday, July 12th, 2024, and you are watching Worldwide Exchange right here on CNBC. Good Friday morning. Welcome to Worldwide Exchange. Thank you so much for being here with us. Let's get you ready for this trading day ahead. We kick off the hour with a check of U.S. stock futures after a statistically historic day for Wall Street yesterday. Taking a look at futures in the green across the board. Looks like the S&P's up fractionally. Looks like the Dow would open 70 points higher. The NASDAQ up fractionally as well. We're also checking the bond market ahead of today's PPI inflation report. Taking a look at yields. Right now, the benchmark, the 10-year at 4.22. Easing back a few basis points after that cooler than expected CPI report. We're also looking at oil adding to its week-to-date gains. Taking a look right now, both WTI and Brent crude up over 1%. That's your morning money set up now. We're going to turn our attention back over to stocks and what could be a possible inflation inflection point. June CPI coming in at a cooler than expected 3% year over year. Its first month-over-month decline since back in 2020. The read further opening the door to a late summer rate cut by the Fed, with odds now standing at more than 92% compared to just 73% yesterday. The softer inflation data hitting stocks as well. The S&P 500 and the NASDAQ snapping their 7-session win streaks. The NASDAQ closing down nearly 2%. Its worst day since all the way back in October. The Mag 7 also impacted, with every member of the mega cap group closing down more than 2%, wiping out a combined $598 billion in market value in just one day. That's the second worst on record. Tech's big loss translating into a huge win for the small caps. Take a look right here. The Russell 2000 jumping 3% for its biggest outperformance compared to the S&P since all the way back in the financial crisis. We're talking October 2008. Conviction in the trade as well, with volume in the iShares Russell 2000 ETF almost 2.5 times its normal daily volume. Noted bull Ed Yardeni, he's hoping this, what we saw yesterday, is only the beginning.
What I'm counting on is the market rally broadening out. So I like what I'm seeing today. I wouldn't mind at all if the Magnificent Seven do nothing for the rest of the year, and we see money going to the rest of the market, which has been left for dead there for a while.
All right, now we bring in Ross Mayfield, Baird Investment Strategy Analyst. Ross, good morning. Good to see you.
Good morning. Thanks for having me.
All right, so Ed Yardeni is saying he doesn't mind if the Mag 7 do nothing the rest of the year. I think a lot of other investors would. But let's just pull on that thread just for a minute. Let's say we do see a major rotation out of tech. What sector do you see being the biggest beneficiary?
Yeah, I think if we're seeing it because rates are coming down and the expectations for a Fed cut are moving higher or being pulled forward, then it's the cyclical sectors of the market, right? And you have to look at ones, in my opinion, that also have some structural tailwinds. We've liked industrials for a while on that front, so I think you've got a cyclical trade, the economy holding in there, structural tailwinds in the form of fiscal spend, aerospace and defense spend. So something like industrials, I think, with a diverse industry backdrop, has a chance to outperform.
All right, so yesterday we definitely saw a rotation. For example, biotech, the IBB ETF finishing up almost 2.5% higher. Biotech's been under a lot of pressure this year. And as we mentioned earlier in the show, small caps having a very good day, especially compared to the S&P. I do want to ask you a bit more about small caps. If we continue to see this rotation in the small caps, in your mind, what does that say to you about the strength of this market overall? What does that say to you about investor confidence in mega cap tech?
Well, I think it's a lot less about mega cap tech, right? Maybe a little profit taking, a bit of a breather after a historic run. But the fact that we're seeing a rotation into equal weighted S&P, into small caps, signals a confidence in the economy, right? You're not rotating into those parts of the market unless you're confident in the economy that when we get rate cuts, that rates coming down are not a negative for growth, that they're not giving a negative message on economic growth, but rather are signaling that inflation is coming down and the soft landing is still in play. So totally fine, as with Ed Yardeni, that tech is taking a breather, especially because we're rotating into something a little more cyclical, a little more rate sensitive.
So Ross, very quickly, I just want to push back a bit. So if the economy remains strong, would that also benefit those mega cap tech names as well?
Sure, absolutely, yeah. I think the thing is you're getting a breather here, not a total deflation of AI enthusiasm, right? Now, the big tech, they're not as rate sensitive, right? They're cash rich, they're low debt, so they're not as rate sensitive as long duration tech. The equal weight tech has really underperformed cap weighted tech here. So I think if you get a rotation into other parts of even the tech sector, that says the same story.
All right, Ross, one last question. I was speaking to a managing director of one of the big banks. They said since the jobs report, they've seen a big flurry of long duration bond buying. A lot of people trying to lock in those longer yields. Is that something that you would advocate for your clients as well, to take advantage of those higher yield bonds now while they last? Because obviously, not obviously, but it seems like we're pushing closer and closer to a rate cut.
Yeah, I think so. Our wealth management clients have been loving cash, loving money markets, the 5% you can get there. But I do think the days of that are numbered because, as you mentioned, rate cuts are being pulled forward. So I do like locking in a little bit of duration. If you've loved these rates, and I don't think we're going back to zero by any means, but if you're liking these high rates, I think locking in long duration makes a lot of sense. I would keep it high in quality, whether treasuries or some high quality corporates. But yeah, I think I think that makes all the sense in the world.
All right, Ross Mayfield, great to see you. Thank you very much.
Thanks.
All right, coming up here on Worldwide Exchange, we got a lot more to come, including the one word that every investor needs to hear today, as well as we're bracing for the banks. Earnings season kicking off in earnest, and the one stock our next guest says is a buy ahead of the tape. Plus, headline inflation, that may be cooling, but one key sector, that sector is still red hot. We have all the details coming up. And later, much more on President Biden and his refusal to bend to pressure from his own party. We look at the impact to investors. We have a very busy hour still ahead when Worldwide Exchange returns.
money today.
All right, welcome back to Worldwide Exchange. Turning to Washington, and President Biden saying he will stay in the 2024 presidential race despite growing calls from donors and members of his own party to drop out. Mr. Biden addressed reporters last night in his first solo press conference since his debate with former President Trump. The president saying he's staying in the race to finish the job that he started. NBC's Bree Jackson joins me now from Washington with much more on this story. Bree, good morning.
Good morning, Frank. So despite the uncertainty here on Capitol Hill, the Biden campaign is arguing that President Biden succeeded in fending off some of his doubters during yesterday's news conference and urged Democrats to stop talking about themselves and focus on the guy they're running against. A defiant President Biden defending his re-election bid.
I think I'm the most qualified person to run for president.
The president's first solo press conference of the year, getting off to a rocky start as he flubbed the name of his own vice president.
I wouldn't have picked Vice President Trump to be vice president, but I think she's not qualified to be president.
That gaffe comes as the 81-year-old is working to fend off critics, even within his own party, who say he must drop out of the presidential race, citing concerns about his poor debate performance, age, and ability to win this November.
Can you name me somebody who got more major piece of legislation passed in 3.5 years? I created 2,000 jobs this last week.
Still, more than a dozen Democratic lawmakers want him to step aside.
The hard reality is, and I'm far from the only Democrat who believes this, that the numbers, the trajectory, what Americans feel in their bones right now suggest not only that Joe Biden would lose this race, but that he or we would lose the Senate and the House.
Others are sticking with Biden at the top of the 2024 ticket.
We have the team, we have the operation, we have the president who I trust.
President Biden seeking to prove he is the best candidate to take on former President Trump, with the fate of his campaign and the future of the country hanging in the balance. And President Biden continues to ramp up stops on the campaign trail with an event in Michigan later today. In a memo, his campaign laid out what it sees as its path to keeping the White House, saying winning Wisconsin, Pennsylvania, and Michigan is the clearest pathway to victory.
So, Bree, I want to go back to your story. In that story, you had Representative Himes, one of the top Democrats. He spoke out after the news conference about President Biden stepping down. Do we know why he waited until after this news conference?
So, Frank, Representative Himes, who is a top Democrat on the House Intelligence Committee, he says he purposely waited until after the NATO summit to go public. He says he did not want to interject politics into the summit.
All right, Bree Jackson, live in D.C. Bree, great to see you. Thank you. Turn our attention now back to Wall Street. The prospect for rate cuts become more of a reality as inflation inches closer to the Fed's 2% target. That could be good news for other parts of the market outside of stocks. That includes fixed income. Joining me now to discuss the outlook for bonds in the second half of the year is Gurpreet Garawal, global fixed income macro strategist at Goldman Sachs Asset Management. Good morning. It's great to have you back.
Morning, Frank. Great to be with you.
So give me a picture. As we look at the second half of the year, the sentiment is that we're getting closer and closer to rate cuts, very possibly in September. What does that mean for fixed income?
Yeah, you're absolutely right. I think the CPI data that we received this week, combined with the cooling, although not collapsing, of the US labor market, and Fed Chair comments where he said that the central bank is placing similar or equal importance on both sides of its dual mandate, all of that does pave way for a September Fed rate cut. Of course, we've still got 2 more inflation prints, 2 more jobs data between now and then, but this is good news. As the Chicago president said last night, it does demonstrate that we're on the path to 2%. From an asset allocation standpoint, this really underscores the importance of rotating into bonds, locking in those attractive yields before the cutting cycle begins. And then I think within portfolios, one of the ways to position for this, at least for our clients' portfolios, we believe, is to position for the US Treasury yield curve to steepen, because the front end of the curve will benefit from those impending rate cuts, while the longer end exposure is aligned with the fact that we'll see higher supply and fiscal dynamics as well.
You know, Gurpreet, that's really interesting. I was telling a guest earlier today, I was speaking to a managing director at a big bank. They've seen a flurry of long duration bond buying since the debate. a lot more, excuse me, the jobs report. I keep saying the debate because obviously the debate's a big news item right now. But since the jobs report, when sentiment seemed to shift that we're going to get the rate cut sooner than later, is that what you're saying as well? A lot of people looking to lock in those long duration bonds. And then what do you think that could mean for the equity market as we look at the second half of the year?
Yeah, look, I think for the equity market, what matters is what is driving this easing, because right now it is an adjustment cut cycle that is expected and priced, because the economy is still relatively sound, fundamentals are still good, the fundamental picture is decent, and so the adjustment in policy rates is due to the slowing of inflation and cooling of labour markets, which can be positive for risk sentiment, including risky parts of the fixed income market, but also by extension equities. And to the first part of your question, yes, absolutely, you are seeing interest for fixed income. We've seen that renewed interest since we moved into this higher yield environment. You've seen pension funds de-risking, looking to move into fixed income. In our 13th annual insurance survey, we saw the interest in fixed income at its highest since that survey began. We also see households who'd moved into money market funds looking to engage in fixed income, some for the first time. And so the fact that fixed income, once again, does deliver income is really opportunistic and attractive. So it's a really interesting time to be in fixed income market.
So, Gurpreet, let me ask you something. I would imagine a lot of your clients are asking you, as you look at corporate debt right now, if rates are definitely on the way down, doesn't that make more parts of the corporate debt landscape a bit more attractive? I mean, obviously, investment grade and Apple's corporate debt's always going to be attractive, but doesn't that kind of broaden out, I would think, what other investors are looking at right now?
Yeah, look, we think there are interesting opportunities in corporate bonds. When you look at the fundamental picture, fundamentals are sound. Interestingly, higher rates have actually instilled discipline among corporate managed teams in terms of how they manage their balance sheets, and that's good for us as a credit holder. You see decent interest coverage ratios. You've seen open capital markets have allowed many corporates to come to the market this year and issue new bonds to address refinancing risk. And actually investors have snapped up those new issues. And so you've seen solid new supply being met with resilient demand from investors looking to capture those yields. And coming back to my earlier point, if the Fed begins its adjustment cycle, whilst you may see that fully reflected in the US Treasury market, in the rates market, and perhaps the currency market, markets are still relatively inefficient and it's not yet fully priced into corporate markets. And so if that adjustment in policy rates is occurring against a still resilient growth backdrop, there can be opportunities to rotate into, say, high yield corporate bonds as well.
There we go. Gurpreet Garawal, great to see you. Have a great weekend. Thank you. Coming up here, Worldwide Exchange, Tesla's rocket-like rally cut short. Details on that downturn right after this break. Stay with us. welcome back to Worldwide Exchange. We saw more positive signs that inflation is finally cooling with yesterday's softer CPI numbers and the first month-over-month drop since 2020. Things like car prices and gas prices, those are cooling. However, the cost of car insurance, that remains red hot. Our Contessa Brewer joins us now with much more on that story. Contessa, good morning. Good to see you.
Hi, Frank. Yeah, car owners are still facing rising premiums according to the latest CPI, with prices up 19.5% over last year and up almost 1% even from last month. Now, that's good news for shareholders in insurance companies. Allstate got a price target increase from JP Morgan to a street high of $200, and it raised the price target on Progressive to $239 from $210. BofA Securities predicts strong margins for the auto insurers. But why are car insurance premiums so high? Well, rates are still catching up to loss costs. Insurance companies have reported over the last several years, with accident severity and frequency on the rise, that they've reported soaring costs of repair and replacement. And in some cases, in some states, California the most extreme example, insurers are paying out more in claims and expenses than they were taking in premiums. And the insurance commission in that state refused to raise rates for years. So insurers have only recently begun to get the approvals. Investors, though, are watching the catastrophe losses carefully. For instance, Progressive announced results in May. They were announced monthly, and it saw $722 million of net catastrophe losses, almost $750 million. According to Piper Sandler, that was more than 12% of the premium, where normally catastrophe costs are about 3 to 5% of premium in summer months. Remember, that's not even hurricane damages. That's just mostly thunderstorms. Travelers announces earnings next week, and so we'll see if those high cat losses are reflected there. On the upside, in addition to rate increases, insurers are getting a boost from high interest rates and other investments. Piper Sandler points out that Progressive's seeing higher net investment income. Let's show you Progressive shares up year to date more than 32%, and Allstate up 15%. Frank?
All right, some big moves for those insurers. So, Contessa, we talk a lot about car insurance. It's a data point in CPI, of course, but what about homeowners insurance?
You know, it's interesting because CPI doesn't break out homeowners insurance the same way, but we do get a view of that. We are looking in some places at year-over-year increases of 30%. And in fact, in New York, I've even started to begin hearing from colleagues, Frank, that they're opening their insurance bills and they're just getting sticker shock. And that's without even having an incident that you had to report a claim to your insurance company. It's just the way things are, partly because of the inflation that we've seen in materials and labor. And home values themselves are more expensive. So of course, if you have to put in a claim or if your home is completely destroyed, it will cost the insurance company more money to replace it. And so those rates are just now catching up to what inflation was for materials and labor last year and the year before.
You know, Contessa, I think a lot of us are homeowners. We don't actually want them to catch up. We just want them to keep lagging. Contessa Brewer, really great to see you. Great reporting as always. Thank you. All right, as we head to break, watching shares of Delta Airlines after yesterday's massive stock slide. Delta fell just about 4%. The airline missing sales estimates for the third time in 4 quarters. Delta is saying it's been forced to reduce ticket prices because of industry oversupply. Take a look right now. A slight rebound in the stock. Shares up very fractionally right now, but you see the big drop after earnings yesterday. Much more Worldwide Exchange coming up right after this.
got this.
It is almost 5:30 a.m. in the New York City area, and there's still a lot more ahead here on Worldwide Exchange. Here is what's still on deck. We're seeing growing hopes for a Fed rate cut coming sooner rather than later after that cooler-than-expected CPI report. Investors now pivoting out of the big tech trade into other left-behind bets, while one Wall Street veteran is now calling this an inflection point. Top of the agenda today, to kick off the big bank earnings, JP Morgan, Wells, and Citi, all of them reporting their numbers this morning, the key numbers that you need to watch in those results. And President Biden pushing back on calls to lead the 2024 race, and in some minds, raising fresh concerns about his ability to lead for 4 more years. It is Friday, July 12th, 2024. You're watching Worldwide Exchange right here on CNBC. Welcome back to Worldwide Exchange. I'm Frank Holland. Great to have you here on a Friday morning. Let's pick up the half an hour with the check of U.S. stock futures following a whipsaw day of action in the markets on the back of that June CPI report. The S&P and the NASDAQ, both of them snapping 7-session win streaks, with the NASDAQ closing down nearly 2%. Its worst day since October. Take a look at futures right now. You can see a bit mixed. Earlier, we did see the NASDAQ fractionally higher. It's now just dipped fractionally lower. The Dow off of its highs of the day so far, of the morning, I should say, looking like it would open up almost 50 points higher. The S&P still fractionally higher right now. We also want to take a look at some of the biggest pre-market gainers on the Dow. Taking a look right now, you're seeing Nike right here at the top of the list, shares up over 0.5%, followed by Amgen. Cisco Systems up just over 0.25%. Apple in that top 5 up 0.25% as well. All right, turning now back to our big story of this week. The rebound in small caps and their historic outperformance versus the S&P yesterday. Taking a look at that right now, you're seeing the Russell up over 3.5% yesterday. Big jump yesterday on the back of CPI. Week to date only up just about 5%. But again, that softer CPI report definitely led to a rotation. And we're also checking the bond market ahead of another read on inflation today. That's PPI. Taking a look at yields. The benchmark right now with 4.22. It came down just a few basis points from yesterday after that cooler than expected CPI report, something we'll continue to watch and talk about throughout the show. And we're also looking at oil this morning, adding to its week-to-date gains. Take a look. You're seeing WTI and Brent crude. WTI up over 1%. Brent crude just slipping a bit from the levels it was earlier this morning, but still up over 0.75%. But again, strong week for oil overall. Okay, that is your morning money setup. Let's now see how Europe is shaping up as this trading day gets underway. Our Sylvia Amaro is in our London newsroom with much, much more on the early action. Sylvia, good morning.
Good morning, Frank, and happy Friday. Well, it's also a happy day for European equities. At this stage, we have all of the major bourses trading in the green. In fact, the Stock 600, the benchmark here in Europe, is trading at a month high on upbeat earnings. However, that CPI print that we got from the United States yesterday is also driving some of the momentum behind some of these names. But let me show you how sectors are trading at this stage as well. Important corporate stories this morning out of Europe too. Ultimately, though, the rotation we saw yesterday stateside in terms of out of tech investors dipping tech, this is also the case here in Europe. We also are seeing a rotation out of technology stocks. It was a bit more pronounced earlier this morning. It is easing somewhat a little bit now, but nonetheless, one of the trends we are tracking at this stage. I also want to take you to telecoms. It is among some of the top performers today, up by about 0.5% on the fact that Ericsson this morning reported second quarter sales that were higher than what analysts were expecting. Now, let me show you how Asia traded as well as we finish the trading session in Asia as well. As I was telling you earlier, that CPI print also boosted some of the momentum in Asian shares. However, when you look at the Nikkei 225, it ended down by more than 2%, also because that rotation out of tech also played a role here. And of course, Frank, we continue to monitor what the Bank of Japan might say as well later on this month.
All right, Sylvia, thank you very much. Our Sylvia Amaro, live in our London newsroom. Now time for a check with some of this morning's top corporate stories. Our Silvana Hanau is here with those. Silvana, happy Friday and good morning to you.
Hey, Frank. Happy Friday to you. All right, let's start with Chicago Fed President Austin Goolsbee, who says the June CPI data is helping to build his confidence. Inflation is going back towards the central bank's 2% target. Speaking to reporters yesterday, Goolsby says housing prices have been trending lower for 2 months, which is, quote, profoundly encouraging, adding he thinks this is what the path to 2% looks like. Goolsby is not a voting member of the FOMC this year. Shares of Tesla are lower again today after snapping an 11-day win streak yesterday. Now, that move coming on a Bloomberg report, the company is postponing its robotaxi event from August to October to give Tesla more time to build prototype vehicles. The stock dropping more than 5% in yesterday's session. It had surged 44% during the 11-day win streak. That's the longest run since a string of 13 straight gains in June of last year. And Boeing is reportedly warning customers of further delays for the 737 MAX. Bloomberg says the company has told them aircraft set for delivery in 2025 and 2026 could be pushed out by an additional 3 to 6 months. Boeing has not commented. Last month, Reuters reported Boeing told suppliers it was delaying a key milestone for the 737 program by 3 months as production has slowed in the face of increased scrutiny from airlines, regulators, and lawmakers, Frank.
Yeah, looking at Boeing shares down just about 0.5% in the pre-market. So, Vanna, thank you very much.
Yeah, Frank.
All right, turn our attention back to earnings season. It ramps up later this morning as the big banks officially begin to roll out their results. JP Morgan, Wells Fargo, and Citi all out before the open. Investors are going to be looking for some signs of weakness from higher interest rates, credit card delinquencies, and commercial real estate. The FDIC says banks have had around $517 billion in unrealized losses for over 2 years. Regulators call that unusually high. Investment banking revenue could offset some of that weakness as deal making begins to make a comeback. Joining me now to look ahead to bank earnings, Stephen Bigger, Director of Financial Institutions Research at Argus Research. Stephen, good morning. Great to have you here.
Good morning.
All right, why don't we start with one of the biggest metrics for all these banks, net interest income. That's the spread between what banks make on loans and what they pay out in deposits. What are you expecting when it comes to that metric? And I also want to ask you, as we see more and more people go to these higher yielding money markets and other products, how does that impact that metric?
Absolutely, Frank. So, yeah, we expect fairly anemic loan growth this quarter, kind of similar to what we've seen in the last several quarters as the elevated interest rates, those higher borrowing costs are just reducing loan demand. So that's not going to change, I don't think, until we get some lower rates here and meaningfully lower rates. And then, as you mentioned, those net interest margins still under a bit of pressure here as the consumers are shifting still somewhat to higher interest-bearing deposit accounts from non-interest-bearing, and that's put some pressure on that. So year over year, we're still seeing some weakness in margins. The good news, though, is that the second quarter here is expected to be the trough for that. We'll look for some deposit pricing stabilizing from here out, and also the securities portfolios that you mentioned that are deeply underwater, getting a bit better here as they reprice higher in a higher interest rate environment.
All right. I want to go some data points from one of your recent reports. So you said credit cards at about 3% delinquency, and then office commercial real estate is at 2%. We often talk about the pressure on commercial real estate, but 2% delinquency, is that a high number historically? I mean, how should investors read that?
Yeah, 2% is certainly higher than it's been in the last couple 3 years. And everybody's, particularly on the regional bank side, has been pretty concerned about not just broadly the commercial space, but the office market space in particular. So high vacancy rates there have reduced cash flows. That's put a lot of pressure on the operators. And as these rates come up for refinancing in a higher rate environment, that's also been hurtful for the lenders. So that is a potential worry spot, and 2% by itself is not a worrisome figure. I'd be worried if that moved up to closer to the 3% level, but it still is higher historically, and certainly a worry spot.
One other thing I want to talk to you about, if you're looking longer term, is unemployment. Unemployment's ticked up. I know you said that's something that banks really watch closely when it comes to some of these delinquency numbers, and also, of course, their deposits and everything else. As you see unemployment go up to about 4.1%, is that something that changes your view of banks in the longer term?
Well, the correlation between unemployment and delinquencies is extremely strong. So certainly, if unemployment goes up, I think we're still at relatively low levels here in the high threes or even low fours. I'd be more concerned if we got to the closer to the 4% level, 4.5% or 5% level rather. Historically, that would result in much higher delinquencies at this point. So still a strong job market, and banks are certainly adding to reserves at this point as the economy slows and unemployment does increase.
Well, Stephen, we have three big banks reporting later today. Sorry to cut you off. We have three big banks reporting later today. I know you have buys on several of them. Do you have a top pick of the three banks reporting today?
Well, I think J.P. Morgan is kind of the standard bearer here. We do expect the capital market side in particular to be strong, equity underwriting, and that better IPO activity, debt underwriting, credit spreads have narrowed. We had almost a record quarter in the first quarter. M&A deal flow is bouncing back. Executives there said they're looking for 25% increase in investment banking. So they are kind of in the sweet spot here. Citi also buys, you mentioned, but going through some still the restructuring. I think they have more room to run, but we'll look to hear more about that.
Steve, we got to leave the conversation there. Your top pick, J.P. Morgan. Thank you very much. Always great to see you, especially ahead of big bank earnings. Thank you. Also, for the audience, we're going to be sure to catch Wells Fargo CFO on Money Movers. That's today at 11 a.m. Eastern. Meanwhile, catch Citi CFO on the exchange. That's at 1:15 p.m. Eastern. All right, coming up here on Worldwide Exchange, more bad news for Tesla and a new downgrade out this morning. We're back right after this break. And welcome back to the Worldwide Exchange. Time now for your morning call sheet. We start UBS downgrading its rating on Tesla to a sell. It cites what it calls risk around where growth opportunities will materialize on a longer-term horizon for the company. Wolf Research initiating coverage of Spotify with an outperform rating and a $390 price target. It says the streaming giant will be able to leverage its lead in audio to super serve customers with other forms of audio, like a podcast. And Morgan Stanley cutting its price target on Starbucks from $104 down to $98. It says while the second half of the year is mostly de-risked for the coffee giant, China remains a real hurdle. Time now for your global briefing. Japan's Nikkei falling by 2% and snapping its three-day win streak after hitting a record high yesterday. The sell-off coming hand in hand with a sudden uptick in the yen against the dollar, which reversed most of its gains the end of the day. Analysts say the yen could have been strengthened because of intervention from Japan's Ministry of Finance, who flagged concerns in the currency market earlier today. Chinese exports growing at their fastest pace in more than a year last month, up more than 8.5%. The strong trade data is a bright spot in China's otherwise slowing economy, even as its relationships with Europe and the U.S. deteriorate. Imports, however, not faring quite as well, unexpectedly shrinking due to weak domestic demand. And Apple's Vision Pro headset continuing its international expansion, going on sale in Australia, Canada, France, Germany, and the UK today. Customers in China, Hong Kong, Japan, and Singapore have been able to buy the headset since late last month. All right, coming up here on Worldwide Exchange, we do have the one word that every investor needs to know today. Plus, President Biden tapping into the economy as he tries to calm ongoing fears around his re-election efforts, where our next guest says the president may have bought himself more time. We have much more when Worldwide Exchange returns. Stay with us. All right, welcome back to Worldwide Exchange. Turning now to the 2024 race, President Biden remaining defiant in his fight to keep his presidential campaign afloat. Speaking during a solo press conference yesterday to close out the NATO summit in Washington, Biden once again dismissing calls for him to drop his re-election bid.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out, for the longest time it was, Biden's not prepared to sit with us unscripted. Biden's not prepared to, anyway.
As the president works to calm fears around his cognitive abilities, he made a notable flub while speaking about his vice president.
I wouldn't have picked Vice President Trump to be vice president, but I think she was not qualified to be president. So let's start there. Number one. The fact is that
So that mistake coming after you referred to Ukrainian President Zelensky as President Putin just earlier in the day. So moments after the president finished his press conference, Congressman Jim Himes, the top Democrat on the House Intel Committee, became the latest congressional Democrat to call on him to suspend his campaign. For more, let's bring in Ed Mills, Raymond James Washington policy analyst. Good morning. Great to see you again.
Yeah, good morning, Frank.
All right, so Ed, we had you on just a few days ago. Talk to you about how you saw the campaign. Now, after this solo press conference, the president out there in the spotlight for quite a while, did that change your opinion of the president's campaign or any other part of this?
Frank, what a seesaw this week has been. And I think that we started off this week with Biden with momentum to stay in the race. A okay interview with George Stephanopoulos with ABC News and going on Morning Joe, letters to congressional Democrats. But then really swung back once Pelosi came out and started questioning whether or not Joe Biden had to make a decision, almost saying that the decision he's made is not okay. The press conference last night was probably good enough for him to stay in the race for now. It was an hour-long unscripted event, something that people were concerned he wasn't able to do. Supporters of him will say his answers to questions, especially on foreign policy, were strong. But detractors are going to point out to exactly what you pointed out, calling Zelensky Putin, Kamala Harris, Donald Trump. And I know a number of members were asked, wait until after this NATO summit before you call for him to withdraw. And so later today, throughout this weekend, I expect the numbers to grow in terms of how many members of Congress ask him to step aside. But the Joe Biden I saw last night seemed very convinced in his ability to stay in this race. And ultimately, this is up to Joe Biden. Okay. If he wants to stay in, he has the delegates.
You mentioned Joe Biden kind of pushed back on some of the questions from his Democratic colleagues. He's also pushing back on the Trump campaign pretty hard, bringing up Project 2025 and a lot of the key policy differences, including tariffs. In your mind, did those jabs, did they really land with his constituents?
It's a start. This was part foreign policy press conference, but probably even more a campaign speech. What Democrats have wanted to see from Joe Biden is for him to go directly after Donald Trump, make the contrast in terms of what his policies would look like versus Donald Trump's policies. So bringing up Project 2025, when you go and have to defend some of the issues in there, one of the true lessons I always learn in DC is that in politics, when you're explaining, you're losing. What the Biden campaign wants to do is look to Project 2025, take out the most controversial things that do not poll well with swing voters and saying, this is the format that you will get. This is the policy you will get if Donald Trump goes back into the White House. Trying to shift this, because if this is a referendum on Joe Biden loses. But if the Biden campaign can shift it to a referendum on Donald Trump, Joe Biden has a shot. That's why they're doing this.
So obviously, a lot of eyes on Joe Biden. You mentioned we might hear from more Democrats in the coming days. Almost like out of mind right now, the fact that the RNC starts next week. A lot of implications there for investors, especially. The president expected to announce a vice president. Give us a sense for investors as the president looks at a vice president. What factors should they be considering? Are there different vice presidential picks that have different market implications?
Yeah, Frank. So it's almost remarkable that we have the Republican National Convention next week, because it's almost been 100% Joe Biden all the time in the political conversation. But as early as next Monday, we could get Donald Trump's vice presidential pick. When I've talked to former Trump officials, they tell me the vice president under Donald Trump is more important than almost any other president, that the pick for vice president is in there on all policy decisions. So if it ends up being J.D. Vance, the senator from Ohio, expect a much more tough stance on trade. That's where we have to start worrying about those tariffs a little bit more. If it's Marco Rubio, man alive, is that going to be tough on China? If it's Doug Burgum, the North Dakota governor, maybe there is a little bit more pro-business tilt to this. He had a tech company that he sold to Microsoft. That's how he made money. As the governor of North Dakota, is that really positive for energy policy? So look to who Donald Trump selects for vice president to get a true signal of what the day-to-day policy in the White House would be if he's elected in November.
Ed, always great to see you. Always appreciate your insight. Thank you very much. All right, also want to remind the audience out there, President Biden is going to sit down with our NBC colleague Lester Holt for an exclusive interview. That's coming up this Monday at 6:30 p.m. on Nightly News. All right, coming up here on Worldwide Exchange, we're going to dig into the market rotation, where our next guest is questioning whether it's too early to dive in and the beaten up names he's adding to his portfolio. We'll be right back after this break. Back to Worldwide Exchange. The market's seeing a major rotation, well, at least for a day. The S&P and the NASDAQ snapping a week-long winning streak as NVIDIA, Tesla, and other mega caps, they fall pretty sharply, wiping out nearly $600 billion in market value yesterday. That's the second biggest on record. Techs tumble as small caps gain, soaring on the back of that softer than expected CPI data. It's the first time since the financial crisis back in October of 2008 that the Russell 2000 rallied more than 3% on the same day that the S&P closed in the red. Some investors think this could be an inflection point, including top market watcher Ed Yardeni.
What I'm counting on is the market rally broadening out. So I like what I'm seeing today. I wouldn't mind at all if the Magnificent Seven do nothing for the rest of the year, and we see money going to the rest of the market, which has been left for dead there for a while.
Let's bring in Jeff Kilberg, founder and CEO of KKM Financial and a CNBC contributor. Jeff, good morning. Good to see you.
Good to see you, Frank.
All right, so Ed Yardeni saying he wouldn't mind if the Mag 7 did nothing and the money all went to those quote-unquote left-for-dead sectors. If that happens, let's just pull on that thread again, how do you see that impact in the market?
Well, I think we all want to have our cake and eat it too, Frank. But when you see that stark contrast like we saw yesterday, where the S&P 500 was down 1%, and you saw the Russell 2000, which, by the way, has been dragging about 12% year-to-date to the S&P 500. If you look on a three-year perspective, Frank, you have seen dramatic underperformance by the Russell 2000. But yesterday was really a highlight on significant volume. You saw the S&P 500 down 1%, led by the Magnificent Seven. On average, the Magnificent Seven was down about 4%. But the other 400 names in the S&P 500 were actually up over 1%. So I think if we see follow-through on this theme, this reshuffling of the deck where there's repositioning by investors, I think volatility is actually going to come back, and you'll see the VIX pop above 18 or 20, and that could really be an opportunity as people reposition.
Yeah, a lot of people think volatility is better for single stock investors as opposed to people who are index investors or passive investors. So Edgar Denny says we might have an inflection point. I want to get a sense of how you see today. What's your WEX word of the day?
My WEX word of the day is recalibrate. I think yesterday really was like a large rock, or even a boulder being thrown into the middle of a pond. There are reverberations, there are ripple effects from that. So if you see follow through, look already at the S&P 500. Yes, it's trying to bounce back a little bit, but the Russell 2000 in the pre-market up over another 1%. So I think you're going to continue to see profit taking from the Mag 7. But if that profit taking turns into repositioning, reshuffling, NVIDIA in itself is owned in over 500 ETFs. So if you see some trimming, some profit taking, those reverberations, that recalibration will continue, Frank.
All right, you did some recalibration of your own, but it was actually before yesterday in that softer than expected CPI report. You bought the small caps a couple of days before that CPI report. What's your outlook on small caps? You have Tom Lee saying that small caps can rally as much as 50% this year. He said that earlier. He hasn't backed off that forecast. What's your outlook?
We've been chomping at the bit to allocate towards IWM, the Russell 2000, and we did take an allocation. And yes, we get excited about the movement yesterday on anticipation that we are going to see interest rates move lower. But I'm not that optimistic on interest rates going under 4% specific to the 10-year. But I like owning small caps just because they have been left out on the street. If you look at that longer chart, pick it 1 year, 3 year, 10-year, it's been such a significant laggard. So I think there's an opportunity for a mean reversion for small caps, but that's only going to be contingent upon if you see further profit taking in the Mag 7, Frank.
All right, Jeff, I want to get to your picks very quickly. We're almost out of time. Masco, owner of the Bear Paint brand, also kills popular primer if you had to prime a wall. Also Home Depot, kind of tied to the home trade. Why is now the right time to buy these stocks?
Well, you saw yesterday investors flock to these smaller names, which have kind of been flat on the year. And even CME Group's another name, which is actually down on the year. These names will get attraction when people have cash in their portfolios. They're looking to allocate to great names, blue chip names, and those names are those three.
All right, Jeff Kilberg, it is always a pleasure to see you. Thank you very much. One more quick look at futures before we let you go. I don't know if you noticed, the NASDAQ actually just went fractionally higher again. It was fractionally lower just a bit earlier in the show. Right now, it looks like the Dow would open up 50 points higher, the S&P fractionally higher. Squawk Box starts right now.
Good morning. Tech stocks pulled back yesterday, snapping the S&P 500 7-day winning streak. We're going to talk about what's behind that move straight ahead. President Biden remaining defiant and steadfast about staying in the presidential race despite several gaffes on stage. Take you live to Washington for the latest buzz among Democrats and Republicans and everybody. And earnings season kicks off today. Enjoy. We're going to hear from J.P. Morgan, Wells Fargo, and Citigroup all before the opening bell. It's Friday, July 12th, 2024. Sunshine today. It's right next to me. Squawk Box begins right now. For you.
Good morning and welcome to Squawk Box here on CNBC. We're live at the NASDAQ market site in Times Square. I'm Melissa Lee along with Joe Kernan. Becky and Andrew are off today. Nice to be back on this Friday.
Nice to have you.
Let's start off with the markets. Tech stocks dragged down the NASDAQ in yesterday's session. Closed about 2% lower. The S&P 500 fell by about 0.9%, breaking a 7-day winning streak. The Dow also closing slightly higher here. Among the big tech decliners, Tesla was down 8.5%, NVIDIA down 5.5%, Microsoft and Apple each fell by more than 2%. And amid the drop in tech stocks yesterday, the Russell 2000 Small Cap Index surged higher by 3.6%. Bespoke Investment Group points out that yesterday was the second day, just the second day, since 1979 when the Russell 2000 rose by more than 3%, while this S&P 500 declined. So what did that tell us about yesterday's session?
I immediately was
equal weighted.
Yeah, I was thinking about the NASDAQ, and that's what I was looking at today. Just to get some perspective. Not saying it's 1999.
Oh, you think that it's like...
No, it's just, it's AI is very powerful, but in October, how long ago was that? Was that 9 months? I think it was 9 months. 12.5. 12.5, we're now 18.2. if you go back just a little bit further to late,
In terms of the run.
well, that's almost 50%.
Yeah.
In 9 months. And if you go back to late 2022, you're basically talking about 10,500 to 18,500. You're talking about 80% since Christmas, right before Christmas in 2022. When you look at the chart, I mean, it looks like, a tree growing to the sky. AI is very powerful. NVIDIA's I understand all that. Building it out makes NVIDIA very profitable, but there better be some real profits from AI for everybody else once they build it out.
Return on investment.
To justify.
Yeah, exactly. The spend, justify the spend.
The spend and where the NASDAQ is. And I don't know. It's not 1999, but don't you think that maybe we're ahead of ourselves? Or
Maybe it's time for some of the other groups to participate, which is exactly what we saw in yesterday's session. The Russell 2000 RSP, the equal weight, the S&P 500, that was, what advanced in terms of relative performance versus the S&P 500. We saw strength in biotech. We saw no surprise. We saw strength in home builders, REITs, interest rate sensitive stocks.
You get to say all this stuff because you summarized everything that happened yesterday at 5 p.m. That's invaluable. That is invaluable. I should watch and then come in.
You don't watch?
I don't all the time. I mean, there's only so much business news. After watching it every hour throughout the day.
So you watch every hour throughout the day, and then you stop at 5 o'clock?
That might have been exaggeration. No, I do. Okay, actually, no, I do. But I do think it helps too because you have all those guys, and they're all talking about biotech, talking about everything that made moves yesterday. Really, a quarter point cut is so great that all this is warranted. That's also it too from those.
Yeah, when the odds go to 90+% of a cut.
So it's good, because maybe it's the end of the tightening cycle, and maybe inflation's under control, and maybe we don't need to keep tapping the brakes on the economy. Okay, so those are all good things.
Yeah. Futures at this hour higher across the board. S&P 500 looking to be higher by about 8 points. The Nasdaq also looking to gain by about 15. Treasury yields, meantime, after yesterday's decline, 4.229%, so we're a little bit higher on the 10-year yield. The 2 years at 4.525.
Do you have a fast money planner? You don't have a fast money planner.
I guess we don't plan.
You don't plan. You don't plan squat. Do you?
We don't plan squat.
Pops and drops. We stole that from you for a while, and then we
lent it to you.
Yeah.
We allowed you to
use it. You may not. We do have a squawk.
Thank goodness. I wouldn't know what I'd be doing today if not for the squawk planner.
PPI's coming today. More inflation data is ahead. We're going to get the June read on producer prices at 8:30 a.m. Eastern. We're going to have a panel and talk about it.
I'm writing that down.
We had a panel yesterday.
To discuss it. Actually, was big.
And it actually got into, it's just, you cannot get politics out of, you can take politics out of them, but you can't, it still came to that because one individual was talking about the reason that real wages haven't risen is because of all the low income jobs from all the illegal immigrants that have come in. And now. And I said, well, that's part of the problem, isn't it? And she goes, no, these are people seeking, that are here seeking asylum, and it's all fine. And I said, well, 10 million in a couple of years is okay? And it was like, yes. So even a business discussion, luckily it does, because November's coming, and we will talk a little bit about last night, I think. Did you watch?
We will, and we will talk about Trump's policies and how inflationary they are perceived to be.
We did yesterday. You did, yeah. Although the 10-year immediately, even when it looked like after the debate, like he was more likely to be the president, 10-year went up 20 basis points in yield and then pulled right back in the next couple of sessions. Earnings season is going to kick off from JP Morgan and Wells Fargo this hour, Citigroup at 8. Speaking of last night.
Yep, now to President Biden's news conference last night at the NATO summit. Megan Casella joins us now from Washington with the big takeaways and the reaction from Democrats. Good morning, Megan.
Good morning, Melissa. It was a busy night. It was an hour-long press conference that showed Biden defiant. He declared over and over that he was staying in the race, that he was the best candidate to beat Donald Trump, and that he was physically and mentally up to the job.
If I slow down, I can't get the job done. That's a sign that I shouldn't be doing it. But there's no indication of that yet. None.
Biden spoke at length about foreign policy and the economy. Many of his allies saw that as a strength. I heard from one who told me, this isn't a man who has dementia. But there were also moments that his critics are seizing on as evidence of why he does need to step aside. Listen to this.
I wouldn't have picked Vice President Trump to be vice president, but I think she was not qualified to be president. So let's start there. Number one. The fact is that
Now, all of this still leaves Democrats in limbo. He didn't do well enough to satisfy everyone, and 3 congressmen, Jim Himes, Eric Sorensen, and Scott Peters, called on him to resign just after it wrapped. But he didn't make any fatal mistakes either. The issue is there's no solving for age, so the magnifying glass is still on Biden, and it will stay there as long as he's in this race. Guys?
There are reports too, Megan, that the UAW, is meeting to evaluate their endorsement of Biden?
Yes, Reuters is reporting that they're concerned, that they're not seeing a path forward, and they're sort of debating what to do next. They had endorsed him, and that's something I think is really crucial because President Biden has long prided himself on just how close he is with unions and with labor leaders across the board. He visited with some just this week. So there's been a lot of talk this week about how, with the chattering class, as he likes to call it, the pundits and Democratic elites and the wealthy donors and the billionaires coming out against him, that kind of makes him dig in his heels even more. And he says, I'm not running for those people. I don't care about the millionaires. If we start to see more defections among union leaders like that one, that's something that could sort of dig into his ethos a little bit more. That's something he might start to listen to.
Megan, thanks. Megan Casella.
You watched it. I thought, okay, there are times when you are thinking about your next sentence.
Sure, and you put a word in. Yeah.
That only happened twice. In general, it was not the debate Biden. He was cogent. He was lucid. He
made very specific points.
Grasps of a lot of it. So Democrats who are, it's just enemy of Miami. Democrats who are now in vulnerable positions themselves were disappointed that he didn't screw up more, which is a kind of a sick situation.
Because they want to strengthen the
That was the same Joe Biden. It was Dark Brandon, he whispered, there were inappropriate smiles, all the things that we've seen for years. It wasn't any different than a year ago or 2 years ago. That's the same Joe Biden that they gave all the delegates to willingly as the head of the Democratic Party. That's the same guy. If they don't like him now, after last night, it's because they're looking at the polls. Just like the UAW is looking at the polls, just like other people are looking. Suddenly, George Clooney.
You can't fault them though for looking at the polls. They want to beat. They want to beat Donald Trump.
Stay in power.
They want to stay in power. They want to strong down ballot. That's what they have to do.
Fine. There's no loyalty to the guy that got them to this point.
That's politics, Joe.
I know. Maybe that's the real world.
It's politics.
Yeah, it is. But he's got all the cards, and he can stay. He's got the delegates,
he's got the money.
And he can say, you know what he can say. I'm not going to say it, but you know what he can say, for them to tell them what to do. And I think he's still going to after a while. And he can make, just like they said, some Democrats said that I didn't like everything. It didn't change my mind. But no one can say, oh my God, there's a smoking gun from last night. He wasn't. He was the same guy that we said. Some of this I disagree with the. Inflation's because corporations are greedy, the sort of faux outrage about, guns and the stuff that we've seen from him again and again and again and again. But it was the same Joe Biden. So if you don't like him now, like George Clooney, if you don't like him now, this is you. This is you. This is not him. This is you for your own, whatever you're interested in. It's not Biden.
It's all about what an individual or a group is interested in.
How it relates to me, ever. Okay, you can do the quote.
We do have a programming note. On Monday, President Biden will sit for an interview with NBC nightly news anchor Lester Holt. It will air during a primetime special Monday night, 9 p.m. Eastern Time on NBC. Up next, are we seeing the start of a rotation out of the Mag 7 tech stocks? We'll talk technicals after this break. And later, he's been called the Fed Whisperer and Nikki Leaks. Nick Timreos from the Wall Street Journal will join us on the potential Fed reaction to yesterday's soft inflation data. Squawk Box will be right back.
Tesla shares tumbling yesterday. It's been up how much? So it's down a little bit. Broader tech sell-off aside came after Bloomberg reported that the EV maker is delaying the unveiling of its robo-taxi by 2 months. Report says Tesla is pushing back the launch from August 8th to October to give teams working on the project more time to build prototypes. Yesterday's loss sent Tesla back into negative territory, though, for the year, but you can see the run that it's just had.
11-session winning streak.
Yeah.
Broken very violently yesterday. We did take a downgrade this morning by UBS, so there is some pressure on the side. Let's dig into the big tech moves this year. Our next guest says if those mega cap stocks keep rising without support from the average stocks, it would create a durability issue similar to the tech bubble. For technical analysis, let's bring in Ted Sohn, technical strategist at Strategas Research Partners, a Baird company. Great to have you with us.
Thanks,
We've been hearing
here.
that for a long time about this durability issue that's too concentrated, and yet the march has gone on. And yesterday we saw glimmers of hope of some broadening
for the rest of the market.
For the rest of the market.
The Mag 7 as an index is 30% above its 200 moving average. That's pretty aggressive. It's not extreme like 2021 was, but it can create a summer speed bump, especially with the election cycle starting to kick out. You can get corrections during election years. So I wouldn't be surprised if you saw some profit taking, but ultimately, the key to this market is the equal weight S&P 500, because when you start to get these big weights, which are so influential now in the S&P 500, without the bench, as I like to call it, you're not going to be able to sustain that. And that's when real issues come through. And so I liked what yesterday had, where you had the large cap names pause, but really good internal strength.
We have, I think, 400 of the S&P 500 stocks actually trade higher today, which is a real positive sign. When you take a look at some of the leadership when it comes to the AI trade, it has been semiconductors. And I think what was really notable in the month of June is we saw some really interesting moves, particularly among NVIDIA and Broadcom. We saw outside reversals June 20th or so that week. And they haven't really regained. They haven't gone up to back to highs at all set on those days. Should we be more concerned given the sort of the speed bumps exhibited by some of the components?
Yeah, I think the expectations are so high. We have earnings coming up that when you start to see outside reversals like that on very high volume too, like think about
very
this.
High volume, yeah.
The 2x leveraged NVIDIA ETF is one of the most traded ETFs now. That is very uncommon, right? Usually it's your SPYs, your IWMs, right? So it's really odd to see this single stock ETF up there. So I think that you're setting yourself up for a correction. And if I was a portfolio manager, if I'm an investor, I have 10 stocks that are 40% of the S&P 500, 10 stocks that are 60% of the large cap growth indices. So I want to look away. I want to look at healthcare. I want to look at financials, which as big tech has paused, those are the names that are actually starting to break out here too. So there's a lot of opportunity away from mega cap growth.
And going to some of the sectors that showed some glimmers of life yesterday, REITs had a very good day yesterday. Home builders had very, on this pullback in rates, the expectation that the Fed will actually start cutting decisively in September. Are those moves, do you think, sustainable? How do the charts look?
The REITs are really interesting to me, along with a lot of those are in the small cap space. The small cap Russell 2000 has gone 670 trading days without a new all-time high. That's the third longest streak in history, only following the tech bubble and the financial crisis. So the bar for stuff like real estate, healthcare, small caps in general to work, I think is really, really low, right? And tech has worked for good reason, but I like this idea of that broadening out, of looking away to the stuff that has not worked really in 2 years. The equal weight S&P 500, give or take a few days, has been basically sideways since January of 2022. So timeliness is there, and the sentiment environment too is really supportive. I think it's nowhere near the euphoria we saw 3 years ago.
We were talking about Tesla just before we came to you. 11-session winning streak, I think it was at 40% or so in that, in this sort of run-up, most recent run-up that it's had. Is there any concern about the velocity of this move?
I wouldn't expect anything less from a Tesla type stock, right? The volatility there is immense. My issue with Tesla is it's the sloppiest of the Mag 7, right? Apple, NVIDIA, Google, Meta, those are all defined uptrends. Yes, they can correct from extended positions. Tesla's the hardest call because there is no trend there. You've had these volatile moves, 40% down, 40% up. I don't know if I have a great call there. I suspect this sentiment will get worse, right? It was pretty bad a few weeks ago. You still have about 13 or 14 sell ratings. That's the most of any stock, large cap stock out there. So yeah, low bar, but you're trendless. It's difficult to make a move on Tesla. I'd rather play through options.
And also in the category of making run-ups into earnings, banks. So what do you see in the charts there?
I like how the big banks have acted. JP Morgan's still strong. Citi and Bank of America have pushed to new highs. The regionals can be tricky due to rates, but they've had a really nice week, and that goes along with small caps because of how influential they are. So again, I don't see many flows to financial type ETFs either. I think the bar is really low for these stocks to work. Pass it along to even the asset managers. Goldman and Morgan Stanley are breaking out. So this is more evidence that there is a want to broaden out besides these influential stocks. I think there's a lot of opportunity to diversify away from the 10 largest weights.
So forced to choose equal weight over S&P at this point?
I think equal weight is the move for the next few months, or the back half of the year, let's call it that, 2H 2024.
Todd, thank you.
Thank you.
That's
Twitter, or X, the latest U.S. tech company in the crosshairs of the EU at this point. Regulators charging the social media company with breaching online content rules. Regulators said X's verified accounts with blue check marks do not correspond to industry practice and negatively affect users' ability to make free and informed decisions about the authenticity of the accounts they're interacting with. X has also failed to comply with EU requirement that companies provide a searchable repository of advertisements or advertisements. X also charged with blocking researchers from accessing its public data. The company could face a fine of up to 6% of global revenue if it's found guilty of breaching the Digital Services Act. Are you keeping track? How many is this? They're gonna make
digital services.
They never need to have another. They don't even need an economy anymore. I don't think they can just
collect global revenues
from the US.
6% of global revenues.
Like they sponge off of us for all their defense needs, and don't really pony up. Now they don't even need an economy. They can just get 6% of what all of our great companies do. It's a pretty good gig if you can get it. Coming up, Chili's should have stuck to the Baby Back Ribs song. The chain now being sued by the Beastie Boys. They're still around. The Beastie Geezers now for using their music and ads without permission. Details next. Plus, big banks set to report. JP Morgan and Wells Fargo results due in the next few minutes. We're bringing those numbers and reaction on Wall Street Squawk Off. Be right back.
Join Jim.
Beastie Boys are suing the parent company of Chili's restaurants, Brinker International. The group says the restaurant chain used its song Sabotage in social media ads without a license. The lawsuit says the Beastie Boys do not license Sabotage or any of their other songs for product ads, and notes that deceased group member Adam Yoke included a provision in his will prohibiting such uses. The group is seeking at least $150,000 in damages and an order blocking Brinker from using their work. The Beastie Boys won a $1.7 million jury verdict against energy drink maker Monster Beverage in 2014 for using its music without permission.
A U.S. Appeals Court ruled yesterday that college athletes in Division I revenue-generating sports, like football and basketball, can't be excluded from U.S. labor protections. That decision rejects the long-time argument by the NCAA that athletes aren't workers, but they're playing as student athletes. The athletes in the case have argued that they should be allowed to bring claims under the Fair Labor Standards Act that establishes rights to minimum wage, overtime pay, and restrictions on child labor. And the panel of judges said that the term student athlete is a marketing invention of the NCAA, and it would not use a term with such a dubious history to define the economic reality of athletes' relationships to their schools. The court also said that, in their words, revered tradition of amateurism was not a valid reason to prevent athletes or bar athletes seeking worker protections. The appeals court denied the NCAA's bid to dismiss the athlete's case and sent it back to the trial court to proceed. Over the past few months, the NCAA has paved the way for athletes to be paid as a result of a separate settlement, but had been seeking to hold the line still that players aren't workers. And we're going to talk more about all this with sports business Professor Patrick Risch. That'll be in the next hour. We may touch on something we care about too, the Olympics.
Oh, yes. Yeah, coming up right around the corner.
Right around.
Are you packing your beret?
I haven't. I'm going to buy one when I get there.
Yeah, you're going to leave the one from the last
You-
trip to Paris at home
What color do you think? You know what color? You know what color I'm thinking.
for the beret?
Yeah.
What color? Red.
Raspberry. You gotta work with me. I can't believe after all this time.
Oh, yeah, all this time? I'm here like once every 5
For
weeks.
3 hours, and you talk about what a long 3 hours it is.
It's a long 3 hours. 2.5 to go. All right, coming up. New signs that prices are beginning to cool off in the used car market, but auto insurance prices remain hot, red hot. Contessa Brewer's got that story next, and still ahead, quarterly results from JP Morgan, Wells Fargo, and Citigroup. Stay tuned for the numbers and instant market reaction. And as we head to break, take a look at yesterday's S&P 500 winners and losers.
well.com.
Good morning and welcome back to Squawk Box Live from the NASDAQ market site in Times Square. Now it's the Dow's turn to shine. As in previous sessions, we've seen the NASDAQ and S&P outpacing. The Dow's up a little bit. NASDAQ was down, but it was 300 points, but more than 300, but it was only 2%. And it's been, on a still headed higher. A lot happening today, though.
The June CPI data showed signs of cooling inflation with used car prices and gasoline easing, but the cost of car insurance remains red hot. Contessa Brewer joins us now with the details. Contessa, good morning.
Good morning, Melissa. Car insurance is a glass half empty, glass half full kind of thing. Car owners are probably getting sticker shock when their bill arrives. June CPI showed auto insurance up 19.5% over last year and up almost a full percent from last month. But if the car owners are also investors in car insurance companies, well, glass half full. Progressive shares are up year to date more than 32%. Let's show you. And Allstate up 15%. B of A Securities predicts strong margins for the auto insurers, in part because the rate hikes are still catching up with several years of lagging, as insurers paid out more in repairs and replacement in claims than they were taking in premiums. Catastrophes, though, could still interfere. Look, we had a Cat 5 hurricane, the earliest ever in the season. Progressive in May got slammed with $722 million of net catastrophe losses. According to Piper Sandler, that was more than 12% of the premium, as much as 4 times what a normal summer month would represent in catastrophe losses. And remember, that's not even a hurricane damage. That's mostly thunderstorms. Travelers announces earnings next week. We'll see if those high cat losses are reflected there as well. Melissa?
But unlike other parts of CPI, Contessa, it sounds like this component might actually remain elevated.
That's right. It is remaining elevated and may still remain elevated in the months to come because it's still catching up, because it takes time for the insurers to go state by state to the regulators, apply for the rate hikes, and finally get them. Remember, in California, they went years without getting the rate hikes that they had applied for and are just now starting to catch up to that. So you're likely to see car insurance stay high for months to come.
Contessa, thanks. Contessa Brewer.
So coming up, Alex Thompson from Axios is going to join us on what he's hearing from Democrats in Washington. Not besides the crying and the gnashing of teeth, there's actually some other things he's hearing about President Biden's news conference last night. That's next. And a reminder, get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out, for the longest time it was, Biden's not prepared to sit with us unscripted. Biden's not prepared to, anyway. And so what I'm doing is, and I've been doing, I think we've done over 20 major events from Wisconsin to North Carolina, to demonstrate that I'm going out in the areas where we think we can win, where we can persuade people to move our way.
Probably know by now, popcorn sales soaring. First was the debate. Remember, first was the debate. Who must see TV? Then Stephanopoulos. People lined up at their sets last night, waiting for 6:30. Waiting for 6:30.
And then Monday it'll be the interview with Lester Holt.
Right, a NATO news conference.
I know everybody is watching
A
it.
NATO
Can you imagine?
news conference. It's really unbelievable. Join us now. Alex Thompson is a national correspondent for Axios. It's almost like Alex, like almost appointment TV, almost a sporting event. And I'm just going to put this out to you, and then you can disagree with me. For me, I wish you could bet on it with DraftKings. And I wish I would have bet on Biden. Biden last night for the win, for the W. Disloyal, feet of clay Democrats in vulnerable areas for the L. That's what I saw last night. What'd you see?
I think you saw a president that is very dug in and has no intention of getting out of this race. And he and his inner team have a disconnect with a lot of these Democrats. The thing you have to understand about Joe Biden's team, and he articulated it both last night and in the interview with George Stephanopoulos, which is that he believes he's the most electable Democrat against Donald Trump. And if you believe that, why would you take yourself out of this race? Just because a few, House Democrats are complaining and worried about their own races.
But Alex, what indicated to you last night that he was any less cogent or lucid than 84-year-old Nancy Pelosi, 85-year-old Steny Hoyer? He had a grasp of the issues last night. I think Democrats at this point have a tough time even making the case that he's no. Now, I disagree with almost everything he says in policy and everything else, but we'd have the same with Kamala Harris. But this is the same guy that I saw a year ago. He starts whispering and he has that weird smile that comes at inappropriate time. But it's the same guy. He was lucid. Do you think he had dementia last night and was unable to put thoughts together about foreign policy and policy in general?
Well, I'm not going to say the D word on national TV, but I will say that no, I mean he did have a command of the issues, and foreign policy has been one of his hobby horses. Is clearly the issue that he feels the most passionate about, going back to his time on the Senate Foreign Relations Committee. And you can tell in interviews when they ask him about, why elect you for a second term? Beyond beating Trump, foreign policy is often one of his focuses. Now, of course, some of the substance of his remarks was undermined by a few notable gaffes, including earlier in the day introducing President Zelensky as President Putin, referring to Vice President Kamala Harris as Vice President Trump. But agreed. I mean, if you are a Democrat that desperately wants Joe Biden to drop out of the race, last night was not helpful.
No, I agree. And I still, earlier someone said politics is a really dirty business. Okay, I get that. But, a lot of these people were full on in the Biden camp until some of the poll numbers after the debate and what it meant for down ballot races. You can just look at the people that are most outspoken and the earliest ones. Look where they're located. Look at what their prospects for re-election are, and you can see where they're coming down on this.
Absolutely, and what we're really it'll be very fascinating to see with the second round of polling, probably coming later this week. The July 4th holiday really made it so it was difficult to get data after that initial wave of polls. So you're going to see the second round of polling over later this week and into early next week. And it's going to be really fascinating if the dam has more cracks in it after that.
At what point does it get concerning that the money just isn't going to the campaign anymore? I mean, we've already heard about donor revolts, donors reallocating funds to down ballot races to strengthen those candidates as opposed to going to the presidential campaign. At what point, Alex, does it get concerning?
it already is concerning. I can tell you inside the campaign, there are deep concerns that the money is going to dry up, that they are going to be significantly outraised this month and potentially in August. There is a hope that, if Biden still sticks this out and is nominated in Chicago on August 22nd, that is the day when he is supposed to be nominated, that donors will come back and rebound just to beat Trump and get them over the line. But yeah, donors, there's an emotional aspect to this too, because donors were told by people like Jeffrey Katzenberg and everyone else that Joe Biden's health was completely fine, that he was completely with it, that the debate Biden did not exist. And that frustration and anger is leading a lot of them to, if not completely outright quit, sort of quiet quit, and that they just aren't giving as much as they would have otherwise.
Right. But when he said, well, if God comes down and tells me I got to leave the race, then maybe I'm starting to believe him that he really believes that. Alex, when push comes to shove and the rubber meets the road, is it up to him?
Yes, there are very few mechanisms to actually push him out of this race, and that's he won the nomination. He is the presumptive nominee. He has the delegates. This is an incredibly personal decision, and it's unclear who can actually sway him. This idea that Barack Obama will come in, their relationship is very complicated. I was talking to somebody just yesterday about that dynamic, and they said, Obama already pushed him out of one presidential race, and that was back in 2015. Yeah. And that's how the Biden world feels. And they basically say, he already did it once, you don't get to do it again.
I mean, I find myself in a unique position, but I would be furious if I knew that Obama and George Clooney were having conversations on the phone about me and whether I should stay in the race, and go ahead and write. I'm behind the op-ed. I think my head would explode. I don't know what I would do. I wouldn't be having lunch with former President Obama anytime soon in the White House. I can tell you that. And I think that some of these other individuals, if he is reelected, if he runs again and is reelected, hell hath no fury. I mean, I think that they might not be welcome in the Democrat. They may have bigger problems than the reelection, because even if they are reelected, they're not going to be welcome.
Yeah, I mean, Joe Biden has tried to argue that he does not hold grudges, but that's just not true.
Yeah, none of us. I don't either. Alex, thank you. I have none with you. Or Melissa. Believe me, nothing. Thanks, Alex.
Coming up, a new report about the timeline for the Chevron Hess acquisition. We've got the details next. And we are awaiting earnings from JP Morgan and Wells Fargo. We'll bring you the numbers and instant reaction as soon as those numbers cross. Stay tuned. humanly possible.
Wells Fargo and JP Morgan are out. Leslie Picker's digging through Wells here. What do we have?
Hey, Melissa. Yeah, I see a beat on the top and bottom line here for Wells, but the stock is declining pretty significantly, down about 5.6%. And I believe it's due to this net interest income number that came in at a miss, 11.9 billion, down 9% year over year, below expectations for the street. And there's also some net NII guidance as well, where they reiterated the guidance. The full year guidance that they had previously given was for net interest income to be down 7 to 9% year over year. And now the firm says they expect that to be closer to the 8 to 9%. So more of a steeper declines of that prior range that was given. Now, how they got to the beat on the bottom line was from non-interest income. This is 8.8 billion, up 19%, and a beat on expectations. So that overcompensated for the miss on NII here. That's driven by investment banking fees. Those were up 70% to 265 million. Although last year, you'll see this a lot, is my guess, in 2Q across the banking system, because last year was such a low bar in terms of investment banking. And also advisory fees, brokerage commissions, those were up about 11%, and net gains from trading. In terms of the provision for credit losses, the firm says that will be 1.24 billion, so a slight beat relative to expectations there. And then there's also some net interest expense guidance that was updated to 54 billion from prior guidance of 52.6 billion for the year, and that's due to higher revenue-related compensation expense because the markets have done so well, as well as operating losses and other customer remediation-related expenses, as well as that FDIC special assessment that we saw in Q1. Wells also saying they expect to increase the common stock dividend by 14% to 40 cents per share, subject to the board. So wide-ranging release here. Shares have come back a little bit, but still down about 3.76% right now, guys.
Thanks, Leslie. JP Morgan initially traded up. Now it is down a little bit. The number looks like it has some special items in it, $6.12. The range, 612 is what they reported. The range for analysts was 396 to 463, and the estimate was 419. So there's probably an accounting gain.
Yeah. 440.
440
versus
okay.
419 estimate.
419. We'll see whether it actually goes. The 50.2 billion was above expectations on revenue, 49.87. What I always look at the book value, $111 now, basically, and rarely do you trade it almost 2 times book. It is the best of the banks and commands the highest evaluation. Some of the other things that you see, Melissa, they're talking about charge-offs. It seems like a big number. It's a huge bank, so I don't know whether this is worse, but $2.2 billion worth of net charge-offs and credit costs of $3.1 billion. But, you know, I think most of these numbers are probably best in class. We always, you know, you don't even usually have to check for JP Morgan. It's a quality. Obviously, it's head and shoulders above most of the other major banks that we talk about. Assets under management up 15%. Leslie, you had estimates for a bunch of these, like non-interest, net interest income, all those different things. They're all out here. So
yeah.
You're going to hang out and look at. You can do that.
I'm digging through it right now
and do all those as well. It seemed like it was moving higher once Wells Fargo's numbers came out. It seemed like JP Morgan got affected too.
Right.
Although I don't know whether there's actual credit issues or not. Maybe there.
We're down a percent on JPM right now. Let's bring in Stephanie Ling, Chief Investment Strategist at Hightower and a CNBC contributor. Steph, I know they just crossed, but what do you make of JPM? What do you make of Wells?
So both of these stocks are up 22% year to date. So they always trade crummy on earnings, Melissa, you know that. And I think it's an opportunity because I think you are seeing kind of the trough in net interest income and net interest margins as the yield curve has been steepening. So I think Wells Fargo is being totally conservative in terms of their guidance for net interest income, appropriately so. But given where the yield curve is, I think that those numbers are going to wind up beating. In terms of JP, I mean, my gosh, they crushed the revenue numbers at $50.2 billion. I mean, expectations were for $42 billion. So in my mind, you're going to get an opportunity to be buying these stocks. And I think you want to own the financials because I do think, again, going forward, net interest income, net interest margins will go higher given the yield curve. I think the bond books are actually better because, of course, they get marked to market every day and bond prices have actually gone higher. In addition, the regulatory situation seems to be cooling off a bit. Everybody passed with flying colors on the stress tests. And then going forward, just the base business. Investment banking fees are going to grow double digits this year. Capital markets are going to continue to climb higher. M&A pipelines are also very robust. So I think you want to pick whichever one you like. I think JP is a little expensive at 1.9 times book. I happen to own and like Bank of America at 1.2 times book and Morgan Stanley, which has lagged Goldman Sachs on the capital markets play.
I know we're just going through the number stuff, but it does look like a beat on revenues for JPM, but we have by a smaller margin.
Yeah, 47 to 51 was the range, and the consensus was 49.873.
So still a beat, but just a smaller beat. I mean, I guess, Steph, you know, you mentioned the runs that these banks have gone on into earnings, and I think I don't know, it seems like what we want to have confirmation of in this quarter is that there is an inflection in net interest income. Is that what you're looking for? I mean, that's going to, you mentioned the improvement into the back half, that this was some sort of a, you know, a trough that we will have seen in the second quarter.
I mean, I think so. I wasn't expecting much, given what the, you know, just looking at the yield curve, right? I wasn't expecting much on net interest income or margin. But I do think that going forward in the back half of the year and into next year, I think you will see tailwinds, again, given the yield curve. So I think companies they're all going to be pretty conservative. They typically are. But you just have to see what's going on in terms of you know, the yield curve, and I think that you're going to continue to see revisions higher as you work through the year. These stocks are not expensive, other than J.P. Morgan. That one is expensive, right? I mean, but it always is, and we know why. But these stocks are not really commanding really a huge multiple. So I think you're going to get looks. You buy on weakness, and again, I like Bank of America and Morgan Stanley.
Steph, thanks. Stephanie Link, Wells down by about 5% right now. We're getting some headlines from that press release too. Jamie Dimon, the CEO of JP Morgan, saying inflation and interest rates may stay higher than the market expects. So that's sort of interesting. And of course, everything that he says we listen to, although it's often very conservative.
He's been saying that is.
Yes, said that.
Exactly. Coming up, much more on the big bank reports. We're going to hear from Citigroup around 8 a.m. A totally different animal and major restructuring. And also in the 8 o'clock hour, former Activision Blizzard CEO Bobby Kotick will join us live from Sun Valley on his next venture. Squawk Box coming right back.
CNBC.
It is 7 a.m. Now, just past on the East Coast. You're watching Squawk Box on CNBC. I'm Joe Kernan, along with Melissa Lee. And among other things, here's some top stories. More inflation data is ahead. We'll get the PPI, the June producer prices at 8:30 a.m. Eastern. You saw what happened with the CPI yesterday. Pretty friendly numbers for the Fed and actually anyone worrying about the cost of living. There you can see the futures this morning. Dow is now up, even though JP Morgan turned around. I haven't looked at it, but initially we did.
Flat. It's down 0.5%.
So that's not really hurting that much as far as the Dow. AT&T disclosing a new hack. Affected data from around 109 million U.S. customer accounts. The company says the compromised data includes files containing AT&T records of calls and texts of nearly all of AT&T cellular accounts and the landline customers, both of them, who interacted with those cellular accounts between May of 2022 and October of 2022. The telecom company said stolen records didn't include the contents of messages, names or credit card numbers, and AT&T said the DOJ determined that a delay of public disclosure was warranted, and it now understands that at least one person has been apprehended related to the hack incident.
The Federal Trade Commission plans to delay its decision on whether to block Chevron's $53 billion takeover of Hess until an arbitration case with Exxon is settled. That's according to a Bloomberg report that says completion of the embattled deal could be pushed back from the third quarter to at least the fourth quarter if it isn't blocked altogether. Exxon has claimed right of first refusal over Hess's biggest asset in Guyana.
President Biden defending his re-election bid last night, saying he's the best candidate to beat Donald Trump in November. Megan Casella joins us from Washington with more. Hello again, Megan.
Hey, good morning again, guys. It was a Rorschach test of a press conference. Biden's allies saw a strong and defiant president who spoke in depth on policy issues for a full hour, but his critics honed in on a couple of verbal flubs. He called Vice President Kamala Harris Vice President Trump, and he introduced Ukrainian President Zelensky as President Putin. In the hours immediately following that press conference, we saw another 3 Democrats come out and call for Biden to resign. It brought the total number of lawmakers doing so up to about 17. But Biden was adamant throughout that he would not withdraw. He said repeatedly that he was the best person to beat Trump and that he was physically and mentally up for the job.
Every single day I'm surrounded by good docs. If they think there's a problem, I promise you, or even if they don't think it's a problem, they think I should have a neurological exam again, I'll do it. No one's suggesting that to me now.
The key to watch today, Joe, will be whether more lawmakers come out and call for him to exit now that the NATO summit is over. Biden has made clear he won't step aside easily, so the party really has to decide now whether to keep pushing on him or to refocus and try to reunite on beating Trump.
Yeah. It's episodic. Nothing was decided last night. Like you said, it was a Rorschach test. Neither side got, I think, the knockout they were. And it's weird because neither side. You're talking about one side, the Democrats, and they're totally split. It's right. Have you decided we call it what we call it? Hot mess, dumpster fire. An S show.
Democrats in disarray is getting thrown around a lot.
Yeah, S show or S storm. People calling it
snowstorm.
Snowstorm.
Right.
Snowstorm. Or, yep.
It's interesting, Joe, that, yeah, exactly. You saw what you wanted to see, so I don't think this goes too far towards settling anything, unless you're somebody who feels like the longer this goes on, the more damaging it is, like you said, because it is something maybe of a dumpster fire, and critics can really key in on that. I talked to a couple of donors and bundlers, fundraisers last night who were they stayed where they were. If you liked it, if you already liked him, you still liked it. Some of them were a little bit discouraged because they felt like the Vice President Trump flub was going to take the headline. Others told me they thought it was meandering and halting. It's everyone's stuck where they are.
Yeah. No, I watched the whole thing, and it was unfortunate. The Vice President Trump, and you saw Zelensky's face, but he immediately corrected himself on the Zelensky thing. The other one, I don't know, but if you're on TV, there are times when you put someone's name in and you mean someone, I think I talked about Steve Ballmer, I said Steve Bannon, but and so, senior, you'll see someday. Megan, you've got plenty of time before you have any of these senior moments, but
Hey.
but it does, it might happen. Here's what I was gonna say. Happening now. When I read about some of the campaign staff or some of the president's staff coming to grips with what's happening, it always says these are sort of outside, far away from the center of the Biden universe, the people that are expressing some of the doubts, that core of whether it's Dr. Jill Biden or his son or whomever represents the core, they haven't wavered one iota on whether he should stay, and it doesn't appear that he has either. So I don't know if 17 Democrats that you don't even, some of the names I don't even recognize, I don't know if that's going to be enough.
I agree with you. It certainly isn't as of now. You're right. That inner core has not wavered at all. That's really where Joe Biden has always pulled his strength. And right now, we also haven't seen Democratic leadership in Congress come out really strongly saying that he needs to step aside either. I actually think those leaders are going to be key to watch. I think it'll be really hard to get him to step aside at this point. That was one of the clearest things to me from last night. He said he wouldn't even step aside if he was presented with polling showing that Harris had a better likelihood of beating Donald Trump. He said he would only do it if he thought he personally had no chance of beating Donald Trump, and he didn't see that in the polls just yet. We did see reporting yesterday, NBC News was reporting that some within his own campaign were starting to say that they didn't see a path forward. That was a new development because it shows that, starting to get closer to that inner circle.
Right.
They have doubts, but that core group, you're right, they're not wavering.
They were like Pluto. And then there's, Mars and Venus, there's the inner circle, and then there's I don't know who they're talking about that they got for that. I never know. There's one other thing I wanted to say. All right, very good. Yeah, at this point, he seems like he's dug in, and that's probably not great news for Democrats at this point. If the eventual outcome is a different candidate. Oh, I know what I was going to say. Came back to it.
Was that done for effect, or is that truly?
ABC Ipsos, tied. Tell me that didn't after the debate. Trump versus Biden. I guarantee you that emboldened his people and probably the president himself that this is still a winnable contest for him. He probably thinks after that poll. Thanks, Megan.
Absolutely. That really reinforces that confidence. And 51 people watched that debate, and we keep hearing you can't unsee that debate. We don't know how many millions yet watched last night, but I think there's a lot of concern among Democrats about how it would look to just bypass the candidate that was chosen in the primaries. They don't want that to backfire. So if the polls stay strong, millions of people watched him look strong last night, how can they really bypass him? That's one argument we're hearing.
They want to protect democracy, except with the way they pick their candidates, right? We so much for the voting.
Coming up, is a rate cut in September back on the table? We'll talk about yesterday's cooler than expected CPI report and get you ready for today's producer price data. The Wall Street Journal's Nick Timmeros joins us after the break. And later, signs that consumer spending is slowing. Matt Shea of the National Retail Federation joins us with a look at the latest retail monitor data. Squawk Box will be right back.
night's sleep. Our next guest's latest piece outlines how milder inflation numbers could open the door to a possible September rate cut. Joining us now, Nick Timmeros, Wall Street Journal chief economics correspondent. Nick, it's good to see you. Good morning.
Morning, Joe.
What's your count? How many friendly numbers do we have now on inflation after those tough ones at the beginning of the year?
Well, obviously the last two, you give them an A or an A plus. But I think the big reveal this week, Joe, isn't so much that we have to get straight A's anymore. It's that a couple of B's are actually okay, and that's because of what's happening in the labor market. And that's what makes this different from some of the optimism or expectations around a rate cut in the first quarter of the year, when it was really just being based on inflation being better, because now you do have the unemployment rate creeping up, obviously still at a historically low level at 4.1%. But better inflation with the unemployment rate going up, I think, is a different scenario from better inflation with the unemployment rate going down or staying, below 3.5% or something like that. So that's what's changed. Chair Powell in his testimony pivoted this week when you're focusing on both of your mandates again. To me, that's a real pivot as opposed to the kind of accidental or confusing fake pivot that we got at the end of last year. And so that was really the story this week, was that Chair Powell is focused again on achieving the soft landing, sees a bigger runway to do it, and is talking about a cooling in the labor market. He said that again and again. And so, that doesn't require tea leaf reading or whispering. He's saying it out loud.
Still maintains that we're in restrictive territory. Nick, do you think that the action in the NASDAQ causes anyone to really wonder how restrictive we are, or whether financial conditions are actually, able to shake off wherever we are on Fed funds right now? I mean, things are still pretty frothy in a lot of areas, not so much like you said, it is bifurcated, not so much in other areas, but we're still rocking and rolling with the NASDAQ.
Yeah, I think a lot of commentators probably put too much attention on the equity component of financial conditions. So they'll say, oh, well, the stock market went up, financial conditions eased. I don't think that's the way that a lot of people at the Fed are thinking about it. I mean, let's look at the housing market. You see mortgage rates now, yesterday they came down below 7%, but for most of this year and for the second half of last year, we were looking at a mortgage rate above 7%. And so you have to wonder, how is that actually stimulating any increased demand for housing, for construction? It's not. And so I think, these moves in the equity market matter over time, of course, because price setters and wage setters will make hiring and investment decisions based on them. But I don't think that's really looked at quite as much by the Fed as the way sometimes commentators hold it out.
Nick, last week the renewed emphasis on the unemployment picture struck me as well. Do you think the market is underpricing this risk that, he said there are two risks now. It's inflation as well as the jobs market. Do you think the market is underpricing in that, the 90+% pricing in of a rate cut in September and no rate cut beforehand? I mean, do you think if we have a tick higher, significant tick higher, that a rate cut could actually be sooner, or the path could be steeper or decline more quickly in terms of rates because of the employment picture?
It's certainly possible. I mean, it's hard to see how you change the pricing for the July meeting, just given, there's not going to be that much data. There's not another payroll report. I guess you do get a couple of unemployment claims readings. I think the big development for July will be on Monday when we hear from Chair Powell. He's speaking in Washington. And so that's really his last chance to set expectations around the July meeting. I think, the big debate is most likely to be at the July meeting over what are you going to do in September? How much do you set the table for a cut in September? They have been prizing their flexibility, so maybe they don't want to lock themselves in with changes to the FOMC statement that really put, September kind of really well pointing to September. But at the same time, you're starting to hear from some of the doves on the committee, Austin Goolsbee last night, for example, saying, look, this is what we wanted to see. Inflation's on a path to 2%. If you think that policy is restrictive, if you're seeing evidence of that, if you think that the elevated inflation you have right now reflects lagged, catch-up pricing on shelter and things like that, and if you think the labor market is no longer a source of inflation heat, then it does raise the question, what are you waiting for? And so I think that's kind of where the trick is going to be in July, is if you're saying, everything's okay to cut, well, why aren't you doing it now? What are you waiting to see? And so I think that's the big question right now.
Nick, when I hit up, I was going to take credit for Nikki Leaks, but when I hit it up, your Twitter account, on Google, your Twitter account does come up if you hit up Nikki Leaks, and then something about Nicki Minaj. So which is it you, or what's really happening? Who came up with it? Can I say I came up with that, or how long have you heard that?
You can take credit for it. I have no idea who came up with that.
It's really good. It's really good. You don't want to go to jail. I don't think he's out now, I think. All right, Nick. He's not very frivolous most of the time. He's very serious. Did you see that?
Well, look at what he covers.
Exactly. Nick Timrose, thanks. We always like having you on and getting. He's I think the Nick Whisperer.
Fed Whisperer.
It's pretty good. Yes. All right.
Silicon reaction to the president's press conference and the state of the Democratic Party. Jay Clayton, former SEC chair, will be our guest, and later the latest CPI data showing overall inflation is cooling, but things like auto insurance and certain food items, they're still running hot. National Retail Federation President CEO Matt Shea will join us to talk about the state of the consumer. We'll be right back.
Time now for today's Aflac trivia question. What year did the New York Stock Exchange officially begin trading? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. What year did the New York Stock Exchange officially begin trading? The answer, 1792.
Bank stocks moving on earnings released just a short time ago. Wells Fargo is down by 5.7%. It did beat expectations. EPS coming in at $1.33 a share. The street was looking for $1.29. Revenue also coming in better than expected at $20.69. Rising interest expenses, though, showed little signs of letting up, and that pinched net interest income. It was below $12 billion for the first time since 2022. Meantime, JP Morgan reporting an adjusted $4.40 a share. Revenues coming in at $50.99 billion, both better than expected. That stock, though, is down by 1.2%. The next big bank to report will be Citi at around 8 a.m. Eastern Time. The company expected to earn $1.39 a share on revenues of just over $20 billion.
Coming up, the president facing the press for the first time since that debate with former President Trump and pushing back on calls to drop out of the race. Former SEC Chair Jay Clayton is going to join us with his thoughts. Squawk Box will be right back.
Come and make it count.
The president facing the press for the first time since his debate with former President Trump. Biden pushing back on calls to drop out of the race.
But I think I'm the most qualified person to run for president. I beat him once, and I will beat him again.
And joining us now for his reaction is former SEC Chair Jay Clayton. He's a CNBC contributor. So since the debate, we saw a lot of teleprompter events, and we know that he considered that. We did see with Stephanopoulos, that was all off the cuff, theoretically, and you may or may not think of his performance there. But last night was extemporaneous, and maybe you disagreed. My thought was he held it together, was COVID, lucid, seemed knowledgeable on foreign policy, and was a far cry from the debate. I mean, there was you can snicker about Vice President Trump and Putin and Zelensky actually looked like he thought that was kind of funny. But in general, if you think that he's not there mentally at all, that's not what you saw last night.
No, but Joe, we've looked at this, and I think it is in the context of how would a corporation handle this, because it is a communications issue, and the issue is still on the table. Is he capable of being president of the United States? Last night, what is people who are reacting very positively to last night? I believe they're doing something that happens way too often, which is recency bias, confirmation bias.
Do you think Donald Trump could get through the board of directors of a corporation?
Do I think Donald Trump? I think Donald Trump could respond to questions.
No, respond. I'm asking you whether a corporate board would keep him as a CEO, given a lot of the stuff that's happening. I think that's a false equivalency.
No, I don't think it's a false equivalency because the context is the same. The context is the same. Are you able to go out and communicate and respond and express the issues in a way that you instill confidence in your constituency? Are you able to do that? That is a big job of the President of the United States. And he did fine last night. But if you look at the data points over the last 2 weeks,
okay,
it's not fine.
When the Democrats in all the different states were voting during the primaries, do you think that Joe Biden that we saw last night was different than the Joe Biden from 6 months ago or 8 months ago or 9 months? The Democrats fully knew that this was the guy. He looked the same to me. He said the same to me. They make my I get furious listening to the stuff that he said, but it was the same guy. Corporations are causing inflation, guns. It was all the same stuff.
Joe, I think you're making my point.
What is my point? Well, they should have thought about this before. Nothing's changed.
Nothing has changed except now you're under the spotlight of scrutiny. And everything he is saying, every time he appears, the test is much more rigorous than it was 6 months ago. These are real tests. Did he pass last night? Yeah. Did he fail in the debate? Did he fail? I thought he failed with George Stephanopoulos. I didn't come along. Look,
Didn't Democrats fail by rubber stamping him as the nominee?
I think
is it his fault or is it their fault?
I think the real question is,
and the media's fault
is were they rigorous enough? Did they think about this? And look, clearly they did not. Who was the winner last night? I think the Republican Party was the winner last night because this issue is still front and center, and in any crisis, it's going to be front and center as we go forward.
Okay, and you are fully aware of his ability to stay if he wants. But you, I think, at the same time, would give it 90% he's not the nominee? Is that where you are?
I'm at a very high percentage.
That he's not.
Again,
so how does that happen then?
Well,
God's not coming down. Let's you go tell him.
I would say we're on a trend to reality, and reality is going to catch up.
I just don't know what that looks like, considering his inner circle supposedly they're just as strident as he is about his plans to stay.
Well, look at how many members of Congress.
17 out of how many are there? And they're not even big. Jerry Nadler?
Some of them I know well.
You do?
And are people of substance and rigor.
Are they in districts where they might lose?
I don't think so.
That's not why they're doing it?
That's not why they're doing it. I don't think Jim Himes is worried about losing. Jim Himes is a deeply substantive, experienced guy, ranking member on the Intelligence Committee. There is no one I know who is more committed to the Democratic Party and to the betterment of the middle class.
If the debate hadn't happened, do you think he'd have a problem with 4 more years? He was fully on board with Biden. Why is he not now? Because the poll numbers went down.
Let me give these folks, the Democratic Party, who were painting with a broad brush.
Yeah.
I don't know how many of them had direct access on a substantive basis to the president in a time of what I would say is deep engagement.
Yeah. Well, I had no access to them, and we knew exactly what was happening. So,
but they were relying on their surrogates, right?
We knew. Why wouldn't they? All you got to do is watch the TV.
At this point, though, does this change the outcome of the ultimate race? I mean, the longer that Biden stays in, the more sort of wounded his campaign becomes, whether it be because of just the image problems or the fundraising issues that are happening as we speak, with donors just not boycotting, et cetera. And so, at a certain point, it wounds them if he stays in for longer and lets this, go on. So what do they gain? I mean, what will be gained?
What to watch for, okay? How much is the brand, the Democratic brand, not the Biden brand, but how much is the Democratic brand continuing to be damaged by this kind of scrutiny on the day-to-day basis? And if he has future gaffes or future problems, and people are going out and defending him when it's clear that that's not really where he is, that will greatly damage the brand.
You think the average American is going to say, I don't want to vote Democrat anymore because they hid him?
Yeah, I think people
like
do,
that will register.
The worst thing you can do to people is to lie to them. People do not like that. They're okay with having differences on policies. They're okay, but when you stand up and you say, you know what, again, in a corporation, everything's fine when you know it's not fine. That corporation loses its brand identity, loses its quality very quickly.
And you think they can move Kamala Harris out and put whomever they want in? You think that's and it's what month is it right now? Is it July?
If you wanted to do that, the best argument for doing it is we can't just anoint the next person. We have to have a democratic process.
Really, like the democratic process that they're totally ignoring by ousting Biden.
I don't know that you're ignoring a democratic process by ousting somebody who the public is telling you.
Almost every vote from the people that are in a position to give him the nomination. What do you mean it's not democratic?
I think you want him to stay in the race, Joe.
Wow.
Okay.
But also in a sense of fairness, I don't like watching.
No.
People that knew all along and now they're,
Well, to Melissa's point, let me tell you something that people in America know. We're living longer. I've lived through it. I've lived through it in the work environment. I've lived through it on people who are fading. And
Any lawyer decided he's got to go, and Nancy Pelosi decided they're 3 or 4 years older than him.
What I'm telling you about the American people, they recognize what's going on here. The American people are smart. They know exactly what's going on here.
Okay.
Thank CNBC and the National Retail Federation putting out the latest retail monitor showing some moderation of consumer spending in June. Real credit card spending based on data from Affinity Solutions shows that spending was up 0.5% last month, down from over 1% uptick in May. Joining us now with more on the report, Matt Shea, President and CEO of the National Retail Federation. Matt, great to have you with us. So what's the headline out of this report?
Well, Melissa, I think the headline is we're seeing more of the same. We see a resilient consumer. We see continued spending by consumers, but we see moderation. And that's what we've seen for the last several quarters, the last several reports. On a year-over-year basis, the numbers are still very good, averaging more than 3%, which is real growth, particularly when you think about the fact that in retail, general merchandise is mostly down, more than flat. It's down maybe several percentage points. So really the inflation in the economy is persistent and lingering on the services side. But on the goods side, even on food, it's mostly come down and flattened. So there's real growth in there, but it's moderated. And I think consumers are being much more deliberate. They're being more thoughtful. They're rotating out of various services categories and discretionary categories and moving increasingly into those essentials they need for the households.
Yeah, and that's what we heard from Pepsi yesterday in ConAgra. Pepsi was talking about, for instance, across incomes, consumers were just, becoming more thoughtful, getting more thoughtful about how they spend, and that sounds sort of like what you're talking about here. As we though see the unemployment rate start to tick higher, how do you think about this moderation and how quickly this moderation could accelerate?
Well, there's no question, Melissa, that the growth we've seen for the past 48 consecutive months now, since we came out of the pandemic-induced recession, has been driven by healthy employment and healthy wage gains. And we're seeing both of those moderate, although I think on the employment side, the moderation and the slight uptick in the unemployment rate has more to do with entrance into the workforce than because of layoffs, and it's taking a bit longer for people to become attached to the workforce. The JOLTS numbers are still pretty good. So I don't think there's a lot of concern there. Wages are slowing, but they're still running in excess of inflation, more than 3%. So I think that's all pretty good news. I think the real question is the one that the chairman of the Federal Reserve and colleagues get asked about when they're going to provide some relief on interest rates, because I think now what you're seeing consumers really express is the pain point of those long and variable legs on monetary policy, and it's starting to hit.
Right. In the Federation, Matt, I wonder if your members are starting to talk about the possibility of tariffs increasing under a Trump administration. Is that sort of coming to the forefront? I mean, a 10% across the board tariff on imports up to maybe 60 or more % on imports from China. That's hard to work around.
Yes, I think it's impossible to work around, Melissa, and it's a tax. It's a tax on the American people. It's a tax on consumers. And so, we've said before, we're going to say again, I think the studies all support this. It sounds good. It's populist politics, but it's terrible economics. It's horrible for households. It's highly regressive. There's no way to, as some political candidates have suggested, there's no way to increase tariffs to the point you could replace the income tax. It'd be devastating to the economy. So it's completely unworkable, but that doesn't mean we shouldn't be on guard for it, and we will be. We saw what almost happened in early 2017. There was a proposed border adjustment tax, which was a tariff by another name. And so this would be terrible for consumers. It already is. The Biden administration's kept billions of dollars in tariffs in place on consumer goods that serve no real strategic purpose whatsoever, don't do anything in terms of advancing bilateral relations and trade with China or our other trading partners, simply lead to escalations and increased costs. So we'll be watching for that, and it would absolutely be devastating to the economy and for consumers and for voters and American families.
Matt, great to speak with you. Thanks. Matt Shea.
Thanks, Melissa.
All right, coming up, a breakdown of bank results from this morning, plus the Paris Olympics will be the first games to take place since legal gambling became widespread in the U.S., how sports books are preparing, and what the gaming industry is expecting. We'll be right back.
We've got this. Major banks kicking off earnings today. We are awaiting Citigroup top of the hour. JP Morgan, Wells Fargo reported results earlier. Joining us now, McRae Sykes, Gabelli Funds Portfolio Manager. Matt, great to have you with us. Wells Fargo's down almost 6%.
Yeah.
Why?
So a couple things there. I think the top line, the NII came in a little lower than expectations at 11.9 versus 12.3 kind of estimate. So I think that was a disappointment. Number two, I think the street was looking for an increase in potential guidance from down 7 to 9%. They reiterated that the guidance will be at the low end, down 8 to 9%. So I think that was a disappointment. I think there's probably some conservatism in that, which we have seen. And then a little higher expenses, but partially that was due to kind of higher revenue from markets, so not unexpected. So when you put it all together and some expectations, plus the stock being up 20% year to date, it's not surprising it's down a little bit, but we still see good value there at 1.4 times.
Right, and that's really sort of the problem, if it's a problem, the run-up of the banks into this earnings season. There's so many expectations, revolving around, a potential trough in net interest income. There's expectations that capital requirements will be alleviated for a lot of the banks, and so there's a lot built in here. Right. For JP Morgan, though, why is that on the headline numbers? It looked fine.
Right.
Why is it down this morning, do you think?
Well, we'll have to see the guidance there too. And in the commentary, we've already seen, worries about interest rates and inflation, et cetera, global macro. It's just their conservatism. But, the ROTCE at 20%, just incredible. Great execution, great capital management, loans doing a little bit better as well. So, and investment banking up 46%. Markets, all these things were doing better than expected. So the execution's there, but at 2.3 times tangible, it's quite a premium valuation. And even Jamie Dimon has said, well, we're going to be reluctant to buy back shares here. So I think a lot of that good news is baked in. And as you say, that the run-up, kind of anticipated these results.
Right. In terms of rate cuts and the expectations, 90+%, chances of a rate cut in September.
Right.
And the path afterwards is a little bit uncertain, and some are saying that maybe we're not even pricing enough in later on. What is your sort of expectation for that? And do we need that backdrop in order for you to be as constructive as you are on some of these names?
Right. Well, the predictions around rate cuts has certainly been very volatile, and we seem to swing one way or the other. It does seem like, given the CPI print and all the economic news, that we're pretty baked in for September, and then we'll have to see. There's certain some political dynamics related to Fed policy, et cetera, towards the end of the year, as you can imagine. But what we saw at the beginning of the year, when we had anticipation of those rate cuts, we saw this kind of rotation of smaller regional banks that lifted off, and then it kind of retrenched. And then we saw the better performance by the big banks going forward. And yesterday we saw kind of a seismic shift there. So perhaps just given the relative performance, with the big banks up 20%, the little banks, smaller banks underperforming, but more dependent on the rate and normalized yield curve, that you could see some of that inflection point and change going forward. So I think that's something to watch. But again, I don't know how to predict interest rates, and never have. We try not to do that. We look at a bottoms-up fundamental research component. But certainly, lower interest rates going forward would be a benefit to the banks.
So basically, if I were to tell you today that there are more rate cuts to come and that the market's underpricing the number of rate cuts, you would say go to the region. I mean, the regionals would obviously benefit, as you pointed out, but should there be a shift, a reallocation more towards the regionals, and a name like a Bank of America would benefit greatly in terms of its book with a decline in rates?
Right, so there are a number of factors with lower rates. I think it would take some pressure just on the economy, help friction there. The outlook for reinvestment in terms of CRE, et cetera, so opening up capital markets, and then deposit costs, which have screamed up the last couple of years. That would take some pressure off of that. And so a normalized yield curve eventually is very good for banks, as opposed to this inverted one. And then the last component being, what do we do with individual credits? We know there's a great revaluation and refinancing that's going to go on, just given the decade we have of rates. So to the extent that you have to still go house to house, check out their CRE concentration, multifamily, et cetera. Right. So ultimately, it should be good for the banks, but you still have to do your work individually.
And just quickly, I want to touch on FTAI Aviation, because I thought this is really interesting.
Right.
Huge run up in the stock. It's an aerospace leasing company, so you wouldn't think that it'd be in your fund. But right. It does lease, so it's a transaction.
Right, so we have 80% of our concentration financial services, 20% we're allowed to use other things to put in there. FTAI was a closed-end fund run by Fortress, infrastructure investments. They've narrowed that focus to aviation, so traditional leasing business. So it's really an alternative investment firm. But they've had an impressive operating segment on this MRO business. It's taken off. It's 25 million of EBITDA. You know, they're hoping to do 500 million plus going forward. So that's been the catalyst behind the huge run up in the shares. It's been a bigger concentration of us just given the outperformance. So there's huge taxable gains in that just given what's happened. And so we're sort of managing that as we grow the fund.
Great. Great to see you, Mac. Thank you.
Thank you.
McRae Sykes.
Coming up, let the gambling. Hold on there. Hold on. Just take it easy. You leave it a second. There's cameras rolling, all kinds of stuff. Let the games begin with the Olympics just weeks away. And look at how sports gambling sites are preparing for what's usually a slow season in sports. Plus, Citigroup set to report the numbers and market reaction straight ahead. We'll be right back.
Make money.
More people than ever expected to bet on the Summer Olympics in Paris, fueled by the recent boom in U.S. Legal gambling. Sportsbooks are gearing up for a surge in wagers as the games approach. Joining us now is Patrick Risch, Director of the Sports Business Program at Washington University. And Pat, maybe you can just help me with normal odds making. I'm always in awe of how right and exactly where these odds are, how they're set, and it's amazing. How are they going to do that with every athlete competing at the Olympics? How do you get? Is it AI? Is it just the way the bets line up? Do you understand what I'm saying? How can we possibly pick a favorite when we have no idea?
I absolutely understand what you're saying, Joe, and I think the analytics people that help set the odds in Vegas would probably be in demand for any analytics team in professional sports. It is truly amazing. It's going to be tricky, right? And I think there's going to be opportunities for the wise guys, people that really know the markets of these different sports, whether it's gymnastics or swimming or whatever the case may be. There may be a unique opportunity where some of the bettors, they know the market better than the odds makers, and that's where real profitability occurs. But Joe, look, the Super Bowl betting this year was north of 25 billion. The March Madness betting was close to 3 billion. I'm going to be fascinated with increased legalization of statewide gambling. Where will that number be for the totality of the Olympics when it's all said and done? I would be impressed if it was even a third of March Madness, which would put it at about $1 billion. I don't know if it'll get there, but it is going to be bigger than it has been in the past.
Than it has been. And what will be the most popular events, do you think? What's most suitable? I guess soccer, things like that. We do that already.
I think men's basketball, you're going to see the most action just because there's greater familiarity with basketball. And it's not just betting on who's going to win, because many people believe the U.S. men will run away with it, as will the U.S. women. But you can see a lot of prop bets, these exotic bets. So, for example, Anthony Edwards, Ant-Man of the Minnesota Timberwolves, he scored 20 or more points. What's the over-under? So those kinds of exotic bets, I think you'll see not just in basketball, but you could see it in gymnastics and swimming. Will someone be over under a certain time? Will someone score above a 10 or above a 9 on the floor exercise in gymnastics? There's a lot of opportunities in terms of betting volume because of these exotic bets.
You saw the just shifting gears. You saw the judge's decision. We're back to trying to figure out exactly what a college athlete is. Is there such a thing anymore? I mean, on the one hand, the schools would make no money without the people that are actually generating the fan interest. But what's the line we need to walk now, Patrick? What did this judge? How does it change things?
Well, again, I mean, we all know which direction this is going. And I think, Joe, you and I are in the same boat, that we believe that these student athletes all along should have been compensated for their performance. And, where is that line? Because once they become employees, and forgive the pep that's scrambling in the background, once they become employees, Joe, what are the expectations going to be in terms of the number of hours that they could potentially be expected to work? What implications are there? I think that there's a lot of things that still need to be vetted, and obviously we're going to see how that plays out going forward.
Right. One of the provisions was got to be paid minimum wage. That'd be good for not for the athletes. It'd be good. I mean, I'm sure that everyone would certainly agree to pay. I mean, they make 100 times the minimum wage, or as what they're worth. How does that even apply? Some of these things, it just seems odd to even talk about it.
Joe, I think the craziest thing with what's happening, and I've talked to a lot of college athletic administrators, is that, clearly the schools like Ohio State, Michigan's, Alabama's, Georgia's, they're the biggest beneficiaries because they have the greatest revenues. You take these middle tier schools, like in St. Louis, we have St. Louis University, where I went to college, UNC Charlotte. These are the schools where there is so much poaching going on that I could only imagine how difficult it must be to be an athletic administrator at schools like this, where if a kid comes in and outperforms, that a place like St. Louis University, UNC Charlotte, recruits a kid that maybe outperforms, good luck keeping that kid beyond their freshman year, because you're going to have all these larger schools coaching them with their collectives and everything else. So I think that's the greatest challenge for these middle tier. And I wouldn't be surprised at some point if you see the separation between the very top 60 or 70 schools versus all the other schools in Division I.
It's left the barn, though. I don't know. The toothpaste is out of the. What's your favorite?
I don't expect it to change. I think that there'll be even more change. Again, you could see the siphoning.
We're ahead of that. We're not going back. All right, I guess Citigroup is out. Everything stops, Patrick. Everything stops because Citigroup is out. Thank you. Let's hit picker. This better be good.
It's pretty good. I see a slight top-line beat for Citi of $20.7 billion in revenue. Net income, $3.2 billion, up about 10% from last year, and the firm reported EPS of $1.52 per share. Shares currently down about 1.42% on this release. Expenses down 2%. Then that's despite the $136 million fines, if you guys recall, announced earlier this week by the Fed and the OCC over internal controls. The savings, though, did come from the org simplification and stranded costs related to recent divestitures. Within Citi's 5 businesses, I want to highlight markets here. At the firm's investor day last month, CFO Mark Mason said revenue would be down in that division, but business has clearly been strong over the last few weeks of the quarter because markets revenue was actually up 6% thanks to equities. The firm also clocked a $400 million gain to that Visa stake restructuring that we saw with JP Morgan earlier this morning. Banking jumped 38% to $1.6 billion thanks largely to debt capital markets as the IPO market remains muted, and wealth up 2%. That's a closely watched division that's undergone a shakeup under the newish, he's been there about 10 months or so, head Andy Sieg. Services personal banking also saw revenue higher in the quarter. CEO Jane Fraser saying in the release that the firm has made a, quote, incredible amount of progress in simplification, both strategically and organizationally. She said Citi will continue to execute our transformation and our strategy so we can meet our medium-term targets and continue to further improve our returns over time. Citi's saying in 2022 that it would achieve a return on tangible equity of 11 to 12% in the following 3 years. So we'll hear more from Citi when I sit down with CFO Mark Mason, live from Citi's headquarters. You can catch that interview this afternoon on the Exchange, guys.
They're in the middle of one of the biggest restructurings and turnarounds ever that anyone's ever tried to do.
Yeah.
Do we just take her word for it that it's progressing as planned? People have, they're skeptical it can even be done with something that size.
There's a lot of skepticism out there. There's a lot of bullishness, though, too. I mean, the stock has performed really well over the last year. And the fact that you do see some significant cost savings already due to that org simplification in this morning's earnings release says something. And in the statement, she's reiterating their medium-term targets that were set out in 2022.
Which means there's long-term targets.
So
it's going to take a long time to get this.
This is a very, very difficult task. It's something that I think a lot of people have been burned by Citi in the past.
Too. There's like 10 things she's trying to do.
But the macro backdrop for banks overall is a positive one, and has turned positive as the year has gone on. So if you pair that with the booster of the restructuring story, that's the case. That's a bull case for Citi.
What's book? Right now, does it say?
Let me pull book for you.
99.
It's below book
2%
versus 2 times book.
I see 85.34.
So that's still a reflection of
in real time.
How far they still want to.
Book value per share 99.70.
99, selling at 60, 66. Should be a buy.
Oh, sorry. I see tangible book is 85.34.
85.
Book value is 97.87.
Okay.
Just to clarify.
That's definitely as much as I need to know about Citigroup what you just did, though.
Perfect.
It's the perfect amount.
Perfect.
The perfect amount, not too much, not like a Goldilocks.
Goldilocks.
A Goldilocks amount that you gave us. Let's look at the futures right now. 49 points. The NASDAQ is actually now positive after yesterday down almost 3%. What was it? 2%.
2%.
2%. 300 points, 2%. There's the Treasuries, 4.21%. PPI is coming in about 25 minutes.
Yep. Now, for more on the broader markets, let's get to Mike Santoli at the NYSE. Mike.
Yes, and Melissa, when we talk about the broader markets, you really have to be specific about what we're discussing when it comes to yesterday's action. The S&P 500 looks like no big deal. We got a good CPI number, a little bit of a sell the news in the mega cap growth stocks that have been supporting this market. Market has been craving permission to sort of assume that inflation is in the sort of mission accomplished column, maybe not quite there. But what you see here is that 0.9% decline off of an all-time high. I keep pointing out that the angle of ascent has basically kind of resumed from where we were in the first part of the year off that October low. So that sort of still remains a pretty solid trend. Now, what happened internally is massive underperformance of the winners versus the recent laggards. Take a look at the Russell 2000 versus the NASDAQ 100. Now, this was a 5.5 or 6 percentage point spread. Russell 2000 outperforming the NASDAQ 100 yesterday, but this is the trend it's coming off of. So it's been kind of falling off this cliff for a while, about 40 percentage points of underperformance from, about a year and a half ago. And here you got that 4%, outperformance, or 5.5% outperformance yesterday. Now, this is the kind of thing you've only ever seen in magnitude around major market lows when the overall market was super oversold and very volatile. So it's hard to know whether you can project ahead here, but clearly positioning was such that it was way against small caps and way for Mag 7, and you had a big reversal. So the volatility index doesn't look like much. It definitely seems like a floor building around that 12 level, but it was up even yesterday, or the day before yesterday on an up day. So it shows you when Mag 7 is not leading, the market's in a little bit less of a secure place, and maybe volatility could go up one way or the other, guys.
All right, Mike, thanks. Mike Santoli. Coming up, THL partner Scott Sperling joins us live on set to talk private equity, inflation, and the economy. Squawk Box, we'll be right back.
You got this.
Moving on now, we're standing by for the producer price index. It comes out at 8:30 Eastern time. Yesterday, CPI printed negative. Joining us now on the economy, private equity, and more, Scott Sperling, co-CEO of THL Partners. Last time that you were here, I didn't know whether you were buying or selling, or I think you were doing a little bit both on an individual.
We've been doing a lot of selling over the course of the last few years. We have been trying to buy, but frustrated at valuations. And I think that's not an atypical story for folks in our industry. When I talk to my friends who run other private equity firms, I think we're all a little bit frustrated by the disconnect still between valuation and what you think the long-term value of an asset would be.
And that is a reflection of cheap money formerly?
I think it's a reflection of people. There's a lot of money out there in almost every aspect of the financial market, as we know. And there are people making decisions about either long-term exit multiples that may be somewhat different than where some of us are. I think there are many of us who are in the rates aren't ridiculously high at all, but there will be cuts, but it's still going to be higher longer for lots of very fundamental reasons that we've talked about and I'm happy to go into, and therefore multiples should reflect that.
The money has been generated organically from productivity and corporate earnings and a good economy, or is it still?
I think in private equity, the outperformance over almost any period generally for the private equity industry has been quite strong. So I think there's a rational amount of money being put into private equity, and I think returns will continue to be better than in other asset classes. I think right now there is a movement to try to buy the very best business models and the so-called great companies, and the premium put on that may or may not be appropriate. I think for some of us, we think it may be inappropriate, but we'll see in a few years.
Do you think your business could be better if there was less regulation, less antitrust issues, more energy development? You see where I'm going?
Yeah,
you see where I'm going with this? Do you care about the election? Could it be better for you, or is it good now?
I think it's certainly
good now.
Better. It's
It
certainly
could be better.
If we had a regulatory environment that was less cumbersome, and where the ability of the regulators was within the bounds of what we have historically thought they should be. So particularly antitrust is an area that I think is important to people in our industry, but more broadly as well. I think the entire regulatory burden on the economy seems quite high when you look at it. Certainly being able to reduce the cost of energy is a big positive for all consumers. And that's something that
10% tariffs, more tariffs. That would be bad from the orange guy. When you hear,
we have to see what actually happens.
Okay.
I mean,
last night,
targeted tariffs.
The head of the country say,
yes,
corporations have doubled their profits. They're the ones that cause inflation.
So
when you hear that, does it bother you? Does it matter? Does it matter?
Well, we know that's not true.
We know it's not true, but does it matter? You have the guy.
I think it's somewhat problematic, but not unexpected in a very heated election, particularly one where there's an even bigger difference between where one party has centered and where the other party has centered. And those centerings are not necessarily in the center. So you're hearing more extreme commentary from each side. And I think the answer hopefully will tend to be more in the middle, and particularly as one thinks about the set of policies, I think the observation that Trump will talk to a set of policies that directionally will go in, but not to the magnitude that he may state.
Are you planning on a Trump presidency?
Well, the betting odds are clearly that. I think it's a lifetime, as they say, between now and the election.
Yeah.
Lots of things can happen, including uncertainty about who his opponent might be. I would have to believe at this point Biden's still the odds-on favorite to be the Democratic nominee, but obviously there is growing concern in the party, concern being a nice word, that he may not be capable of doing the job
but
or winning the election.
He won't do unrealized gains. But he talks about it, but he probably won't.
Well,
he won't do 50% capital gains, even though they 46, whatever. That won't happen either.
Over time, we'll have to see where that goes. Obviously, we are running huge deficits, which long term will have a big impact on our ability to manage interest rates down, because that takes on a life of its own away from the Fed. When you have to finance tens of trillions of dollars of government debt, you tend to have to pay a lot more for that. So that can have a big impact there. I think when you look at overall, the reason we're running these huge deficits is obviously government spending has been a bigger and bigger part of the economy. When you look on the revenue side, even with the so-called tax cuts that occurred, revenue is not diminished significantly from where it normally is. It's the nature of the spending. If you compare 2019 to where we are for the next fiscal year, you have to ask yourselves, yeah, I understand why we spent a lot of money, trillions of dollars, during that pandemic. That was probably a good thing to do. Maybe did some things we shouldn't have done, but probably a pretty good thing. Why is the level of government spending now still growing from that level as opposed to return to where it was, with capital being more efficiently deployed in the private sector?
Leisman, there's some term that begins with an H for why. The amount you spend on a crisis, you never stop. Once you get it going, it's like you did it, so let's keep doing it.
That's the new baseline. Now, look, we have a major energy transition that's going to cost in the trillions of dollars when you run through that. We have defense spending that, by almost every commentary coming out of the NATO summit, is inadequate for in the U.S. as well as in other parts of the world. So there's already other pressures, and the amount of money we're spending for interest rate payments as a government have also grown enormously. So, now, flip side, lots of great technologies being developed, both on the IT side and the healthcare side. There you go.
Thanks.
You're welcome.
And we'll continue this conversation again, hopefully soon. Are you buying the Celtics? What are you doing?
I'm a Knicks fan, remember?
I'm sorry. No, they're better.
Coming up, a can't-miss exclusive interview with former Activision Blizzard CEO Bobby Kotick, live from Allen & Company's Sun Valley Conference. Squawk Box will be right back.
world.
Allen Company's media conference is in full swing in Sun Valley, Idaho. Let's get to Julia Borson, who joins us with a special guest. Julia.
Thanks, Melissa. I'm joined now by Bobby Kotick, former CEO of Activision Blizzard, now focused on a number of philanthropic ventures. Bobby, AI is a huge topic here in Sun Valley, and all of your not-for-profit work kind of comes back to this idea of AI and how AI can be used as a tool to drive change in this economy. What are you working on right now?
So it's really exciting if you see the amount of progress that's taking place from a lot of the new tools in AI. And large language models are really uniquely suited for certain kinds of work. So if you think about education, especially K through 12 education, right now we have 2 generations of failed public school education for a variety of reasons. But if you can actually give kids the opportunity to learn in a way that is appropriate for the way they learn. So if you're a visual learner and we can assess that, test it, and then provide you with a visual learning experience on the core curriculum that you really need to know, AI tools are uniquely suited for doing that. If you're an auditory learner, we can change it. If you look at somebody like Sal Khan at Khan Academy, he's probably the most forward-thinking person in figuring out how to use AI. And one of the things I like about Sal's model is it's not limited to a school. He goes direct to the kid or direct to the family. And so I think you're going to see lots of opportunities to have direct-to-kid opportunities for the way we change how you learn.
For the past 10 years, you've also been very focused on veterans employment. And when it comes to employment and concerns about employment in this country, there's a lot of concern that AI is going to be taking jobs away and sort of replacing a whole swath of workers. Are you concerned about AI having a negative impact on the workforce?
No, in fact, I think it will be the exact opposite. I think what you'll be able to do, and it goes back to what I just said about K through 12, the way that you do assessment and training will change dramatically. And my employment focus is for veterans. And if you think about the population of veterans today that's able, capable, and unemployed, there's something like 300,000 to 400,000 able, capable, unemployed veterans, all of whom have skill training opportunities for new categories of employment. And so AI, I think, is going to be a really important way for us to train, educate, and develop new skills that are going to be necessary for the economy that aren't necessarily taught in the military.
Well, a nice optimistic note about AI providing jobs instead of taking them away. You have a new venture that you're working on, or I should say a new philanthropic venture you're working on, the Center for Government Accountability. You haven't announced this yet. What is it? Tell us what this new initiative is.
So if you look out over the last, let's say, 15 to 20 years, one of the things that's happened is you've had an increase in corruption in government, municipal government, state government, federal government. But the tools to be able to actually identify things that then give you, in law enforcement, the ability to prosecute those corrupt public officials have actually weakened. And one of the benefits of AI is that you'll be able to do things. I'll give you a great example. FOIA requests, Freedom of Information requests, that are important for your work, or Public Records Act requests. The automation of that process, the ability to actually synthesize all of what you gain in a Freedom of Information Act request or a Public Records Act request can be automated through AI, and you can then provide district attorneys, attorney generals, even the DOJ with access to tools and technology that they won't be able to easily get on their own.
So you're going to be working to provide those tools, and how quickly will that launch?
Well, we want the tools to be robust, so it's going to take some time, but I think, when you look at law enforcement, you look at the district attorneys, attorney generals, they don't have the money to be able to get access to the very best AI talent or the very best custom AI tools, but they need it.
When it comes to the government and accountability, sort of more broadly, you've been pushing for reciprocal trade with China, saying that if they limit the way that video games or social media is distributed in China, you want reciprocal trade agreements for what's happening here in the U.S. The president spoke about this last night. What is your perspective on the reciprocal trade situation now, and what should happen with China, especially given there was a big panel here on China, which Secretary Raimondo spoke on yesterday?
So I think the Secretary has actually been leading the charge on this within the government. But if you think about singling out a single company like ByteDance, that's not the most effective way for us to think about trade with China. You know, we have an enormous amount of trade with China, and right now the rules and regulations don't allow U.S. companies to operate without being in a joint venture that's usually owned and controlled by a Chinese company. The government in China will have the choice. You know, for example, Tesla can operate in China on its own. I think if we had a reciprocal trade framework whereby an industry that was required to be in a joint venture in China, that industry, the Chinese companies that participate in that industry were required to be in joint ventures in the U.S., many of those technology-related industries could have information security requirements, security clearances, but it would give you the opportunity to create hundreds of thousands of jobs, billions of dollars of value, and allow the Chinese company to know that they were operating with a partner that would provide the same information security that they're required to provide for American companies in China.
And so do you feel like the government is moving in that direction, or what's the chance of that happening?
Well, if you think about it, the president last night was largely focused on NATO, but he actually specifically brought up reciprocal trade and the need for this reciprocal trade framework. Leader Schumer has been focused on it. You know, you had a bipartisan committee led by Mike Gallagher that was focused on reciprocal trade. So I actually think you're likely to see it's probably the most bipartisan piece of legislation that's being discussed right now in the government.
Yeah, and speaking of the president, there's a huge focus here on this coming presidential election. Looking big picture at the administration, and you're talking about all the different pieces of this, what kind of administration do you think would be best suited for economic growth and for businesses like the one you recently sold to Microsoft?
Well, you know, you think about the federal government, it's the largest, most complex organization in the world, and you know, the people who are running it should be the most sophisticated, capable people who know how to run large, complex organizations.
Well, that was a very brief answer. I'm guessing you don't want to be naming any names here.
No, that's not something that I spend a lot of time.
So then I have to ask you a quick question. It's reported that you're interested in buying TikTok. Speaking of ByteDance, are you interested in buying TikTok?
I read that too. I'm more interested in making sure we have a reciprocal trade framework with China.
Yes or no on TikTok? Will we see Bobby Kotick as the future CEO of TikTok down the line?
Right now, you're going to see me focused on making sure we have the reciprocal trade framework in China, and I don't think singling out a single company is a good idea.
Okay, well, we'll leave it there. Bobby Kotick, former CEO of Activision Blizzard, now working on all these AI-driven philanthropic endeavors. Back over to you guys.
You tried, Julia. We appreciate that. Thank you, Julia Borson with Bobby Kotick. We're just about 45 seconds away from June producer price inflation data. As we await those numbers, take a look at futures and how we are setting up after yesterday's sort of redistribution within the markets from big cap technology to some of the other players and sectors in the market which had not participated in the year's run. S&P 500 up by 2 points. NASDAQ down by 13 right now. Treasury yields, the 10-year note at 4.2%. We did go down about 7 basis points yesterday after yesterday's CPI report in the 2-year at 4.49. Rick Santelli is standing by at the CME in Chicago. Rick.
Yes, we're awaiting the PPI, the wholesale side of the inflation equation. Of course, these are June numbers. They will be coming out in a few seconds. Do want to point out, 2-year note yesterday closed at the lowest yield since March 8th. 10-year notes closed at the lowest yield since March 28th. All right, headline PPI for June up 0.2%. That follows at least up to now an unrevised down 0.2, up 0.2. Well, it's only the highest since April when it was up 0.5%. If we strip out food and energy, it's hot, up 0.4, double expectations. Last month was unchanged, up 0.4, also just the highest since April when it was up 0.5%. If we look at ex-food, energy, and trade, this one comes in under. Unchanged. We're expecting a number up 0.2. In the rearview mirror, unchanged now becomes up 0.2. Revisions are coming in. I'll go back over those. If we look at year-over-year final demand, that's coming in at 2.6. Definitely hotter than a 2.3 expected. In the rearview mirror, at least up to now, 2.2. 2.6 is the warmest since March of 23, over a year. If we look at ex-food and energy year over year, 3%. That's a 0.5% hotter than expectations. Follows 2.3, and 3% is the warmest. And I have to go back a bit here to April of last year when it was 3.1. And finally, year over year, ex-food, energy, and trade, 3.1, following 3.2. 3.1 would be the warmest only since April when it was 3.2. Now, we have revisions coming across everything. Let's go over those. On headline, last month's -0.2 moves up to unchanged. Strip out food and energy, last month was unchanged, moved up to 0.3. If you stripped out food, energy, and trade, that was unchanged. That now becomes up 0.2. The years over year, headline, 2.2 becomes 2.4. Ex-food and energy from 2.3 to 2.6. Ex-food, energy, and trade moves from 3.2 to 3.3. So universally, every category, all 6, last month getting revised higher, and everything but 1 is higher than expected for this month. Yields haven't moved up as much as I would have gleaned because PPI never has the impact when it comes in second on the calendar of events post CPI. But we are seeing a 422.9, 423-ish in 10s, and they were at 420 before the number, and 453, 452.5 now, and before the number that was 449. So several basis points higher. Once again, you want to keep in mind 460 for a 2-year and 4.25 for a 10-year on important pivots for closing the week. Joe, it's a long, big long line of numbers and big revisions. Sorry it took so long. Back to you.
No, yeah, that's we'll see. Look, we're going to dig into after the break, dig deeper into this new inflation data and whether it in any way undermines the narrative that we have from yesterday and the CPI, what it could all mean for the Fed. And then market watcher Jeremy Seal from Wharton School will join us. Stay tuned, you're watching Squawk Box on CNBC.
June producer prices coming in hotter than expected. To talk more about this week's new inflation data, let's bring in Jennifer Harris, Director of the Economy and Society Initiative at the Hewlett Foundation, as well as a former National Economic Council senior official, and E.J. Antony, economist at the Heritage Foundation. So not only was the print for June hotter than expected, but the revisions for the prior month were also hotter. So Jennifer, how do you think this impacts at all the Fed's thinking about a cut in September?
I think it's worth putting today's numbers next to yesterday's CPI numbers, which came in cooler than expected. And I think probably we'll see core PCE still shake out somewhere in the neighborhood of where it has been year over year, which is about 2.5%, which is still looking at somewhere in the neighborhood of 250 to 300 basis points of restricted territory for the Fed. So I'm less fussed about whether today's numbers come in slightly hotter than expected, especially given yesterday's numbers, and more focused on the bigger picture, which is the Fed has a whole lot of cutting to do, and quickly, especially given the recent unemployment uptick to now 4.1% or so. We're not near the technical alarm bells, but we're close, and I think we're close enough that the Fed needs to switch quickly into a risk mitigation posture, and certainly that would need to start no later than a September cut.
EJ, you agree with Jennifer?
No, not at all. The last thing we need to do right now is cut rates. We still don't have inflation under control. A key reason why we had a soft CPI print was the fact that we have had money moving out of bank reserves and moving into reverse repurchase agreements. And what that has done is essentially help slam the brakes on consumer credit for a couple of months, and that's decreased demand. And we saw that in the latest CPI print. But that whole process has been reversing now. The money was never actually extinguished. It was essentially just kept sterilized. But as that money moves out of reverse repos and back into bank reserves, it's going to multiply. It's going to continue to build inflationary pressure. There is still too much money in this economy. The Fed has done nowhere near enough to get this under control.
You don't think we're in restrictive territory as it is, EJ? And you're not worried about the uptick in employment? I mean, that's Fed Chair Powell clearly stated last week that there are two risks here, inflation as well as a jobs picture, that they are worried about.
Of course, there are lots of risks within this economy, but much of that comes from the fact that the government continues to crowd out the private sector. And as long as that happens, you're going to have fiscal and monetary policy at loggerheads, and you're just making it that much more difficult for the Fed to make progress on inflation and to get us back towards price stability.
Yeah, Jennifer, I guess the fiscal and monetary going head to head is sort of a difficult dynamic that the Fed can't do anything about right now. They can do what they can do, but whatever happens, in the halls of Congress happens in the halls of Congress, and there's not much they can do to fight the inflationary effects of, say, the Inflation Reduction Act.
I'll take the other side of this one. Okay. For most of, probably both of our professional lifetimes, we've had the Fed asking fiscal policy to move. You don't get to choose your political windows in Washington, and guess what? This administration has, seen the largest set of public investments into our backbone infrastructure, energy, physical infrastructure, building roads, transport routes, and our kind of technology backbone. And so fiscal policy has moved, and I would argue that it's actually the job of the Fed to lean into that, especially when a lot of the current drivers of the inflationary bout we've had, I'm thinking especially of housing and of oil and gas, are contemplated in these public investments, or at least energy is, in the sense of moving to a set of cleaner energy sources for the grid that not for nothing don't have the kind of inflationary channels that oil and gas do. We have a moment in the IRA and in the other public investments that we've had to sever some of these traditional channels for inflation, and I think it's the job of the Fed to inhabit at least a medium-term view and see those investments through. Not asking them to get woke on climate. I'm asking them to inhabit their mandate for price stability and make a set of investments, or at least not harm a set of investments that are underway thanks to fiscal policy, and that will lend towards price stabilization over time. And what's really unhelpful for more housing? 5.5% interest rates that are putting mortgages where they are. So if anything, the Fed's current posture is actively worsening a lot of the existing drivers of inflation. And I think that gives rise to a lot, some larger questions about whether for these more supply side drivers of inflation, interest rates are the right tool.
EJ, do you think renewables eventually become helpful towards inflation with what they cost now, and the amount of money we spend subsidizing the transition with getting very little in return, because we still, I think it's 1% less fossil fuels that the world uses now after 20 years and trillions of dollars. Is that really going to stabilize inflation, the transition?
No, not at all. Look, solar and wind may very well one day be our main source of energy, but they simply can't today. They're net losers. And so if you look at things like the IRA, by the way, not only are they helping to strangle reliable sources of cheap energy like coal, oil, and natural gas, but on top of that, they're funneling more scarce resources into solar and wind, which again are net losers. And I just don't understand why we're talking about the IRA and building infrastructure. The IRA has literally more money going towards ripping up existing roads and bridges than building new ones. It's not helping to build new infrastructure. It's helping to destroy infrastructure we already have. It's spending billions of dollars to build literally a handful, that's not an exaggeration, a handful of EV charging stations. Look, at the end of the day, I frankly don't know what inhabiting a mandate for the Fed even means. What I do know is that the Fed's hands are tied here because the government is spending trillions of dollars it doesn't have. I mean, my goodness, look at the data we got yesterday for the the Treasury's monthly statement for the month of June, where we spent $140 billion just in interest on the debt. That's not paying it down. That's just the interest.
We gotta leave it there, guys. Thank you, Jennifer and EJ.
All right, coming up, the Wharton School's Professor Jeremy Siegel joins us on this week's inflation data and signs of a new market rotation, which he predicted and we did see yesterday. Don't go anywhere. Squawk Box will be right back.
Peacock.
AT&T this morning revealing a big data breach. The company says data from 109 million accounts was illegally downloaded in April. That includes records of calls and texts from almost all of AT&T's cellular customers during a period in 2022. Though the company says the content of the calls and texts wasn't disclosed and neither was personal information like social security numbers, AT&T says the FBI is investigating the breach and at least one person has been arrested after call logs were copied from a third-party platform hosted by Snowflake. Shares of Snowflake are lower on this news.
The June PPI coming in above, hotter than expected, after yesterday's negative CPI print. Joining us now on the markets is Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, Chief Economist at WisdomTree. Jeremy, Professor, it's good to see you. You said that we won't see a rotation into small stocks and value stocks until it becomes clear the Fed's going to cut, and that the CPI, you said this before it came out, could be a game changer. That's exactly what happened. You saw what happened with the Russell yesterday. Now, what is this? 3 steps forward, 2 steps back? What did the PPI say to you?
Well, I think it's 4 steps forward and maybe 1 step back. There's a few components here that do go into the PCE, and it's going to take a little while to suss that out. But I think that the CPI was a game changer. And yeah, I mean, it was last Friday for Scott Wapner closing bell that exactly what I said. And I think the Fed should definitely cut. I mean, not only was it great inflation news on the CPI, which is far more important than the PPI, but let's look at jobless claims. Now, jobless claims were good this week, but don't forget they reported the week of July 4th, which, is always distorted. I'm really looking at it next week because we've been on an upward trend, not only on claims, we've been on an upward trend on the unemployment rate. When we hit 4.1%, we hit the so-called Psalm rule, which says that if the 3-month moving average goes up 0.5%, which it did on the last labor report, the probability of recession is very high. Now, I'm not calling for recession, but I'm saying that is on the Fed's radar. So I'm looking at that. I think he's teeing up a cut. I'm just hoping that he'll cut fast enough that he won't go too slow on the way down, the way we know he went far too slow on the way up. So my concern is not that he's going to, cut too much, but he might cut too slowly. But the data will tell us what the judgment is.
You don't think before September?
No, unless we get a big deterioration. I mean, I'm trying to think that July 31st is the meeting. So we get maybe 1, 2 jobless claims, no other really important indicators. So, no, he's far too deliberate. But it'll be a tee-up, I think, saying we now see the conditions in place for a cut if the data continue to move in the direction that we are seeing at the current time. Of course, the cut is expected to be 25 basis points, but, there's 6 weeks until that next meeting, and we'll see whether he is compelled to do more at that time. But that's my expectation for the July 31st meeting.
So not just inflation, but suddenly what we're seeing in the labor market.
Because it looks like this half is going at less than 2%.
Yeah.
We were originally excited about, last year way above expectations. The Fed expected over 2% for 2024. Well, the first half looks like under 2%, and that's below Fed target. So there's many reasons. He himself said, we're not going down to 2, waiting for the CPI to go down to 2 before we cut. That's far too late. What was really encouraging, finally, that rental component, which I've talked about so often, is so lagged in the CPI, finally started coming in lower. And hopefully that'll continue to happen in coming months to keep that CPI rate in line.
So the other mandate's not just as important. It used to be inflation. Now you got to look at both. And the claims number is one way to see it every week. The rotation we saw yesterday,
Does that continue? You think the NASDAQ is ready for a breather? Do you think you're going to see a move into this? The breadth will improve. Smaller company stocks will go up. Value will go up. Now that was the beginning of something yesterday.
And the reason is that small firms are so much more sensitive to the short-term interest rate, which the Fed sets. It used to be called LIBOR, now it's called SOFR. They pay the short rate plus 200 basis points, and all their inventories, a lot of their borrowings are due to that. A lot of the big companies, either pay through equity or fixed in long rates long time ago. Those firms are going to be the most helped by lowering interest rates of the Fed, and I think that's what stock pickers saw yesterday. And unless we get some bad news to the contrary on inflation or too fast an economy, that it could be that yesterday marks a shift finally in the big tech stocks versus the rest of the market. I mean, I've never seen anything with 400 stocks go up in the S&P and the S&P goes down. That's something that you don't see very often, if ever.
That's true. All right, Professor, thanks, and we'll check back in not too far time. It's a good call you made with the judge, and thanks for coming on today. Let's see you.
Thank you very much, Joe.
Okay.
Coming up, a top analyst joins us on Apple, which earlier this week regained the title of the world's most valuable company. Squawk Box, be right back. Apple ended yesterday in the red as the Nasdaq had its worst day since the end of April. But prior to that, Apple shares had been up 11 of the previous 12 sessions. Our next guest just raised his price target to $256 a share from $230. Let's welcome Wamsi Mohan, Bank of America Securities Senior IT Hardware Analyst. Wamsi, great to have you with us. Part of this price target raise yesterday was the notion that people have old phones and that they're more likely to upgrade because of AI. And I'm wondering how much of it is just the fact that, you know, whatever it is, 39% or so have an Apple 11 or older, me included, and how much of it is people wanting to get the latest to get the AI features.
Yeah, good morning, Melissa. Thanks for having me on. Look, I just think that it's really interesting. Our survey work shows that after WWDC, the purchase intentions of buying an iPhone in 2024 went up meaningfully. What that tells you is that people were looking for a real reason to upgrade, and you got it through the fact that you now have generative AI coming to the iPhone, but not just that. You also have the cutoff of like upgrades, which is different from what other people have done, right? Like Samsung hasn't instituted this same kind of cutoff at an iPhone 15 Pro Max or at a Pro version. And so it's really giving impetus, not just for the typical cadence of upgrades where the install base is really aged, but also for the newer phone users beyond sort of just before the 15, the 14s and the 13s to actually upgrade a little bit more atypically. So there's a cyclical benefit and a component over here that we're picking up in our survey work, which I think is really interesting to drive upside to both 24 and 25 iPhones.
So do you think that people will choose, you know, if I'm at 11 right now, obviously I'm not really focused on the latest and greatest technologies because I'm willing to live with the phone that I have. But are you getting the sense that people are willing to trade to the highest level to get that AI upgrade? Because I think that changes the cadence, right, of how much revenue you actually build in because of this upgrade cycle.
Yeah, absolutely. The mix is going to be super important. Melissa, like the real interesting thing about the mix is that there is this misconception that the Pro and the Pro Max are only relevant in developed markets and emerging markets. They tend to gravitate to the lower versions of the phones. Our conversations with the company and our own survey work shows that the Pro and Pro Max have been gaining share ever since 2021, right? So from COVID levels, when people were guessing that, oh, this is all because of stimulus checks, that mix is sustained to be very, very strong now. 3 years post that, right? So it shows that people want the feature functionality. And so the more you offer them at the higher end, the more you're going to get that mix shift continue to be a positive driver for Apple. We actually think that there is a possibility that Apple introduces an Ultra model going into next year, so at the iPhone 17, which would be even higher than the Pro Max level. And that could be, when generative AI comes around, like the DRAM content becomes, really, really relevant. And so you could offer an Ultra model with increased DRAM content, which would be sort of the more powerful Gen AI phone that would be for Ultra Pro users, so to speak. So we actually see the mix not being an issue at all. We actually think it's going to be a positive tailwind for the company.
All right, Wams, you got to leave it there. Thank you so much.
Thanks for having me.
Final check on the markets. The NASDAQ is getting back now. Some of those losses from yesterday. Now the Dow. Actually, as well. Actually, I was looking at the futures themselves. Just a little bit for the NASDAQ. Dow is now a turn higher. After all those bank earnings, was that the highlight?
Wells is still down 5%.
Was that the highlight
JP
of
Morgan's
your
kind of
day,
flat.
did you say? Or just being here?
Being here.
And the banks.
With the banks. What a combination.
It was a slice. It was a real slice.
Electrifying.
Yeah, when are you back? Not for a while.
Not for the foreseeable future. Have a great weekend.
Squawk on the Street is next.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Sarah Eisen at Post 9 of the New York Stock Exchange. Kramer has the morning off. Futures pretty solid as we watch for signals as to whether yesterday's rotation was the real deal. Bank earnings in focus. PPI does come in a tad warm. Yields still lower at the short end, 2-year below 4.5. Our roadmap begins with the banks. Investors watching for warning signs in the banking system. JPM and Wells see a profit drop. Citi revenue rises.
AT&T shares are under some pressure this morning. The company reporting that hackers stole records of nearly all cellular customers' calls and their texts.
And trouble for Tesla. Shares set to sink for a second day after reports of a robo-taxi launch delay.
Let's begin with some market reaction to the banks today. Interesting split in the action, Sarah, at least price-wise, between, say, Citi and Wells on their results.
Well, also just the higher rates picture is affecting these banks differently. We always look at the net interest income, and it was a big miss on Wells, and that's partially potentially why the stock is getting punished today. We're going to talk to the CFO of Wells Fargo on Money Movers, but the 9% decline in net interest income, David, the fact that they
don't appear to be making as much progress on the expense side, which was the bull case in part for the stock. That's certainly two of the knocks against Wells Fargo that I'm seeing this morning. But you don't see, for JP Morgan, that net interest income number was a slight beat. And they reiterated guidance. So I think there's a question now of how rates settle now that we're expecting 2 cuts from the Fed, and whether we've seen the bulk of the gains that the banks have made profitability-wise from these higher interest rates.
Yeah, JP Morgan, as you say, a different story. As you take a look, the stock is not doing much. It's perhaps going to be down. They got they posted a 20% return on tangible common equity, but bigger than expected buyback as well. The strength there was capital markets, wealth management, and cards. There were sort of trends in loans and deposits a bit flattish in terms of guidance. NII, to what Sarah's been talking about, came in more or less as expected. But generally seen as a very positive quarter for JPM. Nonetheless, as you can see, the stock really doesn't seem to be reacting. Although quite a difference from the last quarter, we should point out, when the stock was down sharply on earnings. As you point out, Wells Fargo, I think there are a lot of investors, though, who are still lined up there for what is yet to come in terms of the benefits of the turnaround that's taken place under Charlie Scharf, although this is not a quarter, I guess, that's going to particularly excite them, Sarah.
When the asset cap will be lifted, which we don't know, and we ask every quarter, and they don't know, and the Fed doesn't know, and nobody's telling us anything like that. So that's potentially the part of the problem. The other thing I just noted in the JP Morgan quarter is that the credit loss provisions were a little bit higher than expected. There was a $3 billion build, $3.1 billion of credit costs, which was higher than anticipated. They had an $800 million incremental reserve bid. So that's always something to watch as we wonder sort of where we are in the credit cycle and what these banks are seeing ahead. You know, the commentary from Jamie Dimon continues to sound a bit cautious, even in the face of good news. I mean, it came right up top in his statement in the release where he said there's been progress of inflation, but he's still worried about it. While market valuations and credit spreads seem to reflect a rather benign economic outlook, we continue to be vigilant about potential tail risks. There's been some progress in bringing down inflation. This is what I was talking about, but there are still multiple inflationary forces in front of us. Large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. Therefore, inflation and interest rates may stay higher than the market expects. These bankers continually warn about this.
Unfortunately, the statement's all we have because he was not on the call because of a travel conflict. We did get the CFO, Jeremy Barnum, saying U.S. consumer is fine. There's some elevated dialogue regarding M&A, although regulatory pressures continue. I think we have some sound from the call. Take a listen.
When you look at the system as a whole, just to go through it, QT is still a bit of a headwind. Loan growth is modest and not enough to offset that. And RRP seems to have settled in roughly at its current levels, and there are reasons to believe that it might not go down that much more, although that could always change and that could supply extra reserves into the system. But on balance, net across all those various effects, we still think that there are net headwinds to deposit balances. So when we think of our balance outlook, we see it as flat to slightly down maybe, with our sort of market share and growth ambitions offsetting those system-wide headwinds.
Meantime, assets under investment management up 14, record number of first-time investors. And the Wells commentary as well. The percentage of investors who are moving into higher yielding instruments has slowed. Pretty interesting. And then credit performance is in line with our expectations. That was the word over at Wells.
Yeah, moving cash into it. One bright spot, David, in all of them consistently is investment banking fees, right? They soared. Citi's investment banking revenue I saw up 60% from a year ago. Now it was lower base maybe, but Wells Fargo fees up 38% from 2023. But slipping from the previous quarter, I guess, is another trend, but way up year over year, as you've seen activity come back.
There has been more activity, more capital markets activity for certain. M&A not as much in terms of advisory as perhaps there had been a hope for when this year began, and things seem to be perhaps on a holding pattern ahead of the election. You know, you're the most recent person here who interviewed Jane Fraser, I think, Sarah. So
Yeah,
I'd come to you on Citi, which, as you see, is up a bit on revenues that were up 4% over the prior period. What was the highlight from this quarter? Anything
Well, just
for us?
incremental growth in a lot of the businesses, and I think that's important for Fraser to show as she has gone through this big restructuring, which included layoffs and it included a number of the departments under her getting restructured. She said it in the release this morning. We have made incredible amount of progress in simplification, both strategically and organizationally. This is what they've been embarking on. We are modernizing our infrastructure to improve our client service and automating processes to strengthen controls. We will continue to execute our transformation and our strategy so that we can meet our medium-term targets and continue to further improve our returns over time. So potentially some incremental progress on that, despite some credit card losses, which, you know, we watch. It's big business.
And not enough progress being made, at least in terms of the from the regulator's standpoint, in terms of enhancing their data quality management. I know you saw this a couple of days ago, Sarah. We didn't really give it a lot of attention, but they got fined $75 million by the OCC, another $60 million by the Fed as well, for what they say is a violation of the 2020 consent order that they entered into. They did an examination in 2023 that found that Citigroups continue to have ongoing deficiencies in data quality management. I just note that because it's not an insignificant combination of fines, and they continue at least to apparently not, toward the implementation of appropriate compensating controls. But so far, the Fed says that has not been adequate. And we all know that has been a big issue for Citi in terms of just overall data, and of course you go back to when they wired all that money to unknowingly to a creditor.
No, I mean, we watched the expense side on a lot of these, which appeared, look, for Citi, it was a good story. This is a bank that eliminated, 7,000 positions in this restructuring. They were expected to generate $1.5 billion of annualized run rate expenses as a result of the transformation, according to Fraser a few months ago. So that's been a positive story. Obviously, the regulatory setbacks, just a reminder of what kind of regime these banks are still facing, I think, all of them. I mean, it's not just Wells Fargo, clearly Citi, and a lot of them. And as we debate what's ahead for Basel III and the end game, and investors have been excited
although it's
about
very
that.
specific to Citi on this one issue that they've been dealing with, and obviously she's been taking steps to deal with for years now. And to your point, Wells is more or less out from under most of the regulatory issues.
Except for the asset cap, which remains sort of a stranglehold. You know, the setup was interesting too, because the banks had rallied pretty nicely this year and into this report. The big banks outperforming the regional banks, Carl, which have seen more pressure on profitability, and why it could be interesting to see in the coming weeks how they are dealing with some of these net interest income and what they say about the consumer as well, and whether they're hit harder just because they don't have the investment banking fees as much to lean on the market's gains that we're seeing in some of these banks.
Obviously ties right into the macro data that we got this morning. PPI came in a little bit warm after yesterday's pretty tame CPI print, after rekindled hopes for a Fed rate cut in September. PPI 2/10, looking for 1. Got some revisions higher. Year-on-year 2.6 is going to take you back to the spring of last year. Yields kind of gyrated a bit, but didn't really change the story. And Santelli pointed out wholesale inflation doesn't really move the needle the way CPI does.
Yeah, core inflation up 3%. It definitely was hotter than expected. Not goods though. It's services, and that's where we saw it. And it's potentially why the Fed has remained wary and wants to have more confidence, because the inflation side of the services sector has remained sticky and stubborn. But after yesterday's big relief on CPI, and really that was the 4th month of data where we were starting to see good inflation progress, I think the market's pretty confident in a September cut and a December cut, and a potential pivot in the language, a setup for those cuts from the Fed, either in the July meeting, which is almost 3 weeks away, or then Jackson Hole in August. He's got a number of opportunities. He's speaking next week, in fact, with David Rubenstein at the Economic Club of Washington.
That's Monday, right?
Yes.
Yeah.
And we'll see. I mean, if he gets a specific question about how he reacts to CPI, it should be good. Judging by some of the other Fed, we've seen Austin Goolsbee, Chicago Fed president, react. They're very pleased.
Profoundly encouraging was the word out of Goolsbee yesterday. And Nick Timmeros on Squawk this morning suggests maybe we'll start to look for ways in which he tees up September, if at all. Big piece in the Journal this morning. It's time for the Fed to end the waiting game. Why wait until September? The Herd's argument is that September is really just procedural because there's no meeting in August. So it's not an economic decision in their view.
But also July might signal a bigger sense of urgency in some sort of weakness. What do they see in the data? You know, that whole panic thing, which is kind of silly because they see the same data that we see. But the belief is, just given Powell's style and his cadence, he likes to set it up rhetorically for the next meeting. Although he's not going to pre-commit, from July to September, because there's still a number of data releases.
We got to talk about yesterday's market a bit as we head into trading here in 18 minutes. I mean, you saw historic moves yesterday in the Russell versus the likes of the Mag 7 or the QQQs. Kinds of moves you have not seen, and I'm seeing here largest one-day move in 23 years. That is the differential in performance. I mean, that was just stunning yesterday. We talk obviously a lot about the quantitatively driven funds that are enormous in size and can have that kind of an impact. But you can take a look there. What happened? It is historic. I think worst day in 10 years when worst one-day move since the large cap acronym started being thrown around in early 2013. I'm seeing some research here in terms of, again, that difference. And yet, we're fine across the board, but you can see yesterday was just bloody when it comes, at least if you own them very recently and you were short perhaps the Russell. Wow. Whether that will continue, of course, continues to be a question. It was based on rates, as we all know, the sudden move to small caps perhaps being a beneficiary of a lower rate environment, and the idea being that somehow big cap tech growth is out. Now that typically has been a one-day move in the past when we've seen these kinds of things, although never to the level we saw yesterday, or not in a long time.
Wells takes a crack at it today. Chris Harvey pumping the brakes on the great rotation. We believe the great rotation needs lower rates and earnings optimism. CPI delivered the lower rates, Harvey says, but earnings concerns linger post-Delta. We'll talk more about Lufthansa today and their guidance, which got absolutely slashed. But we do see this as an oversold bounce, not a rotation. So we'll see if it continues.
It's the flip side of what we talk about every day, which is the narrowness of the market rally. Some stunning statistics: 87% of S&P members outperformed the S&P 500 yesterday because the index moves based off of big tech. David Rosenberg had this stat: $600 billion of market value wiped out from the Magnificent Seven yesterday. And then everyone, a rotational move is not the same as a broadening out move, according to Matt Bailey of Miller Tabak. And how do we read into that? And what is it going to mean for the averages and the pain out there, despite the fact that everybody's been rooting for small caps and for this broadening out?
I mean, the Mag 7 has added some $2 trillion, some incredible number in market cap, and that to some extent has sucked the liquidity out of the rest of the market, essentially.
When we come back, Tesla's 11-day win streak comes to an end. Stock gets slapped with a sell rating over at UBS today. We'll talk about this reported delay in the robo-taxi event on August 8th. As futures hang in there on this Friday, what an eventful week. Stay with us.
Shares of Tesla extending yesterday's losses, at least in the pre-market. You can see perhaps down another 2%. UBS downgrades the stock from what had been a neutral to a sell, describing the rally as too much too soon. Of course, that call comes one day after Tesla shares snapped an 11-day winning streak. There was a report out from Bloomberg saying the company is delaying its robo-taxi launch. It will now be in October, says Bloomberg. It previously, of course, had been scheduled for August 8th. No word from the company as yet. They say that 2-month delay has been communicated internally, at least, citing people who are familiar with that decision. Of course, Tesla shares, as we have been talking about for some time, have had an incredible rally, having been down as much as 30% on the year. As of yesterday, at its high, I think it was up about 9% before this report and the subsequent turnaround. And you can see month to date, and that's just month to date. It's only, what, the 12th? It's still up almost 20%, far exceeding, again, an $800 billion market value. Not a surprise when it comes to delays involving robo-taxi. Obviously, if you go back, and Mr. Musk certainly admits to this, he has promised this technology and full self-driving for many years. I mean, if his original promises had actually been accurate, these things would have been on the road for some time now.
Did you see Uber and Lyft moved up on the news as well?
Dramatically,
pretty substantially, almost as if it's not happening at all. But look, I think that's the UBS, the bulk of the UBS downgrade has to do with just the share price reaction to some of this hype, the sort of non-auto related business, which is what the market has gotten excited about, whether it's robo-taxis or humanoid robots. I mean, according to UBS, they say it's always had a premium on the stock for the future growth initiatives. Proper valuing that additionality is difficult. The premium has widened of late, we believe, on the AI enthusiasm. While Tesla is investing heavily on AI and the tech is making progress, investment is costly, pace of improvement may slow, and the payoff is long dated. They say basically 60 to 90 a share, Carl, is the core auto business, and then the other attribution, the 2-year average is 140 a share. It's now 175 a share. So they're kind of looking at the sum of the parts and the valuation and showing this is when it typically starts to trend down.
Yeah, funny because yesterday Adam Jonas from Morgan Stanley, who's been quite bullish on the name, talked about a client lunch where he does every month regarding Tesla. Core auto business didn't come up at all. He says we talked for 90 minutes about energy, humanoids, AI, FSD, China, geopolitics. The logic of cars was almost completely absent from the discussion.
Is that bullish?
Kind of amazing. That's what Musk wants.
Yeah.
It's what he's asked of his shareholders in the
Car
last
business
call.
is boring.
He said, you don't want to own this if you really just care about the car business. We're a AI and robotics company, essentially, and full self-driving obviously is a key part of that. By the way, I want to correct something I said. The market value is now below $800 billion, again, at least at the outset today. That was a dramatic reversal yesterday from where the stock had been. But nonetheless, you know, you can imagine that enthusiasm will once again be built up conceivably if, in fact, the new date, whatever it may be, holds. And we haven't gotten confirmation of the story at all at this point. Although typically Musk would correct.
That's what I was about to say.
He would correct if...
Reuters is fake news or something.
Yes.
In this case, it was Bloomberg, but
Yeah.
he normally comes and issues a very rapid retort.
He does on
The
X.
accent spoke volumes.
Yes.
Look, I think it was looked at as a catalyst. Now the next catalyst is earnings. And what's in focus on earnings? Slowing sales and profitability challenges.
Yeah, although the stock did also benefit from those delivery numbers that did seem to at least indicate there was perhaps some momentum, and the 1.8 million estimate that's out there for deliveries for the year would be met. So July 23rd, definitely important, coming
next week,
coming soon.
When we come back here, the chips have taken a detour, but the sector is still outperforming the major averages so far this month. We're going to look at what's in store for the semis for the rest of the year. Also taking another look at futures as we head into the opening bell. Pointed a little bit higher, at least for the S&P and the Dow. NASDAQ lags again. So we'll see whether we're going to get some sort of repeat of that rotation from yesterday. Squawk on the Street when we come right back.
NBC.
Check out some NASDAQ 100 laggards as we get set for the opening bell. Got some more pressure on mega cap tech, and what we'll see is if it's in fact a follow-through on yesterday's enormous rotation. Tesla, we already mentioned that downgrade to sell over at UBS. Don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
All right, welcome back. We're keeping an eye on shares of AT&T as well. The company telling us about a significant hack where customer data was illegally downloaded from a workspace on a third-party cloud platform. Now, the data is nearly all of AT&T's cellular customers from May 1st, 2022 to October 31st, 2022. These are phone call and text message records of all of those customers.
Whoa!
The records identify the phone numbers with which an AT&T number interacted during the period. They do include AT&T landline if you still have one, a home phone.
You
also,
suck.
of course, including counts of those calls. That said, it doesn't include the content of any of the calls or texts. It doesn't have the timestamps. It doesn't have any details such as social security numbers, dates of birth, other personally identified.
There's my phone number. That's a problem. AMD at 182. Spy breaking out. I'm gonna set my, well, there she goes. SPX is at resistance right now. Right there. 55.93.63 somewhere. Yeah. July 15. Into the VWAP. What's SPY here? The 560s or the 558s? I'm watching it right in here somewhere. Right, 75, 74. Because we could come down, you'd stop at the VWAP, and these three crows. So get in, you know, or we wait to hit the 200. Or a double bottom at 557.14. $557.15 if that doesn't hold right there. There's your double bottom on the wick. We're going to find out. 560 strike at 75, 74. Meta's today's loser under 5. Ooh, down 15, 16 bucks. Okay, here we go. We're watching SPY. Watch Meta too. I have a 490.34 on here already. Hey, Jimmy. You need a blackout. IWM had an unbelievable day yesterday. The IWM. The QQQ looks a little froggy right now. The SPX is at resistance and broke it. And yes, I'm watching the SPY real close here. Yep, SPX just broke resistance. And the SPY's trying to. $557.81. Uh-oh. 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 Tweezer bottom on Meta on the 5 minute. Tweezer bottom on Meta on the 5 minute. Would you please come to the operating room? Crowd's going wild at the sports arena. Such a pretty world today. Good morning, Mannequin. Good morning, Parge. And everybody else that's listening in there on YouTubers. Say hi to Jimmy. If you want good luck, say hi. We agree, Jim. We've got a real close eye on Meta today. AMD's flagging out. Amazon was being badmouthed yesterday. There goes the SPY. And it's now at 86 cents. Someone could make a business decision right here. The SPX just broke out Randy. VIX is in a dive. Oh my God. Oh yes, Randy. How dare you take a vacation? Nobody's allowed to take vacations but me. Moderate volume. 10 consumer sentiment. Oh. Well. It's going to be them kind of weeks. The 550 strikes. 560, I think that's what I said. Up 10 cents. Profit taking should exist. As I watch into the kitchen and I address the coffee situation, I'll be right back. In between, I'll drink 16 ounces of pure water at a temperature of less than 72 degrees. That has to sit in the refrigerator for more than a day. Goodbye, CNBC. It was short-lived. Okay, we've got a knife here on the spine of the V-whips. Jimmy said profit taking. Now we're down here at 72 cents. Come on now. Get your eyes open. Pay attention. The crowd's going wild here at Sports Arena today. 70 cents. These are the 560s. And I had a tinkle in my ear, so that's a real good sign. Jim, I've had that tinkle in my ears too. Hello? Yeah, this is the ear tickler. Doctor, is it true that you have had some tickling in your ears? Yes, when I'm in a trade and I'm up like 80 bucks right now, we're at 80 cents, and I'm wondering, should I sell it? What would Jimmy do? Oh, did you get in at 82 cents like you said? Yes, 72? Yes, I did, sir. You know, you did call the VWAP pullback, and you just now had a confirmation of hitting that first candle. I think I would consider a little bit of separation here, a little bit of profit taking. Why, the dog is in heat? What do you mean? Yeah, like any dog that's in heat, you know what they do. They kind of get locked up, and then they get stuck, and then they could be there for hours. But if you realize that before it happens, and you get out at the heat of the moment, you're not going to get stuck. and watch it depreciate. Thank you, Jim. I just got out at 90 cents. The drop was to shake people out by Magnificent. He is 100% correct. He was 100% correct. Magnificent. Give him an A+. Woo! Damn, they were even whistling for you. I don't even get that. That's right. Don't know why I'm giving you an A+, but I am. You get no memos. You'll still get your memos. You ain't off the hook yet. How dare you? The master chartist gives you a good grade and you want to have a coup? Watch him. Watch him, Michelle. Keep a good eye on that guy right there.
Commercial mortgage loan.
The mortgage loans. Well, after that successful trade, that's how you do it. Mike, should I have sold? That's the question. Right now, I'd be up more if I did not sell. But all in all, 72 Main all the way up to freaking 90 cents. And you go to the beach. That's right. That's right, Rug. I've got to get my little collection fee up a little bit more so I can go to the beach. If I go to the grill, I will be with all the prostitutes and the drugs. If I stay in Montego Bay, I'll be halfway safe. Okay, the crowd's going wild. Now we're waiting. Where's support at, Jim? We have two of them. You have one right here. Just don't get your panties in a wad. You got one right there, then you got the other one right here. You want to make a basic business decision and keep us on watch. If it pulls back to the knife and you know how to count to 3, then you've learned how to trade with me. Damn, Jim. You make it look so easy. Well, if I did that, I'd still be in this sucker. I had a buck. See, I used to be very stubborn. And then I started paying attention. We got a rookie in here named Mike. So now when I'm charting these up, I just don't always just go to the boxes. I go straight to the wicks. I used to be a nerd. Now I'm not. I'm a turd. You understand that, Mike? He understands. Tesla. So many traders yesterday had to kneel down and pray because Tesla went downwards in a big way. So now we've snagged up a little bit and we're at a pivot point area. Do you think this stock will go up more, or will it show more hysteria? Tips, leave him at the vacation counter. Nothing better than listening to poetry by Washboardjim while you're trading. Really soothes your mind. Tesla. Hey, Papa. Yeah. Remember, this was just a rumor yesterday. What they tried to do to Tesla. You understand? Him's going hard. We don't talk like that in here. Him's always hard. Jim, that was funny. Woo! Jimmy called a double bottom here on AMD. Amazon, Jimmy's calling at the 200 SMA. Apple, new high. SPY just broke resistance. SPY just made a statement. Not a very nice one because it's at 110 now. Jimmy would be up. I'm not going to say it. I could say it. Let's just say 20 cents a contract, which is $20. 18 bucks a contract. Okay, SPY just broke out, period. We're at 114 now. That's 220 bucks left on the table. I'd be a multi-millionaire by now if I just held on to every trade I made. Everyone, winners and losers. Jim, this is the stock god. We're now at 118. I hope you haven't sold yet. 121. I am giving you a gift from the stock god. I hope you haven't sold yet, James. I don't think that's right for the stock god to rub it in my face. How dare you? Oh my God. 123. That's 300 bucks left on the table. We left 120 some percent on the table. Richard, Randy. Randy. The pullback. Now we're at the 9 or the 50. I don't have the 9 on here. That's the 50. That's the 9. Do 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 do. Back down to 106. We broke out, we respected the resistance line of the 1 2 bits Phoebus with 3 black crows. 106 to 112 here, 113. It's a 560 strike. Carvana's up $5 today. In ARM, SMCI's up 26 at 916. We're at 116 now here on the SPY. Look at run on SMCI, mannequin. You got a double top with a new high. And the SPY now is at 123, the 560. It's got so easy. 3 black crows, 3 white soldiers out of the trade. So Jimmy called 3 black crows, 3 white soldiers out of the trade. Vacation fund, Washboardjim. I want to see someone donate $500. Damn, $500? Yes. Let's get it done. I'm gonna go get me some water because I'm dehydrating. Right there, I mean, that was a nice little trade. 3 black crows, 3 white soldiers out of the trade. Frankenstein.
7, that's the high from April. Other than that, we're kind of range bound and contained. All right, beautiful. Thanks, Ben. Good look at the market here. Appreciate that. Mr. Lichtenstein, host of the Futures Show every morning before MTL. Let's talk earnings and let's look forward next week to a big, I don't know if it's a Mag 7 Netflix, technically, I guess it is. Jeff Pierce joining us from St. Louis, Senior Manager, Derivatives Trading. We're right at the high. One of the most incredible comeback stories, really, here over the last couple of years for a giant like Netflix.
Yeah, absolutely. I mean, even if you just look in the last 12 months, right? We were down at 344 back in October, now almost touching that 700 mark just last week. And we've got earnings coming up next Thursday after the market. Good news for investors that are hoping it gets over that 700 mark is we've seen a lot of analysts come in ahead of earnings with some pretty positive commentary. And then the pullback over the last couple of days might give some of those investors, the extra push to buy in if they do like what they see on this report. Some of the common themes we're seeing from investors are expectations that they're going to raise the fiscal year revenue growth, seeing additional revenue from those ad-supported tiers, possible price increases, especially as we see some of their competitors raise their prices. Also, some of the new ventures they've got, the NFL deal for Christmas Day, some of the new content that's coming out, think games, shows like Squid Games 2, and ultimately seeing a pretty low cancel intent from customers out there. All these things are pointing to positive.
That's Netflix.
Just to look at a couple specifics here, JP Morgan raised from 750 from 650. They raised their Q2 net subscriber addition estimates to 5 to 6 million. They also think that the expectations for 2024 revenue growth is 13 to 15%, the $6 billion.
COSK hit resistance 1549.
Pretty conservative. If we look at TD Cohen, who moved into 775, they think the size of Q2 and Q3
Lily's up $14.
The new ad-supported tier is going to be in
Lily, new high,
any price increase.
new high in Lily.
These major markets are going to be a catalyst as well. And we saw KeyBank, who they expect them to raise their annual revenue growth to 14 to 16%. Previously, they had it at 13 to 15%. So numbers.
SPY new high.
Raises coming from these analysts, a lot of positive commentary. Now, investors are kind of waiting to see whether or not this pans out in the report.
Okay. So it's really a game of steady wins and stable.
Hey, Jim, I saw your morning report this morning. Man, you nailed it at 558.13. Man, you nailed that resistance level of 557.73. Right now, I got enough food to feed my family for a good week because of that trade, Jimmy. So I'm going to be nice to you, and I'm going to put a little donation into your vacation package. Because everything that you taught me in the past year, it's increased my profitability up more than 99.9%. Thank you very much.
In Q4 and 65% in Q1. 6.9 billion in free cash flow. They have money right now to spend on content, and they're one of the few streamers that we see generating a pretty constant profit, right? 6.4 billion in net income over the last 4 quarters. That gives them that ability to invest in content, which is not something we're seeing from all the streamers, right? Some of the companies have been cutting down on their budgets. So they're in an interesting position. They've got a lot of different avenues that they're trying to drive revenue from. You think about the sports, you think about some of the gaming. And so I think this report is going to be an interesting one. And I think, to your point, they're getting in that mode where investors kind of have this expectation of what they're going to see from Netflix going forward.
Yeah, very true. Okay. Thanks, Jeff. Good luck. Quiet chart. What a massive V bottom, Netflix from just really down in a rut to flying high again. Just shy of $700 though. We'll keep that in mind with the trade here. Dan Deming joins us, managing partner of KKM Financial. Dan, so close to a high here for Netflix. Hasn't quite punched through it yet.
Not yet, and it certainly has realized some pretty heavy selling pressure here the last couple of days and trying to recover a little bit today, but not reacting as strongly as some of the other big names after some selling pressure yesterday. So we'll see. Yeah, I mean, I think that, certainly the trends, and when you look at the price action, as Jeff pointed out, that's the October low from last year. I'm just looking at it from a technical standpoint. We did see a low then, and we did see another dip in the end of April, early May. And if you draw a chart line from the October lows through the April lows, it comes in around 600 here, Oliver. So I think that there's still a possibility that we're going to see a little bit more give back in the market here over the next few weeks, particularly as we head into August. I just feel like, it's a bit overbought at these levels, and some of the euphoria might work its way out. It was a weird reaction yesterday, as you pointed out, the dispersion in the market. Also, the fact that rates went down and the market went down. So that was an interesting dynamic. So I do think the market's possibly in a little area here where we're going to see, I think, a temporary high. I'm not calling for a big pullback, but I do think that Netflix is a little bit vulnerable here for further pullback. And so what I did today, Oliver, is structure a trade example around being able to pick up the stock around 600.
Okay. All right. So if it drops, then you're ready to scoop.
Yep.
Take me through the process.
Yeah, so in this case, it's the selling this August 600 550 put spread. Basically, you can do that for about $9.50 at 651. So I think it's a little higher now, but nonetheless, somewhere about a 1.5% return over the next month and a half, or just under. And you have that on into the earnings announcement. And if we do see some weakness, I think at that 600 level, you got some pretty decent support. And I could see us going there if there's some disappointment in the earnings. And if it continues to grind higher, then you take your 1.5%, and then you evaluate it from where it's currently trading and decide if that's something you want to step up and buy. But at this level, and just the way the market's acting, and just I think some of the other metrics in the market, that I do feel like it's a little bit vulnerable as we move into August. Excuse me.
Yeah, I like that approach, basically selling downside, because there is still the idea in previous high might be some kind of resistance. So if you're basically looking to own options for upside, then you kind of have to contend with that issue technically, whereas
it's expensive.
Yeah.
And it's expensive. I mean, the implied values are elevated for a reason. But if you are looking to get long this name by using options, then it's particularly if you're looking at call spreads. I mean, they're expensive here, and but again, the stock has realized a significant upside here, and by and large, if you bought call spreads throughout the first part of this year, you've done pretty well. But it's just a more expensive way to enter the name, unless you just want to buy the stock outright and then maybe do a covered call, something like that. But again, that does open up the downside. And in this case, you have the opportunity to get long at better levels, and that's the thought process here.
Okay. All right. So getting exposure at Netflix, if it pulls back to maybe some support. And look, the thing too is that at this point, it really does feel like the downside would be kind of limited. There's not going to be like big. Don't think there's going to be big shock factor like Jeff was just taking us through. Like they've hit their stride here. Like there shouldn't be any major, like a shocker. They've already handled the account stuff. Money's flowing in.
Right, exactly. Yeah, you would think that by and large the fundamentals favor this name, and from a technical standpoint, as I pointed out, you do have some what appears to be some support, but those were off of some pretty, decent back-offs, and they were short in duration. I mean, the one in April was really just the last couple of weeks in April, but it sold off quite a bit. So again, if we do see a negative reaction to this earnings announcement, I certainly could see us down, another, from here, another 10%. Which would be around 600, and then the opportunity would be much more. I think valuation-wise, and just from a technical standpoint, it's a better level to enter the name.
You think so, huh?
Like the trade, makes sense.
All right, Albert.
Yeah, good
You
stuff.
got it.
Appreciate it, sir. Dynamic managing partner of AM Financial. We're going to talk about yesterday's massive inversion of the market regime with John Jerian next. Joining me here in studio. Don't miss it. Always a good chat. Stock's in good shape right now. Russell started off strong. NASDAQ was a little weak, but everything's now moving higher and with some good conviction, too. After consumer sentiment came in light, markets, no problem with that.
No problem with it. Judy. $150.
Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Stocks are in pretty good shape this morning. Let's talk about the action from the last 24 hours. And as earnings season begins, John Jerian joining us here in studio, co-owner of Market Rebellion. author of It's Not an Option, co-author.
It's not an option.
What's going on, John? Good to see you.
Hey, Oliver, it's fantastic to be here. Thank you.
Absolutely appreciate that.
Love your audience and look forward to the discussion on trading and opportunities.
Yeah, we always have good chats about the market. I love our conversations, and it's good timing because yesterday was like this crazy inverted day. So kind of take me through your process of how you're viewing that, because everything got flipped on its head.
Yeah, it seemed like it was, in the old days, Oliver, that would have been a risk-off day because you saw all the biggest cap stocks. They were just selling almost indiscriminately. Every one of the Magnificent Seven was just flipping around, and you and I will get to Tesla, which had its own issue, but they were pretty much selling across the board in the big tech stocks that had got big gains. And what did they go into? Apparently into the small caps. The Russell 2000 was up like 3%.
Yeah.
And so when you have one falling pretty dramatically, 300 points plus for the NASDAQ, and the Russell moving up like that, it's pretty clear there's a rotation. It wasn't just probably a one-day event, but I don't know that it's going to be a trend for weeks and months. I think for whatever reason, a lot of big hedge funds decided, okay, looks like the fever's broke. We're going to get that rate cut. And, it's 88 or 90% at the CME tool that they monitor, exactly what's going to happen at the next Fed meeting. 88 or 90%, pretty much a sure thing. I mean, that's as close as it gets.
Right.
Obviously, we can get all the way to 99 or 100 the day before. But yeah, that was a big day yesterday.
If it's there by the time the Fed has to make a decision, they go with it when it's at 100. But we still got a couple months.
Months, and we got that producer price today that was
a little warm.
Warmer than they'd like.
Yeah.
So that takes pressure off, if you will, Jerome Powell and the Fed, as far as everybody saying, well, why are you going to wait till September? Do it now. Do it now. Make it 50 basis points. Do it now.
Yeah. I mean, there's like a cacophony of economists, and I kind of feel like to a certain degree, people like to comment from, the proverbial peanut gallery, us who don't have to make those decisions, so we can look back and say, see, I told you the Fed should have cut in July. But realistically, I mean, he's not going to do that.
Yeah, realistically, especially right at the beginning of earnings season here, because even though the Fed's job isn't, how are the corporations doing as far as earnings?
Yeah.
That's not their job. But it's an important input for employment. So if a number of companies, in particular, housing, that's the largest employment category, really, because it goes from everything from roads to sewers to toilets to whatever, home building. If those companies started saying, hey, we're looking at the possibility of layoffs and this and that because, for a variety of reasons, then I think the Fed might be more pushed towards making a move. But I don't think those kind of numbers will bear out this quarter.
Okay. What do you think of the banks so far? Because the timing is interesting. Yesterday, a highly cyclical day.
Yeah.
Banks generally have good lens for the economy. It seems like the net interest income stuff is waning. Wells Fargo is kind of an example of one of the weaker ones. Then you look at JP Morgan, it's like, boy, it would take so much to really put that business under stress.
Yeah, and Jamie has built, an amazing machine that just prints money. They got that one-time boost from the Visa, I think it was
that was a big
exchange of stock.
Yeah.
But other than that, it was just a very, very solid report in any quarter for JP Morgan. Like you say, Wells Fargo, they always seem to have some troubles. Sometimes it's a group that is doing something wrong, basically creating ghost accounts or whatever. I think all of that is in the past now. I think they're really focused in on being a bank, but they have massive exposure, of course, to real estate. Wells Fargo does. Of those big four banks, Citi, Bank of America, Merrill, JP Morgan, and Wells Fargo, I think Wells Fargo has the most exposure in that group.
Yeah.
So I think any excuse you give somebody, Oliver, to say, you know what, I'm going to ease back a little bit. Maybe I'll boost up my bets on Bank of New York, or I'm going to boost them up on JP Morgan, or go to some super regionals or something. You could see that, but any excuse for them to lighten up on Wells Fargo, as soon as they take it.
They take it generally, pretty major break. In Wells Fargo chart. Yesterday was a pretty good bounce in the regionals. It seemed like there was a lot of optimism I described it yesterday as the market pricing not just a soft landing, but like an immaculate one. The way the interest came back into some of the kind of higher risk areas, if you will.
Yep.
I mean, even if we do start in September, and then you've got an election and a possible shift in power, like, is a 25 basis points going to make a difference for a regional bank that's got exposure to a bunch of, debt wall that's coming up on real estate businesses and stuff? I mean, are
The
we
answer's
really
easy, and that's no.
Right, yeah.
But I think right after the election, if everything is roughly the same as it is now, after the election in the first quarter of 2026, or 2025, sorry, I think we will see additional cuts.
Okay.
I think the Fed really does not like to play God, if you will, into elections. They'd rather not make multiple moves into an election because it seems like they're favoring one party or the other. Certainly there's a lot of people that would say that.
Yeah.
But if the inputs are there, they're going to have to move. And I think the inputs right now are telling them they have the room, they can cut in September. It's very likely that that'll be the only cut until after the election, in my mind.
Yeah, agreed. Let's talk some trades and some specifics here. We mentioned Tesla. I mean, it's frustrating to see Elon kind of cave right into the cynics and the critics on the timing and the promises falling short. Big pullback in the stock. I mean, does this like invalidate the huge run it had up off the lows, or what do you think?
I don't think it invalidates it, but it does put it off, and that's what Elon did yesterday. Sadly, as a Tesla shareholder, option trader, I like what the company had done over the past 11 trading sessions or something.
Right.
Put on a lot of nice market cap.
Yeah.
Then we reversed yesterday from about 270 or 272 in that stock to fall all the way down into the 240s. That's a pretty ugly drop. $30+, massive turnaround. And it was, okay, delay of robotaxi, delay maybe of that Model 3 variant and so forth. Those kinds of things, Oliver, happen for a whole variety of reasons. Look at how long it took them to finally get the Cybertruck out there.
Right, yeah.
But overall,
with time he comes around.
Yeah, but this guy is the world's greatest cheerleader when he's got the things to cheer for.
Right.
And he was talking about, well, robo-taxis are going to be $1 trillion business for us. And you're just like, wow.
Yeah.
And the stock zooms. And then he pulls back a little bit like he did yesterday with, we might have to push that event out a little further into the future. It's natural, I think, to see a reversal yesterday, a little continuation today, but I don't think we go back down. I think the April lows in the 140s or something that. I
Still
think that
far
was a
ways
gift. Those areas in Tesla stock were a gift. And there's now some nice fat volatility, and you and I know, you own the stock and you decide to sell some calls.
That's what I was going to ask. How do you manage the position?
Yeah, you can put on a collar, of course, buy a put underneath the market and sell an upside call to pay for that put, sort of locking in a range.
Okay.
But then a lot of people, like myself, are just true believers in the stock, in robo-taxis, in all of the stuff that Elon's doing. The AI side doesn't get nearly the credit it deserves yet, but it will.
Sure.
I mean, look, Accenture gets $900 million in AI business. Tesla's gonna be a $500 billion or $1 trillion AI business. I guarantee it, because they've got all that data more than anybody else in the world, including BYD, Volkswagen, any of their competitors for these what goes on in these EVs in a variety of conditions: snow, heat, wet roads, all the rest. I think that is going to be really and that's just part of the data. Of course, the rest of it is how often do you go to this kind of retailer or that kind of retailer.
Yeah, they know where
they
you're
know
going.
exactly where that car's moving.
I'm with you. It's what was kind of shocking to me how bad the stock was performing when the AI kind of rush was happening. So a little delayed effect when they announced the robo-taxi stuff. I like the idea of the collar because it's hard to imagine, even if the timeline gets shifted for their implementation of robos and whatever, it still could be such a massive market that if this move reflects that, why would we unwind it in its entirety? So that's where kind of the collar makes a little bit of sense. But also to recognize how quickly we moved on that until now we actually get the event, seems like maybe you do have a little upside kind of cap there possibly.
Yeah, and why not let time work for you in that regard? Because it works against Elon and shareholders when they push out an event like this, but that works for you as somebody who sells that upside call, somebody who sells that 270, 280 call, or whatever it might be, 250 call, depending how aggressive you want to be.
Right.
And then just let time go by, and that air just comes out of the balloon, and all that premium you get to keep.
All right, right now shares coming back a little bit here today. They were actually soft earlier and now bouncing back. John, great conversation. Great to
Thank you. Great to be here, Oliver.
Yeah, good timing on a fun 48 hours for the market. John and Jerry, co-owner of Market Rebellion, co-author of It's Not an Option. Coming up, let's talk some charts. Let's get ready for earnings next week. We got two other banks, Bank of America, Goldman Sachs. The most important move, though, is going to be in Taiwan Semi. It's an early look. It's like a cheat before the actual semiconductors kick in a couple weeks. Taiwan's going to be big, so we'll check out the technicals when we come back. Stocks at the highs of the morning. Russell's now just shy of 2%. NASDAQ trying to keep up. We'll be right back.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes up to 25 stocks in just a few clicks.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Continue the earnings discussion, prep for next week. Two banks and one very important chip stock. I got Alex Coffey here with me alongside Mr. Rick Ducat. Let's go to the banks first. Goldman on Monday. What are we looking for?
Yeah, EPS expected $8.63, revenue $12.64 billion. More investment banking focus when you're looking at Goldman. That was a bright spot for Citi, so perhaps a foreshadowing of what's to come. Although notably, none of those rallies held. And they all were lower, at least before the show, in terms of Citi, Wells Fargo, JP Morgan. But you still do see a little bit of green in terms of Goldman's response. Analysts are mostly favorably rated for Goldman Sachs, 2/3 of them in the buy camp, about 30% in the hold, and then there is one lone sell amongst the analysts compiled by Bloomberg, which is a total of 28 of them. When you're looking at this particular stock, though, it's been an outperformer. So that's also something to keep in mind. JP Morgan, strong results, not a favorable reaction. Jamie Dimon does a good job of trying to throw cold water on things, usually keep the stock kind of under control.
Right, yeah, he likes to keep the bar low.
But also, the stock had done pretty well. So you saw a little bit of that give back. It sort of fought to a draw and then a little bit weaker.
Okay. Goldman should kind of look in theory like it, but more kind of pure kind of trading, capital markets.
Yeah,
business.
more Citi than JP Morgan.
Right, okay, all right. So, Rick, I mean, this chart looks really good for Goldman, it seems like.
These big banks are just crushing it during the past 9 months or so. This one's no exception. New all-time highs yesterday. Not quite at that point today. Very close, though. We're only down very modestly on the day so far. Still kind of within the middle of this rising wedge type shape here between our two white dashed lines here, and they are converging toward each other very slightly. They're not parallel, just for awareness there. Okay. But we can see that now we have crossed above the previous highs near 471, this green dashed line here. We managed to close above it on Tuesday, and then we had a strong move to the upside on Wednesday. Now we're kind of just hanging out around the same area here, so we'll have to see if we can get another lift up. I wouldn't expect a ton of fireworks right before earnings. I mean, that's probably when the big move, one way or the other, could be. That would be the sensible thing to be on the lookout for on the horizon. Looking at RSI, triangular pattern. We've got an upward trend line going across the lows, downward trend line going across the highs. You could argue there's some, mild bearish divergence here, but you would have gotten killed trying to play that, unfortunately, because price has been moving up so strongly here. So
we've also got the higher lows too.
Exactly. So it's kind of a mixed picture. RSI is very nuanced. If you just look at it at face value without really thinking about it, you'll probably come to some wrong conclusions. And you also should not just make trades based on one indicator anyway. You should look at a more complete picture here. But overall, if we were to keep moving to the upside, and RSI is more bullish, we're above the 50 midline, we're in that territory. The next step would be to cross into the overbought area.
Yoko?
Anyway, so if we were to keep moving to the upside, we've got kind of a resistance zone potentially here, near like maybe 500 to 507 or so. This upper line, plus one standard deviation channel, one standard deviation above our linear regression line. To the downside, 471, this obvious old high, old resistance, frequently new support, so we could see a pullback to that level. Beyond that, we've got our 21-day EMA, then right here, a confluence between our linear regression line and our trend line. You're like,
we got a profit taker on AMD right here.
Good looking chart. What a beauty.
Yeah.
That's what you want to see, really. Because the trend in both the RSI and the chart, both look pretty good, right, generally. And it's kind of also not extreme. So it's kind of one of those that doesn't catch attention in a negative way. It just looks like it's quiet.
That beautiful run on AMD.
Channel.
Finally, a win for the big banks,
Nice. Okay. All right. We got what do we got? Bank of America. This is going to be more a kind of Wells Fargo style loan book conversation, right?
Took the words from my mouth on this one. Net interest income is potentially going to cycle low is sort of the thought. Based on the guidance, also reflected in the estimates, though. But Wells Fargo missed on that metric, so that's perhaps going to be even weaker than expected. It's also probably
562.46.
Loan growth was somewhat disappointing across the board in all the ones that we saw, so that's going to be a pivotal piece of the conversation. Also, credit cards are a conversation with Bank of America.
562.46.
There, EPS is expected 79 cents on revenue of 25.19 billion. But like you said, probably more like a Wells Fargo, perhaps the Chase side of JP Morgan. Those were the weak parts of the three reports we got today. So the Goldman kind of investment banking, trading, that was a strong part in Citi. The more consumer banking, loan growth, provision set aside, as well as interest income, that was the weak part kind of across the board and all the ones that we heard from. So you're seeing sort of that being priced in ahead of time today.
Okay. Yeah, the quality, it seems, of the Bank of America earnings, probably we should expect them to be a little lower than JP, maybe Goldman too, especially just when it comes to the kind of core loan business. But it'll be important to see how much they set aside well for loan losses. A good-looking chart too.
I hate to undersure you, but I have 561.39.
Channel for a long time here, up 66% off the lows. Once again, also in a situation where we made new highs yesterday. We've backed off a little bit here, certainly not collapsing or anything like that here, as we touched on the upper level of our channel here. And this one is a channel. This is a parallel line. I drew a conventional trend line going across the lows, simply duplicated it, put it across the highs, matches up pretty cleanly. You'd be surprised how often that happens. Won't happen every time though, just something to keep in your trading toolbox to project potential resistance here. So now we're seeing RSI kind of sideways actually for a while here, not really making any consistent gains, but that matches up with what price has been doing recently too. So even though we have been overall trending up in our channel here, we had this period of pretty sideways movement here, and it's also highlighted by this volume node. This was a heavy trading kind of congestion area that we did work out to the upside of it. Yeah, exactly. So we
have a little bit going on right now.
Highs at this green line near just about 40 or so. Then we got an energetic breakout.
I have to give Yoko a
retested it again, and then we can
chart
in our
artist.
The upside there. So
spoke when you're speaking to. Only speak when you're spoken to. Do you understand? Okay. So we have a $200,000 bet going on. But Jimmy sees resistance at 561.39. And Yoko has resistance, which is at 562.46, which is a beautiful spot. We just broke another resistance just now. And I'm going to state that number right here in front of everybody. $560.60. Today's resistance to be bullish was 557.73. As you can tell, we're up $3 from there. Jim, how do you do it? Uh-oh. It's broadening out. It only took him a year to do it. What, 7 months? Magnificent right again. His level of intellect is astonishing. Woo! What's this here? Uh-oh. $561.39.
for the bulls. If we do break out to the upside, though, you know, that's why we look for these
TSM.
because it can be an energetic move to the upside then, possibly here. +2 channel comes in near 221. That's our orange line there. To the downside, we've got our old support. Then a confluence between our steeper trend line and our yellow 21-day EMA.
Oh, big pop today.
Yeah, Bulls salivating to hear you talk about Taiwan.
That would have been a good one to watch.
Handle on it. Does kind of seem like, though, in the short term, the chart is fairly kind of straightforward in how to think about it, because everything basically up until this point has been so constructive and positive. But after the move yesterday, it's just kind of a question is, are we going to get stuck basically in this sort of 185, 182-ish to 190 range? Does it break down? Because if not, then the only piece of concern we've had really in a long time yesterday gets unwound and we break out, and it's like business as usual.
Yeah, exactly. I mean, that's a very reasonable, logical take.
Yeah, it's kind of a short-term sort of assessment to see if this thing breaks or not. But it'll be a good one to look at next week as kind of the test for the semiconductors.
184.
Rick Ducat, Alex Coffey. A little prep for next week as earnings are the focus. Today the market is running with momentum from the small caps, but not leaving tech behind this time. That's good. It's not happening at the cost of tech. We've got the Magnificent Seven, the Big Five, whatever you wanted to say. FANGs, they're back. Tesla up almost 4%. Microsoft going green finally after being sluggish.
TSM, I got 185.59 support.
Yet, but
alert.
NVIDIA with a nice pop too. Has the NASDAQ now up almost 1%. So Qs are closing the gap with the Russell this morning. We'll market discussion. Kevin Hanks join me next.
Should have typed in 5 minute. Gotta get into the habit of doing that. Really, no, definitely on fire. Dim James by WM. You had a good trade going on there, buddy. These. Well, it's too late. They're already expired. I wonder what they've been like.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hanks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Here we go, ramping up. Tech making a stand after yesterday's drop. Diane King Hall back with us from New York. Kevin here in Chicago. Can't keep a good Robot down, Diane. They're going for the AI today.
It is true. I mean, it's so funny. I was taking a look at the market action earlier, kind of the overall market action, and we've seen these gains in small caps and seeing them continue. But now what you're seeing is, just in general, the tech play recapturing that bid after losing some ground yesterday, and investors just shaking off the PPI data and paying more attention to
235
in regard to CPI and saying, okay, this does not take our expectations off the table in terms of the path forward for Fed rate cuts, and still projecting that cut to happen in September. So it seems like it was just interesting to see that turn back to risk on in general.
Okay, Yoko, this is it.
Breaking out further than small caps and seeing the S&P 500 reclaim that 5,600 level, Oliver.
Yeah, this is a pretty good little
We're gonna do it.
rally today, participation. I mean, some of this stuff really coming back hard. We were just talking Tesla. I mean, hard not to talk about that one today, Kev.
Well, we were reporting. I mean, I talked to Ben Lichtenstein on the Future Show.
Did anybody enter the poll? Well, Howard Cosell here. After all these retirement, I thought about retirement, but then we had a stuckathon going on, and I was going to be the referee of this stuckathon. And in this corner, we got James Howard weighing in at 173 pounds. Still got a little bit of work to work on. Called SPY out at 561 pounds and 39 ounces. In the other corner, we have Yoko, native from China. He come in here with a weigh-in of what was approximately 562 pounds and 46 ounces. So Jim qualified for weight. Yep. Thank you very much. Jim qualified for weight. And Yoko's kind of sitting on his hands right now saying, break it. Break it. Come on, do it. He just turned around and just bought 1,000. Did you see that? Right there? He just raised a bid and bought 1,000 contracts. 1,000 shares. You can't do that. Break it. I don't mind if it breaks it. But it has to break 561.39. China. $561.24 is the overhead resistance. Should that number be allowed in the contest? The judges say nope, can't allow it. Unless you have proof of evidence. Oh, he's talking about sigma in here. One standard deviation from the week's mean. Uh-oh. He's talking Harvard talk. Professor Mike. I bet you are, Professor. Or you have something, some kind of something title in front of your name.
Checkmate.
Yep. Yoko really wants to see a breakout here. I'm going to give it to him if we hold the 21 EMA. And he's probably wondering what that number is. It's 560 pounds and 98 ounces. China.
China.
Don't do it. Woo! Uh-oh. The crowd's going wild here at the sports arena. Exactly. And it's 2 minutes before lunchtime. Two minutes.
Nothing for you.
And today I'm going to try something different. We don't think the game's over yet. We will decide that if we hold the 21 here. So Jimmy called the exit, or at least gave himself credit. And we're come down here and retest, because I mean it can happen. Now if that doesn't hold, I think we can drop all the way down to 560. I've got my reputation and everything built on this here weight class. I'd really like to see it hold right here and bounce up right now. No lower. Stop. Stop. We hit it. So let's see what the calls are. The let's open this there. 562s. Get out of the 560s. Okay, 562s. I don't know. To get them, it was 562 at 110. That was bad. I should have jumped in them right there. I had good 6, 8 seconds. I'd be out of the trade right now with $100. And I called it. Said we're going to come down and hit the 21. See? James, that was a good call. How'd you do that? So you get the 21 EMA, and you have the 9 EMA. So you're sitting up here watching it, waiting for it to dip below the 9 EMA, and you get ready to sit down and say, hey, Jim, I think if you wait for it to pull back and hit the 21 EMA on the 1 minute, you might be able to take this trade. So me and Ethan, we're sitting down here whittling on some wood. And I get on my laptop, hit the buy trigger once set to buy it if we hit the 21 EMA. So I had to go in there and go to the bathroom, come back out, and my thing was triggered. I got in it at 108, called it out at 106, and got out of it. Paper trade at 122, 124. Matter of 2 minutes. Perfect. Did you like that, Bob? Hey, novice, you got your ears on? What? 561.24? Hmm. So we've really got a kind of a conundrum going on here between 24 ounces and 39 ounces. I do believe we hit 38 or even 39. DXY. Let's see what's going down here. Uh-oh. Uh-oh. We just hit 39. This is going to be it. This is it. Yabba dabba do, Mike. See Blake's. How dare you? Crowd's going wild. I think that was a pretty good one right there. The 562s are now at 135. Yeah, I said that. They were at 106. 537, you know, you make a business decision. Excellent. Just beautiful. I mean, that beautiful. I don't think you understand how beautiful that was. Anybody in Apple missed that one? That gives you plenty of time. It's going to wait, it's going to pull back and hit the 21, and then I'm going to grab it. It's like 5 minutes of waiting, 8 minutes. That's the 21. I talk about how I trade them all the time. So you start to see some weakness. Then you have just one candle, maybe two, but one for sure. That has the body completely under the 9. That's it. All the rest of the candles kind of respect it a little bit. That's how we do it. All right. I think Jimmy's going to give him something to eat.
That didn't get.
I think almost every day can be a winning day. I haven't had too many red days at all. But I don't trade a lot. A lot of different stocks. I think if I did, it'd be more difficult for me.
but they want confirmation in terms of what the yield is showing, because if the yield continues to move lower and looks like it will from a technical perspective, that just creates that gap more between the Fed funds rate and what the 10-year yield is doing, and if that gap continues to grow,
I'm going to get an A+.
10-year yield moves lower and Fed fund rates does not, it just forces the Fed's hand to eventually do something, cutting probably sooner rather than later.
Yeah, so you think sooner than, so you're not thinking July, you're thinking September?
I would think later half of the year, probably, fourth quarter.
Yeah, understood. Understood. Small caps, are they interesting to you? Had a big day yesterday.
They are. So when we talk about rotation, it's sector rotation, there's also market cap rotation, and having 90% of the components of the Russell move higher clearly was an emphatic answer to that. And now, small caps have been frustrating for many people, and especially from the technical side, because we see IWM oscillating around that 200 area. But along the way now, over the last number of months, it's been forming some bullish pattern itself, and we have targets off of two of them of around 230 and 240, and now 240 will be a new all-time high. If you could zoom even further back into one of these charts, going back a number of years, IWM has done this numerous times where it's taking its time to get back up to a high, but once it does, we see some breakouts along the way. Now, it's important to understand the makeup of the small cap index as well, IWM, because two of its two biggest industry groups are regional banks and biotech, which of course have had their own issues over the last year and a half. Both clearly been making comebacks recently, and so we really think we need those two to work for IWM to keep going higher. And the interesting point about that is there are two different sides of the spectrum there, one being speculative growth, of course, and one being value.
So we got a lot of great information from you about different, you're looking at the XLK versus the S&P, and we just talked about small caps. I just want to be clear, what's the pattern of advice for investors? If you're not doing specific stocks, sectors,
Yeah, really nice.
what a portfolio should look like today.
Right, really it has to do with one on the time horizon as well. I always say that you're either going to be market agnostic and continue to invest for the long term.
You're ready to squeeze again.
These short-term patterns and try to gauge where the next rotation is going to come into. And so looking at, say, the XLK S&P 500, there's been times along the way where XLK actually underperformed for longer than we think. In fact, there's a time this year from the end of February to early May when XLK underperformed the market for 14 weeks. Didn't feel like it because the market continued higher most of that time. Only time it didn't was from that late March to mid-April pullback. So along the way, other areas have broken out. And so what I look for is the next breakout zone, right? And so looking at, for instance, the XLK financials ETF, trying to break out through a multi-year pattern. In the meantime, it's only about 10% above its peak from May 2007. So if I'm looking for rotation, looking for breakouts, that's a very interesting one to me, because once you get through a major area like that, a prior resistance point, that attracts momentum buyers, and that can really, turn the tide there, so to speak.
All right, Frank Capillari, thank you, at Cap Thesis. Good to see you, Frank. Thank you very much. Plenty more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals. Joe Tagay takes us through the trades for ASML, JP Morgan, and Amazon. Trading 360, Schwab Network, Friday. We'll be right back.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. It's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades, Joe Jagay, Rational Equity Armor Fund, with us now. Joe, what a week. I feel like we already got in
nice little bounce on the SPY and the SPX. Beautiful.
Some of your thoughts. How do you feel?
Yeah, it's been an interesting week from a trading perspective. Lots of volatility, lots of movement, but generally higher. So that's just a win-win for everyone involved. You know, last year, the market also peaked in July. So yesterday's action, maybe this is going to be a sign of things to come. We'll just have to wait and see.
If this market is going to be like this all the time,
you know, the market's had such a tremendous
it's
run up.
easy.
Before yesterday, there was all this attention. Are these mega cap stocks way overweight? Are they too big of a percentage of the index? Is that going to drive everything down if they go south? Well, at the end of the day, we just have to look at the trends of those stocks. They had big pullbacks yesterday, but the trend broadly in most of them is still higher. I think that we should be cautious. There was a warning sign yesterday. Maybe have our head on a swivel for a lot of these names, but broadly the trend is still higher in all of these names. So I think it was a nice pullback. Could be a buying opportunity, but again, it could be a warning to be careful at these levels.
Yeah, I was just looking. I mean, week to date, the S&P's up over 1%. Year to date, 18%. I mean, no one last year would have thought an 18%
I'll be right back.
year, right? I mean, that's amazing. Let's go to ASML. That is the first name you're focusing on today, Joe. Why is this one jumping out at you?
Yeah, well, it's having a fantastic run up this morning. I was looking at it, I was like, wow, this looks great. Perfect example, not one of the Mag 7, but it's riding in the coattails of NVIDIA because, of course, it makes the machine that powers NVIDIA. And I think this is just another company to play in this AI trade, another one of the manufacturers of these chips that are just going to be in demand for the foreseeable future. I saw 1050 as a previous high. Yesterday, I thought it was great that was support, and that just looked like an opportunity for me to get back in after maybe a little exuberance, just kind of trading the range. Again, that's a spot where I'd be very cautious below. Maybe I'd look at the 1050 calls as an opportunity to buy at these levels because that'll stop me out if we do trade below. But it's a name that I love for the long term. I got a little bit ahead of itself, maybe ahead of the CPI. After the CPI, it came back to earth, and maybe trading it in that fashion, I think, is the way to go.
Right, understood. And I like how you sort of tie it in with the NVIDIA story, right, and how it rides the coattails. I like that phrase. Let's look at the chart, please, Ben.
Yeah, Nicole, I think Joe's on with this 1050 level. It's the lower extreme of range that we've been in throughout most of this week. He mentioned the big run-up we're seeing here today. Let's take a look at the charts. 5-minute candle, first and foremost, and 2 areas of value that are forming at higher and higher levels. So we've got a bit of a bullish pattern playing out, and then again, Joe mentioned this 1060, I see it as 1050 area, lower extreme of this range that's holding right now. So we're building momentum through the middle, and we know that opens up a door for a retest to the upper extreme just within that phase of development, that horizontal phase that we're seeing here, and that rotational price activity. But getting a little bit of a lift here, not only on the short term, also more intermediate. We've got a 4-hour candle chart queued up here. We're going all the way back to the beginning of the year. End of last year, stock was balancing around 600. 749.70. Does look like we're trying to get something going a bit vertical here right now. Again, attempt to break out of this balance here this week with the run-up we saw to, well, up and through $1,100. Let's move away from this chart because speaking of vertical, that's what it looks like on the weekly. Look at these candles here. We've got 2 big green candles stacking up right now. We're going to look for that to continue into next week. Momentum is to the upside here as we have and continue to be trending higher, Nicole.
Okay. Thank you for that. Do you have any thoughts on the charts now that you see some more here?
Yeah, that's exactly what I was looking at. This looks beautiful to me. I've been watching this all year long, riding it up from 700. So this is a beautiful chart. Continues to make these higher highs, and hopefully we get another one. I'm just very cautious if we breach that 1050 level. Given the disruption we saw yesterday, maybe something new is happening. Apart from that, I still love it. Going with it to the long side.
Yeah. All right, next up, the banks. We've been talking a lot about them this morning already, and JP Morgan had its quarterly report. It is trading down about 1%, but always seems to be a fan favorite in the group overall. Year to date, it's up 21%, recently hit a high of 210. Some of your thoughts there?
Yeah, just a fantastic stock, fantastic chart. I love it. I love that it broke above 205. I love that we're back above 205 right now, even after the earnings. So I think that's kind of an important level for me. I'll be watching that closely, but I just like it to the long side. I think, Jamie Dimon, most people think you talk your book on these earnings events. That's not necessarily his book, that it's going to be higher inflation and higher rates. Most banks like low inflation and lower rates so they can, capitalize on that spread. But maybe it is his book in the sense that JP Morgan is so much better than these other banks at managing all this that they're just going to continue to outperform in these tricky environments for the rest of the banks. So I think they just have that competitive advantage. They're going to win if rates do fall. They're going to win if rates don't fall. So JP Morgan and JP is the bank for me to own.
You said you love it as long as it's holding 205. I guess there's some risk to the downside. Let's see Ben's chart. Ben?
Yeah, the numbers to me were described as winner, loser, and kind of something in between. And JP Morgan definitely fell into that winner category. Stock has been and continues to be enjoying gains, rewarding the bulls, the longs that have been sticking with this one. Let's just look at some of the intraday price activity first and foremost. We did get a bit of a spike initially in reaction to earnings, and we've been kind of hanging out around this 208.
See if you're still in the trade.
Just below 210, above 205, and you can see currently trading around 206. Stepping away from the...
As you can tell, it's the 9. I started disrespecting the 9, and then the 9 starting to disrespect the 21. So you're at the fake out time, or you're at the time where you already got out of the trade.
Chart now, we're stepping away from the hourly into a daily, and we're going all the way back to when we were trading back in October of 2022 around that 110, 115 level. Look at this, 3 really well-defined areas of consolidation that are formed. Now, this I'm not quite sure if we're in a vertical phase breaking out here. It's a little bit different than that last example that we looked at. We're starting to see something a little bit more overlapping, kind of rotational play out, but a bullish pattern nonetheless here. No rejection of the upper level as of yet. It looks like, again, that the longs are still in control, Nicole.
Yeah. You know, what's interesting is I'm looking at this chart, and then I look at the Thinkorswim here. You know, the August, September, October, it was sort of boring there, and then it ran up, and then it sort of had this gap down in the last earnings season. So, you know, my dad loved financials, right? The generations before us always went for the financials. They were dividend payers, and, but it's not that they always perform. But let's hear Joe's final thought.
Yeah, I'm glad that we agree that it's a bullish chart. Just a company
Morgan.
Just trust leadership, and it's good to have a bank in your portfolio, to say the least. For me, at least, it's great to have some diversification. Everyone's talking about AI, but we need to think about the banks still. And for me, JP Morgan is the one to own.
Yeah, well, speaking of winners, how about Amazon? It's up 50% in 1 year, hitting highs of 201 recently. Some of your thoughts there. That's been a clear winner.
Yeah, so, Jamie Dimon's talking about the stubborn economy, this inflation that's persisting. A lot of confusing thoughts of why that might be true. Usually when you get these interest rates so high, it's going to slow everything to a halt. Well, usually we don't have government spending as much as the government is spending, which might be why the economy is just continuing to hum along. And that's going to be the benefit of retailers like Amazon. They're also going to be benefiting from the AI adaptation with AWS. So I just love it. I love that it was able to hold on to its level of 192 yesterday. Got hit, of course, yesterday with a lot of the mega cap tech, but I think this is just another opportunity to get in gear with Amazon. I love it to the upside. I love it for the future. It keeps on coming up with new things, driving its revenue, and I don't expect that to stop anytime soon.
Yeah. And look, I think we're waiting on the next Prime Day, too, right? Another catalyst. Let's see what Ben has to say about the charts.
Yeah, that 192 level Joe just mentioned was the end of June low. It was significant that it held. Let's begin first and foremost. We'll look at the more granular, more intraday price activity, the selling we saw yesterday, and how Amazon really has yet to recover, right? We were talking about ASML and some of the rebound we've seen there. This one still kind of hanging out around this 195 level. There's the low that Joe just mentioned, and you can see balance forming, right? Overlapping, sideways, random, not a lot of conviction simply put. The conviction on this chart happened during the day yesterday, right? That move lower. And then even within that big move, you can see a couple of areas where the market consolidated and sort of regained composure along the way down, sort of reassured itself that that was the correct trajectory. Now, you can also see that that was an intermediate, possibly a longer-term buy opportunity. As that area Joe just mentioned, again, 192, that was the lower extreme of this range we've been in over the last couple weeks. After breaking out of the balance and formed around 185, the market lost some of that momentum to the upside, topping out around 200, and has been somewhat rotational. Lack of conviction, but with value moving higher, we give the benefit of the doubt to the bulls. We expect that to continue rather than change, and you can see that, well, the reason why, because off the October lows, that's definitely been playing out. 118 is where he bottomed out there. If you remember, balance around 130, 150, 180, again around this 197 level. Here is what we're talking about, that lower extreme of the range that we're forming. I'd expect this to widen out at some point, but yeah, right now everything above 180 is still a very bullish here pattern playing.
All right, that was a good finale there. The narrow range we're in right now, but we're holding above 180. That's good news for Amazon, and we'll leave it right there. Thank you both for the big three today. We looked at ASML, JP Morgan, Amazon. Thank you. Joe Tegay of Rational Equity Armor Fund, and our own Ben Lichtenstein there on the charts. Thank you both. Coming up, how about we spotlight those movie theater names, gaming stocks? We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. All so you can trade brilliantly.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was hurt, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the New York Stock Exchange. I want to spotlight some of the movie theater and gaming stocks. Chad Bainman's with us of Macquarie U.S. Equity Research to talk about these names. I know IMAX is a top pick, but let's just talk about the big picture. The theaters. Good news, bad news? I mean, the last big one I feel like was Top Gun Maverick. Were there big movies that I missed? I'm sure there were. Let's hear what's going on in the movie world.
Thanks, Nicole. You didn't miss anything in April and May.
April and May results were actually very weak compared to prior periods pre-COVID and just kind of going back over the past 10 or 15 years. What we did see in June was some really nice green shoots and some positive performance with two big, family-friendly movies, Inside Out and Despicable Me. So that type of customer is coming back to the box office, and June looked really good. That said, compared to pre-pandemic levels, Q2 is still going to be significantly below what we had seen during those periods, over 25% below those periods. So the negative operating leverage, given rents, given fixed costs, given inflation, will certainly put pressure on the group. As we look at the back half, now that we have more movies post the writers and actors strike, we are pretty positive here. July is historically a month where you see some big blockbusters, but then it's really Q4 where you see a lot of the stuff that hopefully you and I are separately going out and paying money to these companies.
Notes that 2025 could be a nice time and rebound for these movie theaters. We think of names like IMAX, like Cinemark, AMC. I think AMC is in a different category. I mean, what are the top names that you're following? RGC would be in there. IMAX is the top pick in your mind. Is that a buy?
It is. IMAX, we're at $24 price target. This stock has moved up during times when China is strong, when there was a little bit of rotation away from some of these traditional exhibitor names. IMAX doesn't have leverage. They don't really have the expenses that traditional exhibitors bear with labor and service. So it really is a tech company that usually falls into the coverage of people like myself and some of my competitors. So it's sometimes unfairly valued in our view. China looks pretty good in terms of digital projectors that are going to be delivered in the back half of 2024 and then 2025 and 2026. So this is a company that should have unit growth in the double digits, and then you hopefully have a flat to slightly up box office with a lot of operating leverage. So we have this name trading below 15 times earnings, and despite the company growing mid to high single digits for the next couple years.
I see also Macquarie has the price target Cinemark Holdings. You adjusted that to $24, up from $21 with an outperform rating. So I'll leave that. I do, just before I move on to gaming and gambling, I just wanted to ask you about AMC. When people think about AMC, if they think about trading AMC, what do you tell them?
AMC raised a lot of equity again in the past couple months. So they essentially brought on 25% dilution to prior shareholders, and this was done at prices between $3 or $4 per share. They're still in the cash hemorrhaging phase. We project them to lose money again in the second quarter. I think EBITDA will be positive, but with CapEx and some interest payments there, they're going to hemorrhage some money. So they took the opportunity for a resurged meme rally to raise some money here to put the company in good position. They're never going to have the margins that a Cinemark or some of the other peers have, just because their business model has more exposure to urban markets, higher rents, higher labor. I don't think it's the right time to kind of double down on
5 minutes, you're still above
like
9.
So we will remain sell rating on that. That said, when we saw the Royal Kitty moves, there were a few days where AMC shares were strong and then it would sell back off. But yeah, fundamentally, it still remains a pretty weak picture. Nice to see them raise equity, and we'll see what they have to say in terms of other initiatives like selling popcorn and doing more with Taylor Swift types of movies that they benefited from in Q4.
You hit the nail on the head, because I was going to ask you, I don't understand. Popcorn's popcorn. Why does one do so much better than the other? But you answered the question. They're in the big cities. The rent is, I live in Manhattan. It's expensive, right? Labor's expensive, and it's just hard to ever catch up.
We're going to know in a second.
With those outside the cities or in cheaper areas. Let's move on to the casinos. Tell me about some of the best positioned gaming stocks in your opinion.
Sure. From a value standpoint, we really like Wynn Resorts. So this is a company with exposure to Las Vegas, Macau, and
Really?
Boston. They have a proposal to build a property in Manhattan, and they're also underway building something in the Middle East. They are, the luxury of luxury within the category, and I think that consumer remains strong. Vegas has done very well post-pandemic here. That luxury customer is willing to spend over 50% more for high-quality service and win leads the market there. So I think Q2 will look good. That said, Macau has come in a little bit weaker than expected, given some China consumption data that we've been able to gather. But that said, we really like Wynn at these levels. Also with Las Vegas exposure is MGM. MGM has rallied a little bit more in the past 3 months. We have MGM up in the past month, MGM's up 12%, yet Wynn's down 19% just in the last month. So there has been a little bit of rotation over to MGM. I don't think it's a super crowded trade, but they have benefited in the past month there. IAC still owns 20% of the company, so you have shareholders that want them to continue to move towards a digital strategy, but you have the Vegas and the Macau exposure. So Wynn and MGM are probably the top two names in terms of land-based, and then DraftKings, we do like that into the print here. We have a $54 price target on DraftKings. Stock sold off a little bit. There's not a lot going on right now.
Double bottom.
Betting, you had the Euros, the
might be a buy here.
Buzz, and then the Olympics coming up. But generally,
WYNN
baseball season kind of falls off a little bit, and then it picks back up when you have NFL. So I expect for them to maintain revenue guidance, maybe even raise guidance. There was a slight tax increase in one of their big markets, so that put pressure on EBITDA. But I do like DraftKings here, DKNG, on the pullback that we've seen in the past couple weeks.
$54 target. So people are spending in Vegas, to your point, the luxury spenders are spending 50% more.
You can drop a little more.
Macau sounds a little tepid right now. Do you expect things to change there? I mean, are they in a bad state, or is it just like a pause? I mean, what do I tell folks when they say, how's Macau in the next 6 months?
Macau's always been a tricky market because their premium or VIP customers are spending significantly higher than what people spend in Las Vegas. So when there's pressure around, movement of currency or movement of people from a visa perspective, that really hits the model. Those properties are extremely expensive to operate, just given the inflation that we've seen over the past 20 years. Q2 was down about 2% versus Q1 for the market. That's historically what we've seen, but most of us were expecting for things to inflect here and go positive. So that's kind of why the Hong Kong listed names and US listed names with Macau exposure have sold off. But I do think that's priced in, right? You have Wynn trading at 8 times EBITDA, a mid-teens PE multiple. So, that's kind of why I frame it more of a value name. I think if we hear any China positive data points here, these names will move quickly.
Yes, they will.
Thank you so much. Chad Bayman, great to see you.
China.
U.S. Equity Research. I'm still waiting to see how these casinos win out in New York City. I mean, it's been a long battle, and I know the big real estate companies are battling out and putting proposals. So we'll have to have you on as that develops. Thanks, Chad.
Novice, can you hear me? Raise your hand.
The disruptors will focus on Seagate. Got a bullish note from Citi.
Seagate.
To know, and an example trade next.
Wind can pull back and then you want to buy it. Maybe swing it overnight. Jimmy will wait on when. He don't know when. But when it happens, he'll tell you when. WYNN. Yep. The trend is your friend.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest
Oliver.
coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device for free. Only on the Schwab Network.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Ethan! How's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends?
All that research sounds exhausting. Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Tesla back to the top.
Trading 360. I'm Nicole.
Tesla back to the top.
Floor of the New York Stock Exchange. Glad you're with us. Let's bring in Diane King Hall, senior markets correspondent, to talk about one of the biggest stocks this week.
Tesla double top, yay.
From Tesla, because Tesla was an incredible winner this month.
Oh, funny. She's talking about it.
Pullback on the news of delays and everything getting pushed back, and now a sell.
She does not like to be delayed.
That's right. It was slapped with a sell rating today by UBS. UBS downgraded Tesla to sell from a neutral. They now have a price target of $197 a share. But what's interesting is what has occurred throughout the
Who are these people?
Initially, the stock lost more ground, adding to the loss that we saw yesterday, but it has reversed and at least for now managed to shake off those worries that were earlier hitting the stock. But here's the concern from UBS. They say they believe that where the valuation is now, there's a premium placed on it because of this kind of future AI play. And Elon Musk has insisted that Tesla is more than just a car company. So yes, okay, the street believes that now, especially with the robo-taxi event, and even investors shaking off the concerns about the delay in terms of that event to October now because Musk wants to build more time to, create more prototypes. But here's what UBS says. Okay, they say, look, if this is more than a car company, if it's an AI company, they don't believe that the future valuation based on its growth trajectory merits the level that this, they say given this, valuation that they would be looking for a 5-year future value of $1 trillion. And they don't believe that they can't see where the growth is for Tesla and that lack of visibility. And they also just talked about the risk that Tesla faces. So initially, the stock did lose some ground.
So if it was a car company, it'd be worth it. But if it's not a car company, it's a tech company. Oh no. Market cap's way too high. They're making it up.
The gains, the stock was up over 40% in a month. It was super exciting, took a pause, but to your point, they're buying it back, and even with that disastrous move, it was a $30 swing yesterday. But still today, The week to date, while we're talking, just turn positive.
Exactly.
Okay, so just like nothing happened all week. We know it happened, and you know it happened because we had to endure it. But it's been busy. Thank you for that, Diane Hall. Great to see you. Let's turn our attention over to the disruptors. George Sillis is with us.
I'm a disruptor.
Here, taking a look at Seagate, getting a bullish note over at Citi. Some of your thoughts there, George, please.
Let's see.
Well, I mean, if you look at Seagate, this has been a really good performer over the last year, up about 77%. It's just trending slowly to the upside, and it really has to do with what's going on with their core business, which is storage solutions. They have, traditional hard disk drives for computers and servers, and we know those are hot items right now when it comes to artificial intelligence. But the cloud computing and cloud storage needs and artificial intelligence applications, which run on periphery systems on devices, that's where I think the growth for Seagate is. And if you look at the earnings estimates, they continue to inch higher for this year, 2024, as well as for next year, 2025, where the stock is trading around 18 times earnings. So it looks like recently a lot of the analysts have increased their target estimates for next year. And so with that said, you're starting to see prices move alongside price increases, if you will, alongside an increase in the underlying stock price as well, with the trading, like I said, 18 times earnings. So Citigroup actually upgraded the stock in terms of their price target from 110 to 120. And it has to do with the fact that I think if you look at the application needs for artificial intelligence in the cloud, they need random access memory, which we talk about Micron from a high performance standpoint is in high demand right now. But at the same time, you need storage solutions. And I think this is essentially a name that is in line with all the hardware names for artificial intelligence going forward. And going, like I said, forward, you just compare the numbers for 2024, they're estimated to earn only 96 cents, but next year it's close to $6 a share. So they're 5xing their increase in earnings, and that's based upon demand and firm prices, by the way, which is across the board in the memory and storage markets, including Micron, SK Hynix, which is a major Korean supplier, as well as Seagate.
So at this point now, I mean, it's an incredible chart. It's a beautiful chart, right? It went from $57 up to 108, right? 1 year up 75%. So let's talk about an example trade, please, George.
Yeah, so the pace of the trend is important here because you'll note that it's a very moderate trend. It's obviously higher, but it's really steady, and that's a good thing. So to capitalize on that, we have to consider a couple factors. One, there's earnings coming out for the company on the 24th of this month, so in about 12 days. And then the second thing is, if you look on the chart, around $106, that was a previous high that the stock put in going back to mid-June. So it's breaking to new 52-week highs. So it's still bullish, but we're going to capitalize on high implied volatility going into earnings with a bullish construct. So what I'm going to do is put together or structure a long call diagonal spread. So I'm going to sell the out of the money 115 call that expires in 2 weeks. That's 2 days after the earnings event. And then I'm going to use the proceeds, which are expensive, to finance an in the money 105 August monthly call option. So altogether, this is structured for about $4.50 a share in debit, or $450 a contract. So the whole premise here is we'd like to see the stock essentially stay within the confines of the 115 strike by expiration in 2 weeks, to which time the stock is unbounded, or the option is unbounded with unlimited profitability. But if you do hold this trade, you need it. You do hold it through August. Break even is around 109.50.
Tesla
so
254.
But you know exactly
50?
what you're outlaying, which is $4.50 a share, and that's your maximum risk.
All right, thank you for that. Appreciate it. A good look there at Seagate today. Appreciate it. George Sillis with our disruptor every
George.
here on Trading 360. Coming up next, we'll break down this morning's PPI print. Came in a little hotter, right, up 0.2% in June. That was ahead of the estimates yesterday. Came in a little softer on the CPI. Let's go through some of the economic prints. What do we need to know about inflation? Our panel is ready.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Ethan! How's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on Next Gen Investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. It's time for the 360 round. We're diving into this morning's PPI inflation print. Right? We got to look at this. We had to look at the CPI and what will the Fed do or not do. Joining me is the panel. Now we have Sal Nero with us, Chief Investment Officer, Coherence Credit Strategies, Tiptree Advisors. John Lear is with us, Chief Economist at Morning Consult. Thank you both. John, I'll start with you. You know, with the CPI yesterday, that was a little softer. Everybody said, yeah, but it's really all energy, because it was energy that came down. You know, food prices, apparel, and gasoline. I'm sorry, you know, some of the other things were still higher, so, you know, was it what it really seemed? Are we getting what things really seem, or we have to read through these numbers?
I think it's important to always read through the numbers. I think yesterday what we saw from CPI is that some of those goods categories that had jumped higher historically continue to fall back down. Used cars was one example. I think from the perspective of policymakers like the Fed, you know, it's that core services excluding housing that is the central question for them as they think about sort of how to position monetary policy. What we saw today from the PPI is that services sector, the input cost, continue to rise at elevated rates. And so I do think it sort of throws some cold water on this notion that we'll get some immaculate disinflation overnight. I think it's going to be a longer process with inflation remaining above the Fed's 2% target for longer. And so we're likely to see sort of fewer cuts this year as opposed to, I think the market now is pricing in 2 or 3.
Yeah, Sal, what did you make of it?
Yeah, I would agree. I think that the Fed wants to continue to organize the soft landing. And I believe that while the Fed should cut this month in July, they won't. They'll wait till September. They'll do 50 basis points, and they'll be one and done for the year. GDP is sort of down at 1.4, 1.5, and they want to stay ahead of the trend.
Well,
it makes me so happy to hear.
Basis point.
It's so great to hear an investment strategist say that they are only expecting one rate cut this year, because I do think there's so many folks out there who are still hoping and wishing that they get 2 or 3, which is why that's kind of become their base case, but it just isn't in the data.
Yeah, look, 1 at 50 basis points could be similar to 2 or 3, right? I mean, 50 basis points versus 25. I mean, you know, sort of rip the Band-Aid off. Why do you think that they need to do that, Sal?
Well, if you look at the yield curve right now, 2s and 10s are inverted by 28 basis points. They were inverted by 50. So the curve is actually rallying. The front end is still very high. Fed funds really should be at 4 3/4 to 5%. A 50 basis point cut is not going to materially change inflation to the negative. and it's going to substantially help certain industries like regional banks, commercial banks, residential banks for mortgages, home builders, credit card providers, autos, auto loans, subprime, specialty finance, and especially also triple C high yield. So this cut is needed. It'll keep the Fed ahead of the curve. ECB's already cut, and so we're kind of just at the margin, and they want to stay ahead of it. So I think that's what they're going to do. One and done in September.
So I was looking at that narrowest inverted gap, on this curve since January. So you make a good point. I noticed that this morning too. John, just a final quick thought: is the consumer strapped or no?
Well, it depends who you ask. And so at the high end of the income spectrum, we see consumers still have some room in their wallets. Middle and low income groups, anyone under $100,000 a year in income, they are strapped. They've taken on more debt. We see that in the delinquency data. We see that in a lot of the housing data as well. And so this is a really challenging time for policymakers to sort of adopt a one-size-fits-all approach when there's so many underlying differences in economic experiences across the country.
Starbucks starting turn.
Sal Nero, Tiptree, John Lear, Morning Consult. Great to see both. Thank you. That's going to do it for us here on Trading.
Price target $98 from Morgan Stanley.
The watch list. Join me then. In the meantime, keep it right here. Fast Market is next.
Be part of the latest commodities.
Tough China sales.
Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available
Drink a lot of tea.
on any device for free.
Coffee? China people?
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was her, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Accelerate your market knowledge
and shift your perspective into full view. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network. afternoon, traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including discussions and option strategies. We're going to take a look at Goldman Sachs, which is near all-time highs, into their earnings on Monday morning, and Apple, which is up about 19% so far this year and is once again the world's most valuable company. And like Folio, it's going to break down consumer sentiment data in Tesla, which is higher after dumping over 8% yesterday and got downgraded also today by UBS. Now let's take a look at the major indices, which are off recession highs, but all firmly in the green as this rally kind of broadens out here a little bit. The S&P 500 up 0.75%. Same for the Dow. NASDAQ up 0.8%, and leading to the upside for the second day in a row. The Russell 2000, after gaining over 3.5% yesterday, up another 1.25% today. To help me break down this market action, let's bring in my co-host. That's Kevin Hinks. Kevin, let's kind of just go through the choppiness that we've seen over the last couple of sessions. Rotation trade coming in to play big. Russell 2000, as I mentioned, up nearly 3.6% yesterday. And the rally seems to be broadening where they're rolling out of tech into some other names.
The answer to that is yes, so far this morning, right?
Yes.
But as we know in this business, and especially on a Friday in the summer, this day's not over yet. Right. So yes, a good start to the trading day on, I talk all the time with Ben Lichtenstein, with Oliver Rennick on this show. The market reactions to PPI just aren't the same as CPI. And that's a good thing, Tom.
Right.
Because that was a horrible number from PPI.
Yeah, it was inflation.
Horrible number and revisions.
Right.
That were all strong. So that being said, bonds haven't moved.
Right.
The dollar's lower because of the yen. They're pressuring the yen a little higher. That's putting a little bit of pressure on the dollar. But this is, it feels like a day where it's low information, low attendance trading, where the markets just saw that, hard sell-off yesterday, and now it's drifting. So I really want to watch how it plays out the rest of the day, because I thought there'd be more. Where I'm dead wrong today is I thought there'd be more follow-through on the NASDAQ. I thought that weakness would say, nice downgrade in Tesla today, huh?
Yeah.
Stock's up $8.
Yeah.
Ouch.
We're going to talk about
that. Doesn't look good on a resume.
Later in the show, but you mentioned the dollar at 1 month lows today, and those 10-year yields, maybe that move yesterday, where it hit the lowest level since March 13th.
Was harsh.
Yeah, was harsh, but it lended support to the small caps and some of the beaten down names in the equity market. But now let's bring in our next guest. It's going to be Joe Mazzola, head trading and derivative strategist at Charles Schwab. Joe, I wanted to get your take here on the market action because earlier in the week we talked about markets getting overbought. The S&P 500 RSI was above 81 just a couple days ago. Sell-off, little correction yesterday, but right back at it today. RSI is 73. Joe, just give me your take here on the optimism in the overall equity market and what that means for investors, because this can't keep going on where we're up, 17, 18% in 6 months, 6.5 months into a year. It can't continue into that year, can it?
Yesterday was a fascinating day, guys. When you looked at, what happened kind of below the surface, S&P was down, 80 basis points, right? So not even a full 1%. You guys realize we haven't had a 2% move down in the S&P 500 in over a year? It's just so much of these, intraday kind of short moves that haven't had a lot of sustainability, at least on the downside. And it's kind of priced in. If you look at a market where it continues to chug higher, and like I said yesterday, some of those moves that we saw, those rotational moves, those don't happen very often. Those are a few days out of the year. I get excited when I see things like that. I wouldn't be surprised, Kevin, kind of going to your point a little bit earlier, if we do see more of that continue, it might come in fits and starts. I would have expected, like you, a little bit more of a follow through today, but small caps are still up and they're still outperforming today. They're up 6% on the week. And if you look at kind of what's happened with the breadth, it's really massively widened out. Last week we were looking at an S&P 500 and you were looking at the components, and only maybe about 42 to 43% of the components were above their 50-day moving average. Today it's 70%. Like, those are massive rotational moves where, the other 493 or so, they're starting to really pick up. And that could, that could bode very well for markets going forward. And that doesn't mean necessarily that you have to have a massive catch down trade. We're starting to get that catch up trade. A lot of it's contingent upon, the data that we got yesterday, the CPI. I realize today's number from the PPI kind of gives a mixed picture, but I will say this. This is what I think we need to be paying attention to, maybe not the next month or two, but as we move in towards kind of the end of the year, if you continue to see, that kind of disconnect between the PPI and CPI, what that tells me is that you're going to be looking at firms that don't have the same type of pricing power, right? They aren't able to pass on those costs to consumers. So it's probably not going to hit this earnings cycle, but it might hit the next earnings cycle when we start talking about profit margins and what that could mean for maybe top line growth and even bottom line growth kind of going forward into 2025.
Yeah, you mentioned that. Kevin and I talked about that earlier with Nate Peterson from Skipper, that basically, we've got it right here, the S&P 500, the percentage of companies above their 50-day moving average, that was 42% just 3 sessions ago, now up to 70%. So it kind of goes into that broad-based momentum that we're seeing, Kevin, with the small caps catching a bid. Some of the Dow names also, 9 out of the 11 S&P 500 sectors in the green today. But that PPI data, I saw those numbers come out, and then the revisions, and I'm watching futures, and I'm waiting for them to crack. I'm waiting for them to crack, and they didn't. And the market, if that would have been a worse than expected number, if those PPI data points would have been lower, then the market would have grabbed a hold of it and said, oh, look at the PPI data. That's going to flow into the CPI. And that's good, right? But it was the opposite, where it was above expectations, and they just kind of largely ignored it.
Yeah, I'll give you the facts from watching these markets for as long as I have. And why? I'm not sure why. Yeah. But the markets just don't react to PPI like they do CPI.
Unless it's the way they want it.
It's just a muted reaction. Yeah. And don't discount the market's ability to ignore data it doesn't like. It's been doing that for quite a long time. But this is still a market. Remember, I hate to pound the table on this all the time, but it's mid-July. It's the middle of the slow summer, and there's less eyeballs on the market, and these markets are thin. Look at the whips we had. Yeah. Just intraday yesterday, we've already had some today. So these markets are thin, and so lower your expectations on what that means, because it's a double-edged sword. They can run out of gas, or there could be nothing there to stop them. Thin markets are unpredictable.
Yeah, and Joe, we had earnings season unofficially kick off this morning with a lot of the financials. What was your takeaway? Because Wells Fargo is getting smacked on that net interest income number that was below expectations or what the street expected, but JP Morgan's came in line. These stocks are at multi-month or multi-year or all-time highs. Does it give you any indication for earnings season? Because I think that's going to be the next catalyst, is that earnings, they better meet expectations, because we're at pretty lofty levels on a lot of names.
Those JP Morgan numbers were actually really, really good.
Yeah.
And, initially that move was to the downside. It's caught back up a little bit now. But the expectations are high. But I think if you look at maybe the overall earnings expectations, it's for about 9% year-over-year growth for this quarter. But kind of stripping out the financial sector, it's around 4.2. So maybe out of the 11 sectors, I think they're ranked 7th or 8th in terms of year-over-year growth. So the expectations for financials weren't as high as maybe some of the other sectors out there in terms of their year-over-year earnings growth. However, the moves in those stocks up to this point have been pretty darn good, leading up to this, these dates here, because one of the stocks we're going to talk about here coming up is Goldman Sachs. It's already up 25% year to date. JP Morgan's already had a big move. These stocks were trading at year to date, or in some cases all-time highs, coming into this earnings season. So It's one of those, yes, you can beat. Yes, the guidance better be pretty good, but it actually better be really, really good given the expectations and the moves that we've already had. A couple of things that kind of stood out a little bit. The JP Morgan's announcement, they're seeing definitely pick up again in investment banking activity, which I think was important. We'll be looking for that in terms of the Goldman Sachs announcement, but that is starting to kind of ramp back up. The net interest income, that dynamic is going to be in play as, if we start to see a Fed that starts to cut rates a little bit, so we'll have to keep an eye on that for the next quarter. But everything from their report looked pretty darn good. I just think the expectations coming into it were a bit lofty.
Yeah. Wells Fargo too. I mean, they did. Other parts of their business did do well, but the net interest income was big. Citigroup down about 1.3% today, but just going into earnings, that was on multi-year highs too. Going into that report, so the bar is high here, Kevin, and I think that's the takeaway from it. But if you look at some of the other stories that are out there, you mentioned the Tesla rebound. We're going to talk about that later. But then NVIDIA still up 1.6%, and that's having a solid rebound, and that's lending support to probably keeping up the Nasdaq. You mentioned you thought you'd see some follow through on that Nasdaq downturn that we saw yesterday of over 2%, but that's righting the ship a little bit.
Like I said, I think that this is a really interesting trading day, and I'm watching. It's almost down to now, Tom. I'm watching the 1 minute charts to see if these rallies hold, and these things are keeping pace, and you just keep watching and you keep trading and you keep staying involved in them and making adjustments. But this market that we're in right now, it insists, it demands that you be patient. Right, and people that are impatient, it probably costs you a little bit. You got to wait to roll to the ultimate level, and you got to be patient on your entries and your exits and scale, and you've got to use all the tools right now to do this. The volumes are there, and the movement is there, but this is really calling on all your powers, let's put it that way, to get through these days.
Yeah. Hey, Joe, and where's the risk to you, for you, in the overall market? Is it to the upside or the downside? I wrote something earlier this week that, what's the risk for the markets here when you're at all-time highs, you're going into earnings season, the expectations for Fed rate cuts for September have ramped up to where it's almost locked in at this point. You've got earnings season starting. You got Netflix next week. There's a couple of other big names, some retail sales data. Where's the risk to the market? What should investors and traders be looking at right here?
Well, let me tell you what traders are looking at right now, just in terms of what we're seeing in the options market. We're still not seeing hedging to levels that you normally might expect heading into an earnings season, and I think that's important. Like I said, given the fact it's been 348 days since the S&P has declined at least 2%. So what that means is the spread between implied vol and realized vol, even though we look at the VIX and we say, hey, it's trading at 12.25, why is it so low heading into an earnings event? Well, the bottom line is you haven't had a 2% move to justify paying for that type of protection. And we're still not seeing it in the market. If anything, what we still continue to see in the options market is we're still seeing people paying for the upside call skew, and that continues to play out. Now, on a day like yesterday, right, where you're long stock and long upside calls, that hurts, especially in the tech sector. Maybe we start to see a little bit of that unwind. Maybe we start to see some people kind of, sell out of some of that upside. Haven't seen it yet, but that'd be something I'd be kind of keeping an eye on in terms of the risk. The risk is that there's a lot of this upside call skew, and if we do start to see, the Nasdaq continue to pull back and roll over, a lot of people are going to have to be unloading those positions at the same time.
Yeah, VIX 12.25 on a lazy up day Friday, just annihilating.
Right, and you mentioned 348 days without the S&P seeing a $2% pullback. That was yesterday's 0.88% move down in the S&P 500. That was the biggest move that we've seen in 2 months for a downside.
It's not going to induce anyone to buy any volatility. Like I said, that's one of the things I was watching yesterday to see if this sell-off had legs is what's happening with the VIX. VIX never really got above 13, but only for a short time, and today just hammered back down low.
Yeah, and you wonder about the impact of 0 days to expiration option trading right now.
Sure.
And people are using those, the volume's exploding on those for these gamma squeezes and in these gamma type moves. They can actually hedge using those 0 days to expiration options, and I think that's part of the reason why you're probably not seeing a lot of involvement in the S&P 500 options, which is computated into the VIX. Guys, let's take a quick break. When we come back, we're going to talk Goldman Sachs. The investment bank stock is up about 25% so far this year into earnings, just at all-time highs. Stick around. Fast Market's coming right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. We're talking more earnings in the financial sector. We're going to take a look at Goldman Sachs here. Kev, I'll go to you first here. Stock, as I mentioned, up 25% this year. I'm calling this a wheelhouse quarter for an investment bank because if you take a look at, the silos of revenue generation, whether it's market making, trading activity, wealth management, M&A activity picking up, this might be right in the wheelhouse of Goldman Sachs, and that's why it's sitting at all-time highs.
Goldman Sachs is a big investment bank, but they're also very lean and agile, and they move quickly. Like when things don't work, like Marcus, they get out, right?
They're trying to get out right now.
They
right?
risk manage and they exit things that they take calculated bets and then they get out. So what they're doing right now that's showing up in the price of their stock, they're refocusing on investment banking and trading. And that is starting to show up in the numbers. So the revenue growth in investment banking for first quarter was up 33% year over year. So this is a company that is getting back to their roots and what they do well, and that's investment banking and trading.
Joe, when you look at this stock, it's been pretty resilient. And as I mentioned, is this the type of environment where you got equity markets at all-time highs, wealth getting created across the board that is right in the wheelhouse of Goldman going into these earnings?
I mean, it is. And if you look at how they crushed their last earnings report, and the stock's up $80 since that point. I mean, I guess the question is really how much of that's priced in, right? And I've kind of looked at J.P. Morgan as maybe a little bit of a guide in coming up with this trade. But it's interesting because look, they're on board to announce earnings on Monday. The expectations $8.35 a share on revenue of $12.35 billion. And as I mentioned, that they crushed the earnings estimate last quarter. I think that the thing that's interesting to me from an analyst expectation is what we've seen, not just with Goldman Sachs, but the whole kind of financial services sector, and then also just the market as a whole moving into these Q2 earnings estimates, they've actually gone up. And that's interesting because what we tend to see is a little bit of a downdraft in terms of analyst expectations as we're moving into the last couple of weeks into earnings. And that lowers the bar, and
okay, he's back.
Many times over, when that bar gets lowered and you jump over that bar, you tend to get rewarded, especially if the forecast going forward is good. It's a little bit of an opposite right now for Goldman Sachs because their analyst expectations have actually ratcheted up in the last couple of weeks, and I think that's interesting. To me, it's going to come down to mergers and acquisitions. What are we seeing so far in the investment banking space? Kevin mentioned that the expectations are for about 34% year-over-year growth. That's phenomenal. If they get that, I think they'll be rewarded. The question is how much of that is already priced in. When you look at what we've seen on the shares right now, they just recently broke out of a range, that 440 to 470 range. And then, so are we going to be pushing up into a new range? Or are we going to kind of be coming back and testing that? And that's really going to come down to what they have to say for the earnings. But when I look at it technically, it still looks pretty strong. There's a little bit of an RSI divergence where, if you look back where we had the first big move up into that range, the RSI was up well over 74, 75, and here we are setting all-time highs with the RSI around 68.
Goldman Sachs.
So there's some divergence there. But fundamentally, I know we talked about the fact that price to book was a little bit higher than where it's normally traded, but you're still looking at a stock that's trading at 18 times forward earnings, and then a PEG ratio of 0.82. So if the expectations for those growth rates continue, it's not an expensive stock. I just think it really comes down to what we see from the investment banking business and the trading revenues.
Yeah, and Joe, because earnings aren't until Monday morning, we've gotten a market maker move, but the anticipated, on my, pencil math, about plus or minus $14, $15 either way in the shares. How do you want to look at this one from an example trade?
Well, I think if you believe that a lot of this is already priced in, and I think that, you're going to have to make that decision as an investor or a trader. You can sell some upside calls and sell a call spread at this point. You can sell the 500, 505 call. You should be able to get anywhere between, 105 to 110 right now.
Just has got some volume.
July 19th expiration next week. I'm looking at the following week, the July 26th. And I'm doing that because it gives, maybe the shares a little bit of a corrective time in case it does get a big move one way or the other to kind of maybe move back towards, what we would consider maybe a little bit more of a median or an average move. And if you're looking out towards kind of the expectations for the move for that July 26th expiration, it's around $20 to $22. And kind of given where we're at right now, if you sell that 500 call and buy the 505 call, sell that call vertical for around $110, that's going to put you pretty darn close to that break even at this point. It's not necessarily what I would call a bearish trade. It's just it's a trade where you're questioning how much of the anticipation of the move is already built in, and will that realized move pay off the implied move that's built into the options pricing right now.
All right, let's break this one down. July 26th weekly cycle, so you're giving yourself 14 days to expiration. It's not a pure earnings play here, but selling the 500 call by the 505 call, collecting. We've got a $1.05 credit there up on the screen, so that means you've got $395 in risk on this one, Kev. But you got a cushion of $20 to the upside on this one over the next 2 weeks, Kev.
76% probability of finishing out of the money. So 2 weeks out, 14 days, it's not an earnings play by our definition, but if you have a position on in earnings, by definition, that's kind of an earnings play. So you're still betting volatility, though not as high in the front expiration next week. It'll still be elevated in this name. So the short vega on this position will still come in, but it's the move, Tom, right? You're still always betting on the move. But if Goldman Sachs were to be unchanged after earnings on Monday, Implied volatility will come out of this name too, as well as the one in the event week.
Yeah, I think that's a key point. Time decay or theta works in your favor in this trade, and also implied volatility levels if they fall. But Joe, when you look at this, we always talk about these risk-defying strategies going into earnings and how key they are, or if you're using them as hedges to an existing stock position that you might have. But I think the key here is, you've got to be nimble during this earnings season, and it's reflective in J.P. Morgan's down a little bit, Wells Fargo getting hit. So maybe these things have run too far, too fast, and that's a good strategy to look at if you think that's in play.
Yeah, I mean, it's a little bit of a binary trade, right? I mean, you're going to find out fairly quickly whether you're right or wrong on it. I think the reason, like I said, I gave it that extra week of duration was just to kind of make sure that if there was a strong move and you wanted to give it a couple extra days to play out to see if there was maybe a pullback.
So I'm looking at a video that I did last week with Vegas, and I had this 234.33 as a low support. 3 different lower supports down here. At that time we were at 251.52.
If
you buy and it might be the same
Tesla,
price.
directionally you can be
SUV
dead
or
wrong
an
and
electric
so
vehicle,
profitable in
whatever
this
they wanna call
trade.
it.
So
Would you buy
that's
one
what
for-
this does. The trade-off is, the risk reward is out of whack to the risk side. But the probabilities are high, it's risk defined, collecting theta, and you have quite a move it has to make for this to be in the money.
We're all
Where in the hell is it, Jim? It's in front of you.
Yourself or no?
I would.
Really?
Oh yeah.
You're a fan of the electric vehicles?
Well, I'm definitely would have it in my garage.
Would you
And
try
it would be
it?
only the Tesla. Yeah, I'd drive it. I'd drive it back and forth to work in the city, playing around with. Yeah. It would be
Okay,
about
well-
land this way. You wouldn't have to worry about gas. You wouldn't have to worry about changing oil. It's been long enough now where the cars are the number one seller. The other companies can't compete with them. So yeah, I'm definitely a lover of Elon Musk. I'd definitely have one.
Well, you know what? That's great. I mean, me personally, I do like the look of the outside of the car, but I just do not like the interior. I think it's too plain. But remember, he said it's a boring company, so that's probably why the interior is pretty boring.
Yep.
But I keep hearing good things about the cars and the SUVs. People love them. People that love technology are loving the Tesla cars. So, you have to love the car, love the company to own one. I don't think people that don't like electric vehicles will buy one. But that doesn't matter because, the company's still doing very well. And Elon Musk, people love him as a CEO. And they're very excited about what's to come. And so we have this robo-taxi, Jim, coming up.
Yep.
So it's another catalyst. So we have earnings. So we have 2 catalysts coming up, okay, guys? We have 1 catalyst the month of July. We have earnings coming up on apparently July 17. So that's 1 catalyst for Tesla. So for those of you that trade options, okay, I am seeing
Next
a lot
week.
of options grow on the July 19 expiry. So this is holding it into earnings, and that's a risk. So if you do take the options into earnings, that can go to zeros.
Well, I'm definitely would have it in my garage within sound support of the 50 SMA on the 1 hour at 234, with our next target for 260.
Oh my God, that's a juicy move there.
Yippers, and it's your turn.
All
Anything
right.
else? And then
There are some experiences you only dream about, and there are those you didn't know you needed until they're right there in front of you. Now we're voyaging.
here on the 1 hour. $234, $235. I have a first support at 241.07. We could easily duck down here and hit this bottom part of this here Friday's low, which is right around 246.13 to keep it very bullish. If not, your second support no lower than 239.41 with a very low support to keep it within sound support of the 50 SMA on the 1 hour at 234 with our next target for 260.
Oh my God, that's juicy.
So that was it. And this is Tesla. There's that 234.33 right there, 239.41 and at 246. So yesterday, boom, baby. Wasn't paying attention. I mean, right to it. I had plenty of time to think about it. Even jump in the trade or do something this morning, because it came back and hit it again, 234.33. And I called that out Sunday. So yeah, that would have been a bingo. I get an A plus. We get an A plus. Not bad, Jimbo. Whoa. Very long lunches. Jim, that wasn't a very smart move. Okay, he's trying to get something straight here. Well. Are we going to wait for it to hit the 200 SMA? Or are we going to say it's flagged out? Right now, we still have another at least 40 minutes to wait. SPY just broke to 63. There's some big blocks just went through. About 10,000 altogether. Interesting. Okie dokie.
Encompass the earnings play, and that is August 2nd. Let's do the long iron condor, Tom. The move out to August 2nd, Tom, is about $36.
Either way, yep.
In either direction. So what I did, I went based on the stock right here, basically $250. I looked at the 270, 275 call vertical. That's only buying it. That's only $25 higher. That's a little different. On the downside, I did the 220, 215 put vertical. A little further down. It was actually right on equidistant a couple hours ago before the stock moved. So it's trading, I put it at 240. It's trading like between 240 and 245. It's still right about there.
Right.
But this is a chance to risk 240 if it moves to 275 or 215 on the downside. You got a chance for a double here to turn 250 into $5.
And by far not out of the any stretch of the imagination, especially with earnings.
No, I thought the where I put the strikes based on the expected move was pretty modest.
Yeah.
Actually, on the upside, it's tight. It's at $10 inside the expected move.
Yep, let's break this one down. It's a long iron condor, so you're buying
No,
it,
it says
buying
so.
the 270 call, selling the 275 call, and then on the put side, buying the 220 put, selling the 215 put, all in the August 2nd weekly options that expire in 21 days. So you're going to capture that earnings event and then have another week and a half in this position. So you have time in this one. Paying a debit of 240, there's your risk, $240 per spread. Break evens, you need to go below 217.60 or above 272.40. Kevin said max profitability is below that 215 strike or above the 275 strike. But this is one of those strategies we always talk about. You're selling iron condors where it's a neutral strategy where you want to kind of stay in a range, take advantage of time decay or implied volatility levels falling. This is the opposite. This is where you want this stock to move, right, Kev?
Yeah, the trade-off is you're long Vega, so you're susceptible if implied volatility goes down.
Right.
But implied volatility is low, and it might drift higher into the event. But unlike some other spreads we do, like calendar spreads, like diagonals, you are paying daily theta. Remember, if it stays in that range, that 248 is going to a much smaller number if it stays in this range. But you've got some events, you've got some news. This plays for a move, and you don't care which direction.
I mean, this stock is traded in a range of about 186 to about 270 in the last 3 weeks, and this is a 3-week trade. So good look at this, and you got that earnings event out there too, and I'm sure there'll be more headline news on Tesla on a daily basis.
Yeah, hourly.
So we'll continue to watch that. Need a move in the long iron condor there in Tesla as an example. But coming up after the break, we're going to take a look at Apple. The iPhone maker's
That's
stocks
interesting.
rallied nearly 20% so far this year and hit an all-time high earlier this week. Stick around, Fast Market's coming right back.
Iron Condor. So this is it. Ooh, Spy. Kind of missed it. Wasn't paying attention.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Fast Market here, right?
We get a big bounce right here.
Network. Before we take a look at Apple, let's bring in Ben Lichtenstein.
560.98.
Here on the network. Benny, stocks
I mentioned that a long time ago.
From losses yesterday, but once again led by small caps.
Yeah, led by small caps and not a lot of energy, not a lot of follow through to the upside, at least in terms of the S&Ps and the NASDAQ, well off the lows that we saw yesterday, but still kind of contained, range-bound type trade, unable to take out yesterday's highs in the S&Ps, which were up around 56.42.
We can easily come down here, hit right about here.
Yesterday, so I think a win for the bulls to see us up 0.75%, hanging out right around 56.28. Similar pattern with the NASDAQ at 20,392. We have yet to take out yesterday's highs or lows, so just somewhat range-bound contained, but we are seeing some conviction to the upside in the Dow, right? That's a new all-time high, it looks like there. 40,098 we saw earlier today, so it's not just small caps, Tom. To your point, the Russell up to 2160. We're talking 300 points now, within 300 points of that all-time high, 2458 from back in November of 2021. So, yeah, the latter of those, the two, though, the Dow, the Russell have benefited significantly from what we've seen this week, move lower in yields and investor sentiment kind of shifting away from some of those tech names into some of the small cap stocks.
Yeah, I didn't even realize that Dow hit an all-time high above 40,000.
It's been flying below the radar today. That's
yeah,
for sure.
And Russell hitting over 2-year highs also, as you mentioned. But if you take a look at the crude oil market here, Benny, Kevin mentioned it yesterday when we got the CPI data. You know, the energy component was weak in that, and that was the drag down, and why the headline month-over-month number was down 0.1. But now we're back above 82, 83 bucks a barrel this week.
Yeah, definitely. It's somewhat relentless, right, in terms of these stubbornly elevated levels. So there are some concerns in terms of the impact that's going to have on that next round of inflationary data, and will we start to see that kind of bleed back into consumer price index figures, the
58.85.
This is a concern for us all, right? Whether you're a consumer, whether you're talking about the Fed. But ultimately, keep in mind that speaking of range bound, and containing as far as the S&Ps and the
560.22.
NASDAQ, and again on a more granular basis, we're looking at today's intraday price activity relative to yesterday. But that chart right there still contained range bound, right? I mean, we've been holding stubbornly above 80, but still below 87. That's the high from April. Take that out, I think that tone would shift a little bit. But
560.22.
tensions. We got comments from the IEA, from EIA this week. All
The crowd's going wild. If we do not break the 560.98, we have two numbers we might trigger. One would be 558.85 by Yoko Ono, China, or 560.22. Jamaica, Yaman. You ready for a surprise, Yoko? You have about 45 minutes. Need to break a lunch or bust a nut. Sorry, Jim, I can't bust a nut. Crowd's waiting. Head and Shoulders. Oh.
So I think two things are happening here. One, dropping prices is a great strategy because they're essentially getting more people
George
into their ecosystem with things like subscription service.
Ooh. Ow. Kitty. I thought I was going to listen to like some kind of Hawaiian tune or something. We have people in the back row wanting this thing to go ahead and pull on back. We have a situation, Jim. What do you mean? You know how to count to 3? Yeah. You know how to count to 4? Oh, yeah. Yeah. See, there's 4. You had home plate, first, second, then third. You have home plate, first base, second, third. So we're about to hit a home run. I'm debating if I want to take it now, which would probably be too late if I don't. Because I don't know how to count to 4. God, what the hell is that? That's gross. That was literally gross. You're disgusting, James. Okay, Randy. This one goes to you. Fat cats are coming back. Ooh, they're going to be mad. Yeah, I don't think so. I don't think we're ready yet. Well, I can see who bought after that. You're in trouble. I'm going to say it's up 2 cents from there. Oh. Very, very impressive. Very impressive.
In this video, we'll be listing the top 5.
Oh. Uh-oh. We're now at 102. The 562s. Yeah. Be that. July 15. The 562 strikes are now at 106. 108. You make a business decision. Make a business decision. Room. Randy. Michael. Are you on the side of the tree that I'm on? I'm wondering if he's even around. Testing, Michael. Testing, Michael. A15, testing, A15. Michael, are you up? I'm going to get ready to school out. We're at 110. We had the 562 strikes. Woko Yoko. I'm going to make a business decision. You know what I'm saying? Mike, making business decision. Hello. This is Mike. I said, well, how you doing, Mike? Man, Jim, I was just in there, just got talking about this here sandwich I was eating. It was, yeah, you know, Philly sandwich. A real Philly sandwich, Jimmy. One like you've never had before. You had the dipping sauce and all that crap go with it. Well, let me tell you something. So I went ahead and I sat down at the table and I said, Jim, I heard you talking to this guy about number 4. And you mentioned my name. Tribute as I was your mentor. I said, yep, that's a fact, Jack. I mean, Mike. You still in the trade, man? I said, well, I sold. I said, why'd you do that, Jimmy? Can't you tell? Damn. I'm quite proud of yourself. One bits, 2 bits, 3 bits, 4 bits. 1 bits, 2 bits, freebie. It's incredible to you. Ain't that the prettiest thing you ever saw? Just want to sing to it. I had a Elvis Presley doll. I had a Snoopy doll, stuffed animal. I had a stack of detective magazines hidden under my bed that my mother did not know about. I enjoy that one right there. What do you think about that, Yoko? Beautiful. So 1, 2, 3, 4. 1, 2, 3. Boom. Crowd's going wild. Sports Arena.
Than yesterday.
Yes.
Really an interesting last couple sessions. What do you make of it?
It is so interesting to see the broadening out that we're seeing today,
Broadening.
especially because you think about yesterday and what worked before yesterday didn't work yesterday, right? You had that rotation out of tech, but you had the Russell, small caps catching a bid, and you saw an extension of that in early trade today, and then suddenly you saw more participation, more broadening out. As investors paid more attention to CPI than the PPI print today, they decided, okay, that matters more, and that sets the tone for the direction that the Fed is going to take. And oh, by the way, this Russell 2000 move that we're seeing, gaining more strength, putting it on track for its best week of the year. And we've been waiting for participation from small caps, and suddenly we're getting that. And that served, it seems, as a catalyst, and especially when you think about levels. I know, Alex, you're very keen on levels that we're watching.
Yep,
The S&P
the levels.
reclaiming that 5,600 level, and even the Dow reclaiming that 40,000 level. Yes, I know that's psychological, but sometimes these psychological levels matter.
No doubt. I'd also add, too, that yesterday it kind of felt a little bit bifurcated in the sense that you had this rotation of big tech into the Russell, and what was almost like this Goldilocks narrative of, hey, growth's going to hang in there, but inflation's not the concern, Fed to the rescue, everything to the moon that's struggled. But you also had a lot of money going into the Treasury market, which was more of the maybe prices are falling because we're going into some sort of a slowdown and recession. It was like those were the two outcomes being priced in, and that's sort of why you didn't see everything doing well. Today, post PPI, it kind of throws it all into flux, and it's almost like, well, maybe inflation's kind of sideways, and maybe the growth picture is kind of sideways too. And so it's sort of like this pile into everything, but then it's also sort of like the confidence behind the trade just doesn't seem to be there the same way it was yesterday.
Well, I mean, I do think when we're looking at the confidence of the trade, and particularly in the Russell, and holding on to the gains that we're seeing there, because we know that the makeup of the Russell 2000 is different than, say, the S&P 500, right? It's not as, obviously the S&P 500 is diverse, but it has more tech players in there when you compare it in terms of the percentage of tech that's in that benchmark versus the Russell 2000. So suddenly seeing the bid there, I think it starts to give more conviction. And we've been looking for that broadening out beyond the Mag 7, beyond the mega cap tech stocks. And it seems to me that there's something, I hate to use this phrase, but something there. If it holds through the end of the session, this could be the broadening out that the bulls have really been waiting for this year.
Yeah, no doubt. I mean, then the question is it new capital or is it the same capital? Because yesterday it looked like it was capital coming out of big tech into other places. And today, maybe it's a little bit of there's enough for everybody. So we'll see where it goes. We'll leave the macro discussion, at least for now, in the rearview mirror. We'll come back to it, of course, if anything drastically changes throughout the show. We've got a fun stock-specific lineup here, Diane, for the next hour. We're going to look at the semiconductor trade, obviously having a nice bounce-back session today. That'll be our upvote, downvote segment we'll get to in just a moment. But FOMO, we're going to look at a struggling name in the case of Snowflake. Not all tech names are doing well. Snowflake actually one that is having a bit of a tough go in recent months. And then, of course, under 30. George Hill's going to stop by. We're going to talk with him about Archer Aviation, ACHR, kind of an overlooked name. Looking forward to his thoughts there. Let's do upvote, downvote, though. Not endorsements, not recommendations. The undisputed leader of not only semiconductors, but likely the market as well, has been NVIDIA. Tough session yesterday, bounce back today. This is kind of just what you sign up for, Diane, when you come to a stock like NVIDIA.
It's true. I mean, look, it sold off along with that tech rotation that we saw yesterday, but regaining some ground. It has some tailwinds today. Benchmark raised its price target on NVIDIA. They now see it going to $170 a share. Their previous price target was $135 a share. They are maintaining a buy rating on NVIDIA. This, they said, in terms of the raise for the price target, comes from a fireside chat. They'd hosted a fireside chat for NVIDIA, and they said that they came away with more conviction that NVIDIA is poised to maintain its leadership position within AI, right? They expect to continue to see above expectations for revenue and earnings growth for the foreseeable future. Benchmark saying they're boosting their estimates for fiscal year 25 and 26. So you saw that give some lift back to NVIDIA after we saw it lose a little bit of ground yesterday in that rotation out of the tech sector. And I mean, keep in mind, NVIDIA has obviously been on a major bull run this year. A big part of what's lifted the tech sector. I mean, it is considered the leader of leaders within the AI space. They have a stronghold when it comes to their client base. By and large, where else are you going to turn? So NVIDIA just continues its run.
No doubt. And if you're looking for it to move lower, which maybe it's overdue for, maybe it's not, maybe it can continue higher as benchmark says, maybe it doesn't. This trade has become so ingrained within the market, it's not going to turn on a dime more than likely. If it does go lower, there's going to be tons of investors who attempt to buy the dip because it's worked. And so until it doesn't work for some extended period of time, I think that's possible. This is just, again, what you sign up for with NVIDIA. Weakness will be met with buying, but perhaps we also have buying now met with selling as well, as the stock's been a little bit more sideways over the last month or so than it had in recent trading months. So, again, we'll find out as time goes on. We got earnings in about a month and a half. NVIDIA will be center stage when it, of course, announces those. Next one on our list, though, is Western Digital. One thing that we did see broaden out over the last few months was it wasn't just NVIDIA and the AMDs of the world moving higher like it was for much of last year in the chip space. Some of these other names joined the party. Western Digital, of course, one of them.
That's right. And Western Digital today, it's on the receiving end of some increased coverage from Citi. Citi's raising its price target on Western Digital and now sees it going to $95 a share.
Still staying above the 9.
Heading to $90 a share. They are maintaining a buy rating on Western Digital. They reaffirmed their outlook on the company and just in general on storage stocks because they're looked at a basket in general, and I know we'll get to some of that. They're anticipating a demand recovery, cyclical demand recovery when it comes to the storage market.
There we go.
And they said it's driven by just the expectations of this surge or resurgence in storage demand, and that it will be led by hyperscalers and just a favorable supply-demand environment, and they believe that will be beneficial to Western Digital. And keep in mind, they had initiated coverage of Western Digital back in May, so that was when they first issued the buy rating on the shares, and they are maintaining that buy rating on Western Digital, Alex.
And it looks like they got the 90-day positive catalyst watch as well, which Jenny knows that I love these different things that they've come out with to basically reiterate their same ideas over and over. But Seagate was another one that was somewhat a part of this. No, it sounds like they like Seagate for a lot of the same reasons.
It's true. I mean, Seagate, they're raising the price target on Seagate to $120 a share. They had previously seen it at $110 a share. You're seeing Seagate gain even more ground than Western Digital today. I mean, up nearly 2%. They are maintaining a buy rating on Seagate. Again, they just
holding up well.
Just the dynamics within storage to be beneficial to them, not just Western Digital. They see that there's pent-up demand. Again, they led by the hyperscalers. They expect that there will be a favorable environment for companies like Seagate and Western Digital, and they see pricing to work in the favor of Seagate to just kind of be supportive of margin and just profitability, the profitability horizon for Seagate.
Last one on our list here, NXP Semiconductors. NXPI is the ticker. I was about to say this is the most volatile of the bunch because the chart looks the choppiest, but it's actually the lowest volatility of the four. So my eyes deceive me. What's the news here on NXPI?
So NXPI, it is gaining some ground today. It's up more than 2.5%. This is after Oppenheimer raises the price target on it. NXP raising their price target now to $330 a share. They previously had it seeing it at $295 a share. They're maintaining an outperform rating on NXP. They said this is ahead of its quarterly report card. We know we'll get that next week, or not next week, July 22nd. That's when we get that. They They're expecting to see inline or better print and better outlook from them. And they think that their core auto and industrial segments have, kind of settled. And they see them positioned well for the second half of 2024. So that's word from Oppenheimer.
And certainly living up to a lot of the hype as the stock's done really, really nicely over the last 6 months, up about 33%. So good year again for NXTI.
362.02.
Coming up next, though, it'll be time to chart and trade, Diane. We're going to look at the
Yoko.
two from that city note, the memory names in Western Digital and Seagate Technology. We got a guest chart master here today in Ben Lichtenstein. He'll be stopping by as well. We'll be right back.
Lichtenstein.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure
You're never there, I call you.
your future. That means a lot for my community and for every community.
I'll call this morning, you won't be there.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. I'm Diane King Hall. Jenny Horner will be back with you next week. We've upvoted a pair of semiconductor stocks. That would be Western Digital and Seagate. Time now to look at the charts for that. I want
Yoko, you'll take that A+.
with Alex Coffey and Ben.
Be happy with it.
Lichtenstein. Take it away, guys.
Thanks, Diane. Yeah, as she mentions, we got Ben Lichtenstein, the host of Futures, here in the studio. Guest chart master today, looking at a couple upvotes in the semiconductor industry. Both these names getting an upgrade to their price targets from Citi. Memory names, comparable, kind of rivals, if you will. But we're starting with Western Digital. What are you seeing on the chart?
Well, a big difference between these two names, that's for sure, at least in terms of identifiable structure. And what I like to look for in terms of really well-defined trend, the two phases of price development, that horizontal, that vertical phase. And let's begin with WDC, which is not really the, of the two examples we have today, the most clear of the two. So just taking a look, first and foremost, we're going to work our way from intraday price activity to a little bit of a bigger picture. We'll talk weekly in just a minute, but starting off with a 5-minute candle chart, you kind of see what I'm talking about. After a rally up to 80.50, we've come back off, and some of the selling that we saw yesterday, we really yet to recover from, mostly sideways, holding in this range around this $78 level, we'll call it. But simply put, just not a lot of conviction one way or the other as we happen and continue to be in this 5-minute candle chart here. Just so that
And Ben, to be fair on this too, this kind of episodic, almost non-trending look, this kind of looks like the Nasdaq's chart, if you thought about it for the last week, where we had kind of big run-ups and a dump yesterday, and then we're giving back, or we're at least recovering some of that here intraday.
Yeah, and in some ways, I guess longer term, one should consider that a win, but more so the case for the Nasdaq because of the trajectory to the upside. We're going to take a look at WDC, which again is on that bigger picture, still sort of, well, I guess as I like to say, the bulls have some heavy lifting to do still. But to Alex's point, this has been trending to the extent, to the upside along with the NASDAQ. And here you can see as we start to zoom out away from that 5-minute candle chart into a daily candle, you can see that it has been in a well-defined trend up off that October, that low from last fall. And this is, again, about as real clear as it gets in terms of depiction, in terms of conviction, and in terms of what I like to look for, these two phases of price development. You can see that we balanced around 40, and then again in reaction to, it looks like an earnings event last fall, in addition to the broader market just really taking off off those lower levels in anticipation of rate cuts and end of the year euphorism that we saw, but again, rallying up. Areas of consolidation that continue to form at higher and higher levels. And basically looking at the chart right now, we're balancing around the $78 level, upper extreme 81, lower extreme again around those lows that we saw about a week or two ago, 74 we'll call it. But as long as we hold above 72 right now, we are still in a trend up because value is moving higher, Alex.
When looking at, though, I guess the one thing that sticks out to me, and I guess it depends on how short term, you talked about the fractal nature of this, but it does seem like those vertical phases aren't going quite as far. Perhaps the uptrend is losing some momentum despite still being pretty structured to the upside.
Yeah, and the other thing I noticed about this is look at the patterns that we break out to the upside, and let's just clear this chart up for a second so we can see. You get a nice big breakout, a high conviction phase where the market is seeking value to the upside, basically. That's that high conviction. But then look, it kind of rolls over. You see this pattern repeat itself 1, 2, maybe even 3, 4 times along the way up. And to Alex's point, this is a chart where I like to look for that horizontal pattern development with the well-defined vertical separation. And here it's a little bit more overlapping.
And I guess if we were trying to explain that, perhaps it's, hey, it's a jump up, there's profit taking, it eases down, people see opportunity that maybe missed it, they get in, rinse, repeat over and over, and it does seem like that volatility alongside the overall market has started to dry up. The moves are just smaller than they had been.
You could argue the ranges are a little bit more narrow as well. So, and this is about as good as it gets, though, again, because now while we have seen a significant run-up, and this is the move we just looked at on that daily candle chart, again, so a significant move off the lows from end of last year, fall of last year, but you're also going to notice here that we're just barely taking out the highs that we saw back in 2021, and then we still have some major hurdles to get above because we have been in a bit of a downward trajectory here off those highs from, again, we're looking at 114, 115 back in 2014, 2015. So this has been a stock that, again, has been under pressure, starting to recover, getting above a key area, but still, look at this, where I said, again, about the bulls having some heavy lifting to do. Now, the one thing I will say, in terms of the energy off this low right now, it's building, right? We can see that there is some conviction to the upside here off this low. The thing I'll mention is we have a well-defined upper and a lower extreme. We've established a lower here right now, build momentum through the middle of this range, and it does target a retest of that upper extreme. So all of this, again, supportive of the bullish narrative here, I think, and stock that's still contained on this weekly time frame. The daily is a little bit more clear, but one to watch here as we have seen some...
This is about a decade of trading activity, and this couldn't be more of a different picture than everything we just looked at. Looks like we're at a really important level from about a few years ago that you pointed out, that those former highs. But the other highs, it almost looks like if you connect these points here, Ben, and made a line, it'd be a pretty key level there too, where it almost looks like that trend line would be...
We're approaching that.
Would be approached. So nonetheless, when you look at this, Ben, and you start thinking about this picture, this is why it's important to look at different time frames, because this couldn't be more different than what we just looked at for the last 6 months to a year.
Yeah, it helps you kind of pare back your expectations in some ways. When you see a big move like this, you have to realize again that you're still somewhat in the range. I did want to take a look here though real quick where we are relative to the 50 and the 200-day moving average, because along this staircase type pattern to the upside, again, not as easily identifiable as we'd like it to be, or we're not seeing that really well-defined vertical separation. The run-ups are short-lived, we pull back. But each time that pullback has found support around the 50-day moving average. We haven't been below the 200 since the brief test we saw last October. This is a stock, again, that's trying to build some momentum here. Alex trying to gain some strength and basically recovering off a key area of support.
Yeah, and if you look at that RSI that you have at the bottom, nothing there screams like people are worried or dumping this position, but it does kind of confirm what we suggested is the case, which is maybe it's sort of rounding to a more sideways move and it kind of looks like that's the case. But that 50-day looks like it's been a rock solid support,
Sure has.
going back at least till November of last year, Ben. Hold those thoughts, though. We'll come back for Seagate. We're going to look at a quick example trade in Western Digital over here on the big screen. What we're looking at is something looking for this to continue a move higher. Looking at a call vertical spread, a debit spread, in which we're buying the 78, selling the 80. July 26 expiration stays ahead of earnings. So basically just looking for more of a grind higher in this stock. If you do it for $1 debit, you'd be risking $100 to make $100 on a 79 break even, which is pretty close to the current share price. So with that in mind, it's a bullish strategy, but it's risk defined. We just saw a huge tech washout yesterday. Granted, it looks like it may have been short-lived. It does highlight the risks at some of these levels that we're seeing in some of these stocks. But risk one to make one, bullish strategy with a break-even near the current share price is sort of our loose guidelines for the call debit spread in those names that you believe could continue to move higher. Bringing back in Ben, looking at Seagate, a name that's comparable in terms of industry, but as you said, a little bit different looking chart.
Yeah, this is right up my wheelhouse, in terms of price activity, in terms of what we're seeing as far as structure, development, trend. I mean, it really all just comes into play here. A textbook example across multiple time frames. We're going to begin again with the 5-minute. We'll just start off with a more granular, work our way up to the bigger picture. You can see what's going on here. And you're going to see a very similar depiction across all these time frames. Bottom left, top right, recently topping out and holding up near this 108 handle. This is a 5-minute chart, so a 5-minute candle chart. So I wanted to show you, I've got my eye on 4 areas of consolidation that are forming. Alex, you know I love when this happens. Look, in a very systematic way, incrementally, we're talking every $2, the market's kind of paused and stalled out, regained composure, and then continued along that trajectory to the upside. We're balancing around 108 as we speak. Simply put, the move we're looking at here that's occurred basically over the last week has been accepted, right? There's no rejection of this upper level. Rejection would look more like a V-top type pattern. We'd be selling off this area. This is kind of the buyers and the sellers coming to grips with it and a meeting of the minds at this upper level. As I like to say, the market's efficient at that level right now as both sides are able to get their price, simply put, or near their price. Now, let's take a step back away from that more intraday look to a more intermediate 1-hour candle chart. We're going to add a little time on here. You're going to see a very similar pattern playing out, but you can also see that we're trying to get something going vertical here as we work to get above those highs that we recently posted up around that 108 handle. This is an attempt to break out of this range that's been forming around the 104 level. As long as we hold above 94, even if this fails, we can easily work our way back into this range, chop it up around 104, get it below it even, and retest the lower extreme of 100. In fact, there's 2 areas in a trend up that you're looking to participate in the trend and hope it continues. That's either at a lower extreme of a balance that forms, so a retest of a lower extreme that fails to break out to the downside, build energy to the upside, you want to get on that, or in a stock that's really high conviction to the upside. Sometimes you don't get that lower extreme retest, and you have to be a bit more aggressive and buy a breakout, right? An initiative move to the upside, which is what appears that's happening here. So we'll keep an eye on this one next week, but another step back into a longer term chart. We've gone from 5 to a 1 hour now daily. Look at this again. We're talking bottom left, top right, easily identifiable. And then just sort of looking at some of these areas of consolidation that have formed. You can see your eye should be drawn to, well, I got 4 of them laid out for you. And it's pretty easily identifiable. 52, 65. Look at this. High conviction. This is what we were talking about. Remember I said with WDC, I wasn't buying into this one, or it's not necessarily what I look for because we didn't have those 2 really well-defined phases with that vertical separation there. 90, breakout to the upside, sideways consolidation. Again, you're talking my language when we're looking at STX here because this is a textbook example of trend to the upside, easily identifiable phases of development, and simply put right now, assuming that we're trending higher, balancing around 104, the bulls don't want to see us take out 90.
I can see why you like this one, Ben. Not saying that you like it to the upside or the downside.
No, just the
you
structure.
like the picture because it's very fractal. What we always mean by that, if it sounds like a fancy word, I always best describe it. If you took a piece of broccoli and you broke off a little piece of it, it looks like a mini piece of broccoli.
I'm going to do some of that tonight.
You basically just showed us a very systematic, uniform-looking picture on several different time frames. So it really shows that that trend is not only established on the short term, It is on the intermediate term and also the daily time frame as well. What if you zoom out a little bit further and you look at some of those moving averages?
Let's do just that. And Alex, I like to think that when you see, as I pointed to, that systematic kind of value moving higher, and when you see trend across multiple time frames like Alex just described and we looked at, that's when you really want to kind of participate more heavily, more aggressively in that stock, right? WDC, when you're kind of not as clear, sometimes you have to take a step back and wait for that structure to really kind of jump out at you. You say, as I like to put it, yo, you, look at me, we're trending higher. If you want to participate in the trend up, it's pretty easily identifiable. If you want to fade it and counter trend trade this one, there's opportunity there as well. But taking a look, the 50-day moving average, something that we just rebounded off of. This is something I've also been keeping a close eye on, Alex. You get this wide range balance that forms. Look at the test of the middle of this range, and that kind of provides the catalyst, the trampoline that happened to coincide with the 50-day moving average in this instance. RSI exhibiting a little bit more enthusiasm to the upside. In fact, might be some room to go here should we get a little bit more extension to the upside. Another stock to keep an eye on next week.
It does look like, too, when that 50-day moving average hasn't held, it's also confirmation that we're in more of that sideways part of the pattern. Almost looks like every time that level's been important, a vertical phase has ensued past it. So something to think about as well. RSI painting a similar picture, although getting a little bit more excited near that overbought territory, which Rick has done a good job throughout the years explaining to me that that's not a bad thing. It can also mean that the stock's just catching a little bit more strength into whatever the reason may be. Thanks to Ben Lichtenstein, the host of Futures, for stepping in here today. We'll look at an example trade real quick in Seagate as well. A little bit different strategy, but similar idea. If you think that systematic uptrend will continue over the next several weeks, going into earnings, post-earnings, I looked at selling a call, or actually buying a call counter, which consists of selling a nearer dated call to buy a longer dated call at the same strike. In this case, we're selling July 26th, buying August 2nd at the 117 strike. So it creates that mountaintop-like peak that peaks out at 117. The risk on this trade is the debit spent. So in that case, 40-cent debit means $40 in risk. A little bit more of a smaller trade here in terms of notional risk, but also needs something to happen more so than you did in the case for Western Digital. You actually kind of need the move to happen with this one in order to break even and ultimately make money on the trade. That's going to do it for us here in Chicago. We'll send it back to New York and Diane.
All right, thanks Alex and Ben. Coming up next, a chilly day for our FOMO stock, Snowflake. We'll dive into what is behind today's slide. More next-gen investing headed your way after this break. You're watching the Schwab Network.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
At each and every angle, the whole picture, everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. trade brilliantly with Schwab.
Welcome back to Next Gen Investing. I'm Diane King Hall here at the New York Stock Exchange, and we've got my colleague Alex Coffey over there at our headquarters in Chicago. Time now for FOMO. Our focus is on Snowflake, and that stock is under pressure today. It's got a couple headwinds, right? Alex facing it. It's got that Piper Sandler cut to its price target. Oh, and by the way, the effects of this data breach heavily affect Snowflake as well.
Yeah, it certainly appears that way, Diane, if we take a look at the stock. But this hasn't been limited to just today. This has been a stock that has been struggling for quite some time. And despite the market doing its best to try to reward some of the stocks, I guess you could classify as underperformers, just yesterday and today, no love for Snowflake as it kind of is in that sort of forgotten, underperforming tech area that just is not getting any love right now. The stock's down tremendously over the last few years. It's down basically at every time frame but the last month, as you can see that just modest uptick off the lows that it made post earnings towards the end of June. Other than that, though, it's been pretty bleak when you look at this particular stock and its performance.
Hi, Yoko.
Agreed. I mean, look, it's down more than 25% year to date. On a year-over-year basis,
Yoko
it's
wins.
down about 20%, give or take, there. Today, Piper Sandler lowering its price target on Snowflake to $165 a share. Previously, I saw it as $240 a share. They are maintaining an overweight rating, but here's the issue for Piper Sandler from its perspective. They said they're proactively lowering growth estimates across a basket of its coverage list. They said that to reflect the rising macro risk factors that it believes that will impact a company like Snowflake. They talked about that it expects.
You know, that isn't a great achievement.
Strength, but the pocket of strength does not.
Very great achievement.
He called out Snowflake with regard to this massive data breach that's affecting, that was just revealed today, although it happened before today, with regard to AT&T.
Don't you think, Mike?
It looks like they were targeting
Say yes.
Snowflake, which is the cloud data giant that is tied to AT&T. So they've been affected by this, and this is not the only. I mean, it's been kind of. There's been other breaches or data exposure that has impacted Snowflake, like a Ticketmaster one, and then you had this subsidiary of LendingTree as well. So it just hasn't looked good for Snowflake with regard to its protection
don't
of
look
data.
good at all.
And I think, too, if we go back to the Piper Sandler commentary around this, Diane, despite the price target being $30 higher than the current share price, despite the overweight rating that they have here, I think this is the importance of reading the context behind the note. There's not a lot of glowing remarks here. Like, I don't see any positives that they share around Snowflake. So it's almost like if you take the words,
Excuse me.
It sounds like a downgrade.
That's a good one.
Yeah, it does. I mean, even though, to your point, even though, yes, they maintain that overweight rating, they're just
that was
worried
real
about
good.
the macro risk, the heightened budget constraints, how that could affect new purchases. They talked about just kind of the slowing demand environment. And then, that their anecdotal evidence they've seen of cost-cutting actions in the field, and they think that won't be obviously helpful to Snowflake. And Snowflake has been under pressure. Even if you go back to earlier this year, towards the beginning of the year, let's say if we go back to February, when their CEO announced that he would be retiring, so that certainly put pressure on the stock. And then, kind of what was the path forward in the C-suite, and even their guidance back then was concerning to Wall Street.
And when we look at this stock from a trading standpoint, if you do think the stock could move higher, you're absolutely, I guess, not buying the highs in this stock. But on a day where it seems like almost every stock, and I can put numbers to that, 440 of the S&P 500 names are higher and 93 of the NASDAQ 100 names are higher, Snowflake finds itself the bearer of bad news to investors as it's underperforming today after underperforming for the last few years. I just don't know that this elicits a FOMO feeling that you're missing out to the upside. I think maybe investors see an opportunity.
They are now at 191.
The remarks from the company or from the Piper Sandler aren't necessarily glowing.
There's
Perhaps the retest of those
562s.
lows, could be in store before buyers really come in for this name. So I looked at a trade with that in mind. And what we looked at was buying a put vertical. So we looked at buying a call vertical in Western Digital. This would be the inverse of that strategy, using the put vertical to create a bearish leaning strategy. And so what it would be in this case, avoiding earnings that aren't due till August 21st, we'd go to the August 16th expiration, which is the monthly expiration, and looking at the 130, 125 put vertical. Now, this is an out of the money spread, and as a result of that, it creates a favorable risk reward for the trader, but it does so with a break even that needs something to happen. So a little bit lower probability trade, but has the reward there in relationship to the risk to offset that for those who think this stock could make a test of its lows around 120. With that in mind, $1.50 debit means $150 in risk, $350 in max profit, and that theoretical break even would be $128.50, Diane. So they would need, if you put a strategy like this on, you would need a decline in the stock of about $6 to break even. But if it did fall down to below 125, you could make over 2 times the risk on this strategy, assuming max profit of $350.
Yeah, well, it looks like, I mean, certainly when you think about what the picture looks like for Snowflake today, you certainly have to play it a different way than it has been played, because if you were bullish on Snowflake coming into this year, you were certainly not rewarded for that bullishness. And the road ahead looks difficult for Snowflake. Even when you think about the competitive landscape, I looked at some other analyst notes recently, and they talked about concerns with regard to that. You had a conference last month with Databricks, and it looked like they were kind of pulling some of the market away from Snowflake. So again, besides that, and even with regard to that AT&T breach, now Snowflake's blaming some of that data theft on customers, reportedly saying not using multi-factor authentication to secure
Well, if I was to buy a put, it'd be
accounts. But
the
again,
the 562s.
Snowflake has.
Yeah, always just blame the customers. That seems like a great
buck.
strategy to PR-wise. But jokes aside, you mentioned Snowflake not being great for investors this year who are bullish. A stock that has been great for investors who are bullish this year has been Netflix. Coming up next, we're going to look at the technical picture ahead of earnings with our normal chart master, Rick Ducat, for a special technical segment in the back half of our show. Stick around. We'll be right back.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were
Okie dokie, wake up, Jimmy. I'm watching a SPY put here at $1. I got $1 on them. 562s. Oh, well, they just went below it. I thought I was going to get something there for a second. Okay. Not supposed to do that. What burned there? Look at that. Straight up. Huh.
which is now tilted lower. It's sloping downward here. So we're seeing some potential early warning signs of trend change here, shifting from an upward trend to a downward trend here. Now look at also the RSI at the bottom of the screen there. This is our measure of momentum. We can see another sign that perhaps the trend is weakening or even shifting here, because we had an upward sloping trend in the RSI, our green line there, that's been invalidated. We now have a red downward sloping line going across that high point on the RSI, and that is in play now. We've also slipped below the 50 midline, so momentum has shifted from bullish to bearish as we break through support and find ourselves back within this pattern that we were in before. So that green line there, 664, represents some old high points that we saw before we had our breakout. So that now could be a potential resistance area to watch once again here. To the downside, we've got our orange 63-day exponential moving average coming in near 641.53. Below that, our light green line, we have another relative low point near 627. We've also got some fairly clear volume volume nodes there. You can see that blue bar graph on the right side of our screen. The spikes in that area represent areas of particularly heavy trading. Those could be congestion points that price will need to work its way through to continue on a path either to the upside or the downside here. But, like you said, Alex, a pretty anemic movement today. We're up about 0.1%, so nothing really too interesting happening today, but, an interesting situation brewing for next week, to be sure.
And then, Rick, when you think about kind of where the momentum has come from, some of that has come from, okay, the password crackdown or the password sharing crackdown that the company had, that proved to be, kind of a catalyst because there was all this concern that that was actually going to be a challenge for the company. It ended up being helpful for the company and a tailwind. Are we expecting to kind of see, a slowing in that as a catalyst for where this stock goes and what its earnings look like next week?
I can definitely see that line of thinking. And in terms of momentum, as a general observation, momentum typically does slow down as we head into known event risk situations, such as quarterly earnings here. That could be what's happening now. So given that we haven't seen really too terrible of a drop off, I mean, for perspective, let's not get hysterical. We're only down about 6% from these highs here. So we're still pretty close. We're back within a supportive zone. We've got our volume node. We've got our moving average pretty close by here. Like I said, it would not be surprising if momentum slowed down during this phase here. Still, not necessarily what the bulls would want to see. I mean, a bullish, trader would like to see continued strong momentum and traders piling into this name ahead of earnings under the expectation of strong, results for the quarter here. But that makes a lot of sense, Diane, I would say.
Rick, I think investors are on edge going into earnings at about an 8-9% move priced in. And that'll target that all-time high from November of 2021. But man, I think investors on the bullish side want to break through that. Otherwise, this looks like it could be a pretty epic double top around 700. Rick Ducat, appreciate it as always, the chart master with us here on this Friday. Coming up next, we have a look at aviation company is by the name of Archer Aviation. I don't know that this is one that we've talked about before or not. We talked about Joby yesterday. We're going to get the thoughts from George Tillis on Archer Aviation as they signed a deal with Southwest Airlines. Stick around, we'll be right back.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through. I definitely feel privileged to be in that position.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Welcome back to Next Gen Investing. I'm Diane King Hall here in New York. I've got Alex Coffey with me over there in Chicago, where, as Alex mentioned earlier, we've got this melt up continuing. For our under 30 focus, we've got Archer Aviation on the radar. Let's dive into that with George Tillis, senior markets correspondent here on the Schwab Network. All right, George, it looks like there's something going on in the skies between Archer and Southwest. What's going on here?
Well, I mean, Archer, this is an innovative company. Actually, Alex brought up one of their competitors, Joby Aviation, and this is essentially the market that's developing for electric vehicle takeoff and landing vehicles. So basically like low-level helicopter-type vehicles. They're still in development as a company. They actually haven't sold any products from a commercial standpoint, nor have they received any certification from the FAA, but nonetheless, this is a developing company that is getting traction from the standpoint of collaborations with major airlines. And so recently they signed a collaboration deal with Southwest Airlines to essentially partner with them for last mile travel to passengers to airports. So if you think about the nature of commuting, we're moving into the realm or the ecosystem of robo-taxis, in other words, driverless technologies to move folks around, but there's also a developing market for, low-level, low-flying, electric vehicle takeoff and landing technologies to also move passengers who have things like long commutes, but also in areas where there's a little bit more remote and long driving access, like airports. So it's a collaboration deal. I haven't seen any details in terms of manifestation of revenues or sales of units. But I think it's important to keep in mind that this company, if you look at the stock price over the past 30 days, it's up significantly. But it's one of these reverse merger via SPAC deals that came out in late 2020. But I did notice that the company hasn't generated any revenue as of yet, with a market cap at around $1.6 billion. So it's all equity financed, and that's something you have to keep in mind, which again may continue to put some pressure on the stock until they actually develop some product, get certification, and start selling to the market.
And George, is the excitement then maybe driven that it has kind of a big name in transportation alongside it? So much like we've seen with other names, I mean, Rivian in the EV space got excitement before you saw them on the street because they were alongside Ford and Amazon. The fact that they can say, hey, Southwest has got our back here, that makes it a little bit more of a real player, despite the fact that we're not seeing these in the skies yet?
Yeah, that's the thing. So there's obviously the risk is we haven't seen the manifestation of revenues, and certification is a big deal. I mean, just think about Tesla. They're going to have to get certification for robo-taxis, which is difficult. But just think about air travel with these light electric vehicles, takeoff and landing vehicles. So certification is going to become is a problem for this industry, and it's a big hurdle. But nonetheless, I think collaborations make a big difference, because even Rivian at some point in time didn't sell any product, but they did have R&D development deals and collaborations with major automakers. And now you actually see Rivian's powertrains actually deliver Amazon packages in their vans. So, that's a possibility. You have to think about the competition. That's also something one has to keep in mind. But one of the things I will mention is that if you look at the earnings estimates, they're expected to lose $1.08 per share. And with the stock price right around $5, give or take 10 cents or so, it has a negative implied earnings yield of around 22%. So you have to keep that in mind, because that essentially is the financial fundamentals, which can continue to put pressure on the name.
Okay, that makes sense. But I can see the use case for this, as you mentioned, talking about kind of the last mile commute, especially when you think about airports and congested cities like New York, like Chicago. What I find interesting also here, George, I know this is not a tie-up, but shares of Southwest are also higher on this news, and Southwest certainly needed some wins this year. So is there some benefit then to Southwest as well in this picture?
Well, I think there is. I mean, in the long term, I think there's a benefit for any collaboration to move passengers closer towards their delivery needs, and of course, towards revenue generation. So I think this is a technology that will eventually manifest into reality, because if you think about the nature of longer commutes, and there's obviously going to be passengers willing and able to pay premium prices to get where they need to go in less time. So I think this is a market that will develop over time. The question is how long will it take? And of course, the certification needs are another regulatory hurdle that they have to overcome. Now, I will say this, that the company is estimated to earn at least $5 million by the end of this year. And that might be some collaboration deal revenue, but going forward, 2025 is when they anticipate to first deliver their product. The revenue estimates are 65 million. So for what it's worth, they are expecting in 2025 to deliver units.
George, real quick, I guess, from what you understand about this, as well as Joby, just this industry, are these companies going to create and then sell these to the airports or the municipalities, or are they going to operate these paths? Because I'm not getting to the valuation. This isn't that big of an addressable market if there's that many players in this space.
So that's a good question. I think it's going to be both. I think they'll essentially sell units to other, other carriers because, you think about, traditional, hydrocarbon-based helicopters. They're going to need and demand electric-based helicopters. So I think there's a market for selling, but I also think at the same time they're going to lease their services, and that includes, of course, the service provisions of launching software, but also a whole fleet of these, which again will be in-house and leased to customers.
Good stuff. George Tillis, you have a great weekend. Thanks as always for joining. Thanks to Diane
ACHR.
We leave you going into the weekend with S&P 500 on the all-time highs that they have ever traded. Always exciting, Diane. I hope you have a great weekend as well. Thanks for stepping in. Thanks to the viewers. Have a great weekend. We'll see you on Monday. Coming up next is the watch list.
Up today. It's up real low.
Welcome to Schwab Network.
We'll give it some time.
Live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios
Missed
in
it.
Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up to the minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day. I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of thinkers.
Okie dokie.
Award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track
Well, I gotta drop a little bit more.
up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't
There, we're
care
back.
how much you know until they know how much you care.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device.
Oliver.
only on the Schwab Network.
Turn down. Too loud.
Sales growth and a shakeup among the leadership. In the meantime, stocks are going to be could hit some record closes now. We've gotten in our inflation data. We got our PPI report. Lots of banks to discuss. Right now, the S&P 5649 up 1.1%. So that is certainly some new intraday highs. NASDAQ 285 points higher, 20,496. The Dow up 1.1%, and the Russell gaining 1.2%. It's a beautiful chart today, folks, if you're a bull and have 401ks and IRAs. The VIX is only at 1229, so that's down about almost 5%. The dollar 103.79, gold 422 a troy ounce, oil 82.55 the barrel, and Bitcoin 58,415. All 11 sectors in the green on the day. For some of the biggest stories in the markets, we welcome in Kevin Hanks, host of Fast Market here on the Schwab Network. Pretty amazing to see what's going on here. We had that PPI report. We've gotten in a slew of data. And consumer sentiment too. What stands out to you right now?
Hey, Nicole, today's rally should show everyone that the importance of the CPI data that we got out yesterday far outweighs the importance of the producer price index that we got today, because the reaction in my trading career to the PPI has always been muted compared to the CPI. And frankly, that's happening again today because the PPI number was horrible, Nicole. Not only the numbers, but the revisions from last month were both higher and more inflationary. So here's the numbers. PPI month over month up 0.2. That's a tenth better than expected, and significantly better than the negative 0.2 last month that was revised. Year over year, 2.6, much higher than the 2.3 expected. Ex-food and energy, the core, up 0.4. That's 0.2 hotter than expected. Ex-food and energy year over year, 3% higher. That is a massive beat over last month's numbers. So these numbers, Nicole, that we look at, the headline and core PPI were all stronger than expected, yet we've had very little movement in yields. They were a little higher, now they're a little lower, and the dollar, because of influence of the Japanese yen, is lower on the day. Stocks love it. Yesterday seems like a one-off event, Nicole.
Right, understood. Okay, and what will the Fed do next? In the meantime, we've gotten in a slew of bank news. We kicked off earnings season. I saw Bank of New York Mellon was leading the way. Wells Fargo and Citi were lower. JP Morgan, always highly accepted. You're taking a look at least one of the names, Wells Fargo, I believe.
Yeah, we're looking at these names. They lead off the earnings season, and the problem with Wells Fargo was net interest income. Fell way short of expectations. That's got that stock down about 5.9%, just under 6%. JP Morgan put up really good numbers, but it may be indicative of the positive run that these financials and bank stocks have been on. JP Morgan down about 7/8% as we get into the 2 o'clock hour, and Citigroup, they're going through a restructure here that's a lot different than what the other banks are doing. That stock's down about 2%. Some good numbers from JP Morgan and Citigroup, not so much for Wells Fargo. That's the laggard of the day, down, like I said, just under 6%, Nicole.
Yeah, strong investment banking over at JP Morgan.
Yeah.
But as you noted, the net interest income really disappointing over at Wells Fargo. Thank you, Kevin Hanks. Good to see you. Now let's get a look at the bigger picture. Pete Najarian's here, co-owner, Market Rebellion. Pete, how have you been? I haven't seen you in so long. How are you feeling about the market? I mean, you didn't expect the S&P 500 to be up nearly 20% in early July, did you?
No way. I did not expect that, and especially with the numbers. But as was just been said, it's been incredible just the read-through. I mean, the read-through through CPI was something that made a lot of sense. This one just shows you that it might make some sense, but the reaction is completely different than most people probably would have been expecting. And as we kick off the earnings season, you guys were just talking about the banks. I love what
that's today.
The investment banking side, to me, is the most important. That's the key element that we are looking at.
I almost
right now,
forgot.
That has been absolutely extraordinary. We've been talking about M&A. The M&A so far in 2024 is off the charts, and all those that are very heavily weighted towards that. JP Morgan's one of them, Citi's another one. Next week we got Goldman Sachs, Morgan Stanley. I think that we're going to hear even more about how well these banks are doing, or financials are doing, but obviously there are some little things here and there that folks are going to have to deal with. Look at where Goldman Sachs started the year, where it is right now. Look at JP Morgan, where it started the year and where it is right now. So there is a bit of a pause. JP Morgan was up and it pulled back a little bit. I'm not surprised to see that it's actually starting to move right back towards those highs.
Do your stock picking, do you put a bank in there? Is there a bank that you pick in there?
Well, the one that I think makes the most sense right now, and I've thought about this for a while, if you go back to October of last year, at the very end of October, Citibank was trading at about 38. I know they're going through a whole bunch of different changes and they're doing a lot of things, but oftentimes when we talk about these financials, we don't really look at the PE. We look at the price to the book. And when I look at Citi and the book value is 99 and here it is trading, call it 64, didn't get up more 66 today. I think this is a name that still has plenty of room in front of it. Now, it doesn't mean it's the best bank, but I think when you look at valuation level based upon the price to book, I think Citi has plenty of room to the upside to get up there. And there are names like Goldman Sachs, they're trading at a little bit of a premium. You look at JP Morgan trading at a bit of a premium. So it seems like it makes some sense for that pause side there. But all that being said, I think all of these banks, anybody who's involved heavily in investment banking right now, I think they're doing very, very well.
Yeah, you noted the moves that we've been seeing in yields. In fact, with the inversion of the yield curve, we're at the narrowest inverted gap since January. What does that tell you?
Yeah, what does it tell us?
The one thing that I'm always looking at, to be honest with you, Nicole, is I just like to look at where the 10-year itself is trading. And obviously the reactions that we see, and that was talked by Kevin just a second ago, but we were at a 4.48 literally not too many weeks ago, and here we are now trading at 4.19. That says a lot to me, and I think that's been part of the fuel that we are seeing in the NASDAQ. Obviously, yesterday wasn't one of those great days, but we have seemed to have gone to a new record high. It feels like every day. I know it's 37 or 38 times this year, but it seems as if they just continue to go back a little bit higher. There are some pullbacks. They make a lot of sense. But, you know, you look, matter of fact, yesterday, and you look at the SMH pulling back 2.5%, 3.5%, something like that. But here we are again, just absolutely sprinting to the upside, AI being the key.
Yeah, you're looking at commodities, you have crude and uranium. Are there picks and money to be made there?
I sure think so. I think when you talk about some of those in the commodity space, I mean, one of them that stands out to me in the energy space, uranium, and you talk about nuclear, and actually the president himself, President Biden, which surprises me a little bit, is very interested in starting to expand once again for nuclear. It makes a lot of sense. It's extremely clean. But I think when you look at that, I immediately go to Cameco, CCJ. That's a name that I think still has plenty of room to the upside, Nicole. I actually have been watching this name for a while. I've traded in, I've traded out of it multiple times. It doesn't just go straight up, but it certainly has plenty of room, and I think there are reasons why it might start moving again, because we've seen a lot of activity in the options that indicate that maybe there's a little bit of a jump coming up in the not-too-distant future. So I'm willing to ride along with CCJ. I think it's one of those names that is the name when we're talking about nuclear energy. So I think from that perspective, that would be my favorite.
Yeah, I've been hearing more and more about Cameco lately. So I think you're on the right track, right? As you look at some of these names here, at least as far as chatter, right, and interest in the stock. When you talk about energy, do you buy any of the energy names? Because right now oil's at 82.47 the barrel.
It's been awful sticky up above 80, right? I mean, this has been staying above 80 for about the last, I don't know, nearly a month or so. So I think that's interesting. I like that, and I think there are names in the space. I like some of the big names still. I think the Chevrons and the Exxons can do pretty well, but I also like some of the service names. I think we're seeing a lot more behind the scenes, and if you take a look at what's going on in the energy space, you look at nat gas, seems a little bit cheap right now, but then I look over at the price of crude, and it's holding above 80, and it's actually gotten up towards 83, 84, pulls back just a little bit. And I like the stickiness that we are seeing right now. So I think there are some names within the service world as well. I like Occidental. Obviously, anytime Warren Buffett's going to make the kind of investment that he's been making in that name, I think that's a good guy to follow along with as well. But I think there are some other names out there that are a little bit smaller names like Devon and a few others in the service world that I think could work out pretty well as well.
As you mentioned, Buffett, you saw Berkshire Hathaway new high today, and Buffett's it's going to see a record close today, and Buffett's 133 billion. Not bad, right?
It's not so bad. It seems like he hasn't lost too much speed on the fastball, as people like to say in the sports world. So I love what we hear from him. Obviously, it's a different world now for Berkshire than it was. It's just Warren now with the rest outside of there, but I love what they're doing. I've been watching very closely some of the investments that they've been making over time. I think that's always a good thing to do, to try to follow along in some way if you can. And certainly, one of the things I love about Warren Buffett, people don't like to talk about it, or he doesn't like to talk about it, but he loves the options world. He is in options all the time.
All the
Probably one of
time.
the largest option traders in the world. So me being an options guy, of course I have to listen to the Buffett man and listen to what he has to say and how he's positioning into many of these stocks.
Yeah, I think you make a great point. A lot of people don't necessarily know that. Finally, the Fed. Do you think the Fed's credibility is intact? Do you think they could make a horrible mistake here in the next few months? What do you think they should do?
Well, it seems like there's been a little bit of a change now for Powell. Obviously, he spoke
Friday
this week, and we always listen. I think that's always must listen to or watch or whatever. And I think it's pretty incredible how they've gotten fairly close. But do they want to continue to wait? Are they going to be stubborn? And I think the answer is right in front of us right now. You look over at the CME tool. It had been about 72% chance that they were going to have a cut in September. Well, now that's jumped up to about 82. It's been as high as 88. It's been fluctuating around a little bit. And I think a lot of that has to do with how long can they wait? And I think that's part of what we're seeing here. Now, will that cause some movement in the market that might be unexpected? Maybe. But I think the reality is most of us are probably looking at this and saying, hey, look, at some point we're going to see a cut. And here this makes a lot of sense in September. You can't get too close to the elections, I don't think. This is getting pretty close to that level, but I still think it is something that's going to happen in September.
Yeah, understood. You can make sports references all you want. You've earned that right, for sure. Pete Najarian, no doubt. Market Rebellion. Pete, thanks. Great to see you. Have a nice weekend.
Have a great weekend yourself. Take care.
Thank you. Coming up next, Options Corner, right? Pete set us up. I mean, you know, Buffett likes options. So does Tom White. At least he likes to check them out for us because he's highlighting unusual options activity from the day, how investors are looking to trade on recent news of Wells Fargo, PayPal, Reddit. We'll take a look at that next.
with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trade that we've been seeing throughout the day. Tom White is here, host of Fast Market on Schwab Network. And of course, why don't we take a look at a big name, one of the banks, and that is Wells Fargo, which has been to the downside, a drag on the S&P. And you're going to walk us through a bearish trade that you found. Tell us about it.
Yeah, a lot of puts are trading today in there, Nicole. Not surprisingly, with the downturn in the shares, over 5% losses. The earnings were actually pretty good on EPS and revenue. They had a beat on the top and bottom lines, but then you start talking about what's important to a lot of traders and investors, and that's net interest income, which fell about 9% last quarter. That's not what the street wanted to see. They guided for a little lower there. Also, moving forward, competition among borrowers as depositors seek higher interest rates. So the money are coming out of their accounts, going into high yield interest-bearing accounts there, and then also maybe plunging into the market a little bit. And if you look at the repurchase of 12 billion shares, didn't help that much. Their expenses went up a little bit also, so it wasn't a good overall quarter. And you can see there from the stock price on the chart, I mean, the bar was high going into this report, so not surprising we're seeing a lot of option activity in there today with the slide in the shares. Still up 15% on the year, but seeing that downturn today. But one that stuck out to me was on the August 9th weekly cycle. So about a month till expiration on these. Trader bought 8,000 of the 53 strike puts, paid an average debt of only 37 cents. So that break even at 52.63 over the next 28 days or so. That's only about 7% below the current share price. So maybe somebody hedging a long stock position that they might have, or somebody just speculating to the downside that, hey, the weakness isn't over for this one, and over the next 4 weeks we're going to continue to see it moving down. Put volume is about 5 times normal daily average volume that we've seen over the last 5 trading sessions. So even going into earnings, which we typically see a lot of option volume, we're seeing even greater today. But on the call side, Nicole, there's also a lot of call buyers in there trying to buy this dip today.
All right, it's interesting because I was just looking to see, with these banks, some of them pulling back, how we're going to be hitting highs, right? And we already hit highs, I saw on the Dow and the S&P, but not on the NASDAQ. So I was just looking to see if we had a trifecta on the day. Some of the banks did better than others as far as their performance, but we do have some down arrows in the group. You do have a bullish play on PayPal, and I want to see what we're looking at here.
Well, this has definitely been the underperformer over the last couple of years. You would think with, in this fintech space, one of the platforms or a multitude of platforms that PayPal owns, they've got over 420 million people on their platforms, that they'd be doing okay. Well, they are doing okay, Nicole. They're growing at a clip of anywhere between 12 and 15% a year, but that's far below the 40 and 50% growth rates that we were seeing from a few years ago. And that's part of the problem. That, along with the fact that how do they monetize these subscribers or people on their platforms? Well, they haven't been doing a great job at that either, because competition in the space, whether it's Apple Pay, the Block's Cash App, the banking sector has their Zelle. That's starting to come into play, where all the banks are interconnected, where you don't need to use that third-party app like Venmo to pay somebody. So that they've got some problems there. Now, the Apple settlement this week with the European Union, that was a big deal for PayPal. That's why you're seeing the shares up probably about 4% so far this week alone. 15 to 20% of their revenue is based over in the European Union, and Apple's commitment to opening its tap-to-pay technology to third-party payment providers, that's beneficial probably to PayPal in the near term. Mizuho's Dan Delev, who we have on the network once in a while, he hasn't outperformed a $90 price target on PayPal, but the shares are still, down about 1% so far this year. So it's severely underperformed the overall market, not only this year, but over the last year and a half to 2 years. But we did see some call buyers in here, probably trying to take advantage of maybe that decision by the European Union for Apple to open up their third-party apps there. The September 55 strike calls, trader bought over 3,000 of those. Average debit is $7.15. So they're paying a pretty hefty option premium for these because these are deep in the money calls. So that break even of 62.15 for this trader over the next 70 days, it's only about 3% above the current share price. You're going to get earnings on the 29th of this month, so that might be a catalyst to the upside. But as far as the analyst community goes and maybe price targets, we've seen a lot of price target hikes in there recently. Maybe people expecting that maybe the bottom's been in PayPal in the near term at least.
Yeah, I saw an Apple one had adjusted the price target to 68. Well, 268 from 69. They took it down a buck. That's not necessarily so great, but I understand what you're saying, the bullishness and the good news pertaining to the European Union and Apple and all that, and that it sort of, trickles right over to PayPal. So that's good news. I mean, for the week, it's up 1%. So thank you for all of that. And I was actually looking at some of the options activity from last week, and that was also leaning towards the bullish side as well. So that trend has continued. That being said, let's take a look, and this is the last one on our radar, and that's Reddit. The post-IPO highs, it's getting close.
Yeah, close there. It's up about, 5-6% today, getting close to those all-time highs that we just saw last week. On this one, and I was curious when I saw some option activity start to pop up on my screen, is the fact that there was no real news on Reddit today. So maybe just people taking shots in names that they expect to move higher. Lower interest rates probably helping a name like Reddit because, they still don't make money, Nicole. But they actually have a lot of people on their platform. Their daily active unique users increased 37% year over year to 82.7 million, and weekly active uniques increased 40% year over year to 306.2 million, and that was on their first publicly announced earnings report a couple months ago. They'll report again here in the next few weeks. Revenue grew year over year at a rate of 21% in 2023 and already up 48% on that earnings event in the first quarter. So they make a pretty hefty profit margin here too, nearly 90%. It's one of those new social media apps that is the advertising situation going to hold up? Well, during election years, typically we see advertising do pretty well, and Reddit start to expand that so they can monetize their platform and their users. They just partnered with ChatGPT also, so that was a bonus for them earlier over the last several weeks. But saw some bullish activity in here also in the July 19th monthly cycle that expires in just 7 days. Trader bought 3,000 of the 80 strike calls, so far on the money to the upside and would be all-time highs. They paid an average debit of about $1.80 for that for those the 80 strike calls. That takes a break even to 81.80 over the next 7 days. That's about 9% above the current share price. Call volume about double what we've seen over the last week of trading in there. So people piling in on no real news, but the market's going higher. And as you mentioned, a couple of the major indices at record highs, and Reddit outperforming today.
Yeah, and if it could get to all-time highs, as you noted, right, if it starts to, these options plays, these call options actually happen. I mean, this would be great for the shareholders. They would love it to see this move. And I see that Loop Capital has a $75 target. That's about where it is. Yeah. But definitely a fun one to watch. So August 6th is the earnings, and so we'll get ready for that as well on Reddit. Tom White, great to see you. And as you noted, records on the Dow, the S&P, and the Russell, not the NASDAQ at the moment. All right, intraday. Okay. Thank you, Tom White. Good to see you. Let's take a closer look at the AI revolution, Mag 7's role going forward. Critical next steps we need to see for businesses to actually capitalize on these investments. We'll be right back.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. I'm Nicole Pedalides, live on the floor of the New York Stock Exchange on this Friday. The Dow's up 426 points. We have many records happening, and we have a few movers for you as well. Keep an eye on it. Shares of Rivian jumped to their highest point since mid-January on increased optimism that the EV winter may be over. Comes after better than expected delivery reports from the EV makers such as Tesla and Lucid. Signs of easing inflation. Mizuho today raised the price target on Rivian to $15 from $11, kept a neutral rating. Even with today's gains, shares of Rivian are down more than 20% on the year. Shares of Apple also seeing some gains. Reports that supplier Foxconn is stepping up, hiring at the world's largest iPhone plant in China. That report comes as Apple prepares to launch the iPhone 16. Those are expected to include new AI features. Shares of Apple are up around 20% this year and set a new all-time high on Wednesday. Well, the AI revolution has been a key market driver, right? That's been undeniable. Now, where's the segment headed? Our next guest, Lisa Martin, is with us, research analyst at the Futurum Group. Lisa, good afternoon to you. What inning are we in? I mean, is the AI revolution finished, or is it only the beginning? Where do we stand on that?
Great question. I always say early innings. Nicole, great to see you. Great to meet you. Thank you so much for having me on the program. You know, we came into 2024 on such momentum. The tailwind was incredible within the Magnificent Seven. AI is everywhere. I can't go to a technology conference without it being part of the title and infused in every single conversation. What we know is that the Magnificent Seven, who kind of had a tough day yesterday, you talked about Apple doing better overall. What we know is that these Magnificent Seven companies have heavily invested in AI, and very visibly, all eyes are on them. What investors need to see now is, how is this new capacity that end users are buying, how is it being put to productive use? What we do know is, as I mentioned, it is early innings. Frankly, one of the big challenges that the NVIDIAs, that the Mag 7, others have, and other companies, is that a lot of businesses that we talk to are really in the early phases of AI pilot project implementation. And what investors want to see is, where's the proof in the pudding? And that's what we get to see at the Future Group. We get to talk with those end users and understand how they're using the investments for at least those early initial wins with AI.
Yeah, we've seen it. You noted it. Companies are spending big time. I mean, in the Mag 7, in the last earnings report, Meta was the first one to come out with this astronomical number, and it's billions of dollars that's being spent, and you want to know the monetization. How, where does that come through? You said to watch names like Amazon, Walmart, Delta, sort of put it into perspective. Give us some color on some particular names, what you see that could be happening.
Some of the things that I really enjoy looking at as a research analyst for the Future Group is what these companies are doing to leverage AI to make impact. And like I mentioned, a lot of companies, or maybe I didn't, are really looking right now at AI to really deliver efficiencies. And there's wins there. There are efficiency wins that are impacting sales pipeline. Closing deals faster, revenue. One of my favorite stories is really looking at how customers are differentiating themselves, like Delta Airlines, where they're leveraging AI to really deliver an exceptional customer experience. We know, Nicole, I'm sure you're like me, where you just expect that the customer experience is going to be awesome, relevant, personalized. They're going to give me what I'm looking for. They're going to understand me in a non-creepy way. And what we're seeing is companies like Delta Airlines, those who are using AI to fuel that customer experience, understand those customers in real time, those are the ones that are really differentiating themselves in the market. And I love the Delta example. I sat down with their chief marketing officer recently, as I do on the weekly, and we talked about how this 99-year-old company is really leaning into generative AI, not just technically, but culturally. And that's a huge part of AI being successful as well. It's the cultural transformation. But their chatbot, Ask Delta, they have, what I love to see is measurable results, and we know investors want to see that too. With Ask Delta, they've dropped their call center volume by 20%. They're getting to customers and passengers faster, they're getting their answers where they need to be, and they're ultimately influencing the passenger experience. That's a great example of a company leaning into generative AI, leveraging it to create not just a good customer experience, but a differentiating one where customers are happy and don't churn.
Make a great point, and that's a great example of a real life situation. And it's my understanding that AI is really getting really good at answering customer questions, so much so they get about 99% of them right. And they even now tell the operators, hey, why don't you try this? That they're actually spreading that along. You also have, as far as the Mag 7, I know those seem obvious, but people always want to know about some of the things that might jump out at you. We have the Mag 7 and then other names that are related, maybe ServiceNow, Salesforce. What's up with those names? Something jumping out at you there?
Yeah, what's jumping out at me, first of all, I think I've seen Jensen Huang, the CEO of NVIDIA, on more stages this year than I ever have with his cool leather jacket. He was on stage with Bill McDermott at ServiceNow. He was on stage with Michael Dell. He was just with Antonio Neer at HPE. So what NVIDIA is a great example of is a company that's really leveraging its partner ecosystem. They're not doing this alone, and they have some great silent partners. What we're seeing with companies like ServiceNow and Salesforce is it's where AI is consumable by folks inside the organization. And that consumption is really helping drive tremendous process efficiencies that ultimately lead to revenue. Companies need to do a better job of telling that story. How are they using AI in marketing automation, for example? We talked about the customer experience to move things faster, to deliver what Salesforce does really well, those personalized experiences that get somebody from a prospect to a sale much faster. So the consumption space of AI right now is exciting. And I love talking with companies like Walmart. I heard you mention Campbell Soup the other day on the show, Nicole, this week, and you're kind of thinking, Campbell Soup and AI, I don't really think those things go together. But we love at the Future Group getting to talk to those users, whether it's a Campbell Soup or it's a Walmart, those big retailers. How are they using not just the Mag 7 technologies to drive influence and revenue, but how are they using some of those SaaS applications like ServiceNow and Salesforce to make their employees more productive? Because ultimately, at the end of the day, when the employee experience is good, the customer experience is likely going to be good as well.
Yeah, and we're just about out of time, but I think about the monetization of AI, and do you think companies will, in the end, do better on the balance sheet with AI present?
I think they have to. I think, like we said, it's early innings, first quarter, first period, whatever you want to call it. But companies need to be able to show the proof in the pudding. There is proof out there. Maybe we don't see it at the NVIDIA or the Microsoft or the Amazon level per se, but their end users are demonstrating that on a daily basis. What's next, to your point, is that monetization. It's a journey. And I think what investors need to be looking at is where those companies are, not just the Mag 7, but the end users. Where are they in that journey of leveraging AI to really revolutionize their business and start seeing profits? We have to be patient on this because it's a long game.
So this was definitely an enjoyable conversation, and I definitely chuckled at least once or twice. So thank you very much for coming on and taking a look at such an important group that everyone always has 1,000,001 questions. So we'll have plenty of opportunities ahead. Lisa Martin, the future of the group. Thank you. Still ahead, Amazon Prime Day will kick off on Tuesday. Are you ready? In fact, the whole retail sector is ready for Amazon's Prime Day. The competition, it is a critical time for retail, sales, marketing. We'll be right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Pedalides, coming to you live on this Friday from the New York Stock Exchange on a record-setting day for the Dow, the S&P, the Russell, got the NASDAQ. But that's been the best performer, right? Anyway, so it's okay. You know, if you have 401ks and IRAs, you're liking seeing all of these indices up 1% plus on the day. So as we are bucking up against all these new time highs, let's get Alex Coffey in here, Senior Equities Contributor, Manager, Trading and Education at Charles Schwab. Alex Coffey, check it out. I mean, when I was talking to Pete Najarian, and I said, I don't think you expected to be up nearly 20% on the S&P 500 in this early July, right? He said, no, I did not. I mean, even the folks that were feeling good about the market didn't expect some of the moves we've seen. What are you watching today, Alex?
Yeah, I think, Nicole, you said it, records, right? S&P 500 weathered the storm yesterday, was able to bounce back in its entirety and then some today. But also, I think the broadening out that we saw in the market yesterday wasn't all for naught. You see the NASDAQ recovering, but it wasn't at the effect of losing the Russell 2000. Those two indices have not been in sync. It was no more illustrated than yesterday's session. And while today that gap narrowed and the NASDAQ ultimately did overtake the Russell intraday, it didn't give it back in its entirety. I think that's important. Now, as we look at how we close this session, are we able to strengthen into the close across the board, or do we ease off those session highs into the weekend? That's going to be the question, but no doubt about it, a roller coaster ride for investors this week, but ultimately ending near their highs, at least if the bell is ringing right now.
Yeah, and look, just about every sector's in the green. I see one, communication services, with a down arrow. I was going to say they were all higher, but that's down about 1/4%. That being said, earnings season has now begun, right? We had so many of these banks, and now next week we'll have a lot to watch as well on the heels of some of the economic data. Tell us a little bit about what you're watching.
Yeah, it's a little bit lighter on the eco data front, but there are a couple key reports that I'll have my eyes on. Most notably, I think Tuesday with retail sales, as we'll get an idea of the consumer strength. I think that's been called into question a little bit with some of the underperformance of some of those consumer-facing names. Think Nike, Lulu, Target, for example. Airlines also kind of talking about how they're not able to price to keep up with their capacity growth, so sort of an oversupply situation there. Despite the fact that TSA numbers have been strong. So retail sales, I think, will be interesting and an important key piece to this story. Also, jobless claims will continue to be in focus each week, which we'll get Thursday. Also Thursday, Netflix, kind of the first of the big heavyweights that we'll hear from on earnings. That's always appointment viewing, so I'm looking forward to it.
Yeah, I'm looking forward to it as well. Alex, thank you for a nice wrap up and a good look ahead as well. Alex Coffey, nice to see you. Thank you. Well, we're getting close. Amazon's 10th Prime Day sales event begins on Tuesday. The company promising 2 days of epic deals. Remember when it used to be 1 day, then they made it 2 days. So this event is huge, and it's not only important for Amazon, but it's also important for marketers, the other retailers. Let's welcome in Nick Weinheimer's with us, EVP Strategy at Sky. Thank you so much for being with us. This has become a really big deal, hasn't it? And why?
It has been a very big deal. Great to see the 10-year anniversary come around for, may we all get to invent a holiday that is as popular as Amazon Prime Day is. Well, now, to your point, almost a Prime Week of events that's going on. I mean, look, it's a huge boon for brands that are advertising and selling through Amazon's marketplace, as many shoppers across the board are saving up their dollars, looking to, take advantage of the attractive deals that are becoming available. And, when you look at the history of the event, right, this is last year, I think it was 7.7 billion in U.S. sales alone, 12.9 globally. I mean, I think what we're looking at and tracking in the index so far this year from our advertiser base, being an enterprise advertising management platform, we'll probably, I think, see about 12% growth, where I think there's a chance we could be in the mid-14s in terms of total volume of sell-through on this event, 2-day period and the halos around it.
Look, there's no doubt people wait for this. They are most excited about this. This is a somewhat of a global event, I guess you could say. But what's interesting, when you talk about the advertising, I mean, my experience when I go on there, sure, they'll suggest things to buy, but I don't see, take a trip to Bermuda on Carnival Cruise Lines, or, why don't you buy, you know what I mean? I'm not seeing advertising like I'm used to seeing advertising. So where is the marketing and ad industry actually making money with Amazon?
Oh, in an enormous way. I mean, you look at this notion of retail media, expanding beyond a $100 billion opportunity. Really, it's a classic relationship between brands and retailers and the exchange of effectively margin against the priced products that retailers buy. And advertisers are frankly excited to compete for the shelf space digitally, right? And Amazon's really written a book on that. And I love the commentary on AI, right? I mean, you look at Amazon's scale in the marketplace, the size of their Prime membership and loyalty information. They know from your past purchases what you're more than likely going to purchase going forward, and have a million cuts of their audiences to advertise against. That an AI LLM can help with a seed audience from a given brand identify dozens of different opportunities to communicate and market to the consumer, both through the endemic or product advertising ads on Amazon's marketplace, but also through a variety of different offsite CTV and digital channels as well. This becomes extremely important as Google deprecates third-party cookies in Chrome in 2025.
There's no doubt that AI knows everything I like. Everything, and that goes on the Instagram ads as well. So it's more about ads to buy things than it is about ads as we know them. It's sort of, hit buy now as opposed to like old time ads that we used to think about. How does this carry over to the rest of the retail industry? Because as you well know, this is a big deal. Amazon starts to do deals, then all the other, Target and Walmart, Costco, I mean, don't they all get on board too? And how does that help the advertising industry too, right?
Absolutely. And look, even just as an aside, I mean, the really important and valuable data that's available in Amazon's ad ecosystem is available to non-endemics as well. Some of those ads you are used to seeing in financial services or travel. But you're right, other retailers are keen to know exactly when Prime Day is going to hit. There's a reason that Amazon withholds that information till fairly late in the year. So that Walmart Deal Days or Target Circle Week, right? Some of these large competitive retailers can't sit right atop the Prime event. However, we're seeing them be very nimble. We're seeing brands come up with creative strategies. There's a lot of really strong data intelligence across this digital retail ecosystem to take advantage of stockouts and various other insights that might take place on very aggressive event days. And certainly for these retailers as well, this retail media industry, right? This represents a very high margin, typically margin constrained retail organization. So when you look at a Target, with Roundel, their media organization, or Walmart Connect, right? They're going to be capitalizing on the number of eyeballs that are out seeking deals, comparison shopping across, the various retail sites, leveraging their loyalty to convert in the end.
Yeah. Look, where are the ad dollars being spent most of all? Because I think about, and when you think about the bottom line of these companies, all these retailers, advertising is such a huge part of it. I mean, we used to have 3 channels, channel 2, 4, 7 for news, and then it became so fragmented, and where does the dollars go? And then it went to streaming and this and that. So and radio, right? Ad dollars get sort of fragmented. In this area, the ad dollars make all the difference on the bottom line of these books, of these retailers. Do you see changes? You said it's 4 to 5 times the daily average of the previous 30 days for ad spend. So it is a huge event. It brings in a lot on that day. Are we having a good year for advertising? Are companies spending the same or more than prior years? I mean, how do we quantify where we are?
Yeah, absolutely. I mean, we're having a much better year, I would say, than 2023. Some of the macroeconomic signals were more challenging for brands as they thought about scaling their digital advertising efforts. There was still, and continues to be some trepidation on what happens, as third-party cookies get deprecated in digital marketing. That said, especially within retail media, where we're seeing outsized growth in the digital space, it ends up being a relative percentage to gross merchandise volume sold through these retailers. And as these retailers continue to scale growth, right, even just looking at the projected growth we're seeing for the Prime Day event, being potentially 12% larger this year. Other industry insiders are kind of suggesting about the same, right? We'll see usually about a in-step amount of growth with ad spend there, right? And look, we're seeing, traditional media channels shift budgets into some of these retail media channels where they are very measurable, extremely targetable in terms of the segments of audiences within the retailers, this valuable first-party data that when third-party cookies go away in the open web, the brand marketer is going to be looking for kind of a privacy-safe but intelligent and measurable way to invest, and these retailers represent that funnel for them.
Yeah. I'm sure you respect all the retailers. I mean, we've been showing Etsy and Shopify and eBay and Baba and JD.com and Wayfair. I mean, there's so many names that do a lot of online stuff and great for advertising opportunities. But as far as the piece of the pie, I do wonder about some of the smaller names. You did say the ad spend, they're ready to really hit it hard on day 1, but should be prepared with an aggressive plan for day 2. What does that mean? Explain that.
Yeah, there's usually a joint business plan that happens between, especially a large brand that's going to be running a number of different deals, and they have goals, right? Sell-through goals, margin goals, depending on their types of products, right? Originally, Prime Day largely came about to clear out shelf space, right, in the fulfillment centers in advance of holiday to refresh the product lines for the seasonal products, right? So we'll likely see, kind of an aggressive approach in day 1, right, to try to hit those goals. Then as day 2 comes around, if you're measuring and behind on the sell-through goals, right, you might want to up the ad spend to try to push sell-through at a lower return on, your return on ad spend, right? So trade some efficiency for some volume. That's likely what we'll see on day 2. And for their part, Amazon's been very aggressive with their technology innovations to be able to push real-time data throughout the day. So these advertisers that are leveraging technology platforms like ours, they can respond in near real time, leverage our AI day parting to ensure that they're making adjustments relative to the demand that's out there intradaily.
You know, Nick, I don't think I even realized that the companies that are like, I'm looking for a popcorn maker, let's say, and, you know, maybe I want to do 5 stars or best overall, you know, but I didn't realize that all the popcorn makers that are on Amazon are actually paying Amazon to be there. I sort of was under the impression that they make a sale and Amazon gets a cut, but I didn't realize they can pay more to have a better spot. Is that right?
Right, and actually it's not a new concept in retail, right? There's been a long-standing tradition in shopper marketing, right, to trade margin against the cost of goods that you're willing to trade to a retailer for better shelf space. That's why we talk about top shelf products, right? Because they've effectively paid for their position on the shelf in the store. It's not too dissimilar for that in the digital space, right? And you'll see as you search for a product on a retailer, a small sponsored subtext on any given product listing, or you'll be on a product detail page and see what looks to be more like a display ad, but is for another product within that retail site, right? These are the opportunities that are now more democratized in the hands of the marketers and the brands themselves to better be able to compete within the marketplace and, you know, spend significantly as we're seeing, you know, these numbers scale, the tens and $100 billion opportunity to compete in that marketplace for share of wallet.
Yeah, and so you could have this herd mentality. I mean, it could be a hunk of junk, but if everybody likes it, then they get more money, and then they can put themselves in a better position again for the worst maker in America. But if it's on TikTok, right? I mean, they could also work on the opposite side of things, I would think. But hopefully, you know, Amazon's also watching, and they wouldn't get 5 stars if it was really a hunk of junk on anything. Nick, I enjoyed this conversation. I found it very informative as well.
Me too.
Weinheimer setting us up of Sky for next week for Amazon Prime Day. Because 2 days. Thanks, Nick. Still ahead, we bring in our panel to discuss Fastenal. What its earnings can tell us about the industrial sector overall. We'll be right back.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to.
Turbulence.
Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
Cut the cord on the way.
I'm so tired.
It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to the watch list. I'm Nicole Petalides. We're watching Fastenal shares. They've been rising quickly in the morning trade. Reported inline sales growth and earnings. The stock's up about 2.6% right now. Is a winner year to date, up about maybe 13% over 1 year. I want to ask our team about this one, our panel. Steve Volkman's with us, Managing Director over at Jefferies, and Christopher P. Davis, partner at Hudson Value Partners. Christopher, I'll start with you. What do you think about Fastenal's earnings? What did it tell you about the company right now?
Thank you for having me back, Nicole. I thought it was a pretty solid earnings report from Fastenal. I listened to the call this morning. I'm not a specialist like Steve is, but from a generalist point of view, I just like to listen to Fastenal to get an idea of what's happening with all the different customers that they serve. They sell to everyone from Vulcan materials to small firms and industrial concerns, and it seems like there's a slowdown, but not too much of a slowdown, and we might have some more positive thoughts into year end.
So thank you for that. And also, Steve, I know you actually made a price target move, right, ahead of the earnings to 65 from 74. What do you think about this report?
Yeah, actually, as Chris said, I think it was very much in line. That's actually a good thing because I think there was a lot of nervousness around the industrial economy. Remember, Fastenal is 75% manufacturing in terms of their end markets. And so, I do think there was a fair amount of concern that we were going through a real sort of period of weakness here. Really what Fastenal said is no. Things are actually fine, not great by any measure, but fine. It is interesting to us that their daily sales actually improved month over month each month of the quarter, so that's moderately encouraging. I think part of that may be that they're executing a little bit better on some of their outgrowth metrics, but the reality is the bottom is not falling out here by any means, and I think that is reassuring.
And it's interesting, Steve, because I know you're watching the stock and making your price adjustments as needed. If I look at the 3-year chart, it wasn't so great. And I remember from many years ago, this was such a high flyer. It was so hot, and then took this gigantic leg down. I was just trying to look up, a long-term all-time chart. But it's had a lot of volatility over the years. What does this tell us, Steve, about the industrial sector today? Are good things ahead? Are great things ahead?
Well, it's interesting. I mean, COVID was very weird for us in the industrial sector because we did not have anywhere near the sort of bubble that most people saw on the consumer side of the economy. So we had a lot of supply chain issues. We had a lot of inflation that really actually crimped, revenues and activity through COVID. There was a lot of backlog. We're starting to work that off. So it's been a very odd cycle. The good news is there's still some pent-up demand. There's still some very big, we call them mega trends. I'm sure all your listeners are aware of the infrastructure bill and CHIPS and IIJA, IRA, reshoring, electrification, data centers. You name all of these things, they're all industrial growth drivers. And that should bode well for the next few years. But we, I think, need the Fed to cooperate a little bit, and maybe that's even starting to happen now and may explain some of what's going on with the market today. But I think the good news is that there's lots of pent-up demand and lots of opportunity here on the upside once we get through this kind of flattish patch.
That's good. That makes me feel good, right? Fastenal defies the odds. It had good sales. Chris, what do you think? I mean, even though margins get squeezed and supply chain challenges, some of your final thoughts here, Christopher.
Yeah, the line that stood out to me from the call was that they said they're scrimping where we can scrimp, and I think that's indicative of a lot of companies right now that we're reaching the end of cost cutting and where that can take us and hold up on margins and earnings, and we really need to get to a point where there's sales growth. But I come from the Fastenal call pretty optimistic and look forward to hearing from companies like Deere and ABB and Honeywell that are in the general industrial sector that is supposed to really sort of bottom this quarter and see more growth into Q3, Q4, and beyond from there. And if this market really is going to broaden out, we're going to need to see a meaningful contribution from sectors like industrials to build it out. And as Steve said, there's a lot of support from government spending, which should be a great tailwind for a broadening market.
Yeah, and that was a good broad-based take, too, bringing in a lot of those other names that we can watch and that you're feeling optimistic. Good to see you both, Steve and Chris. Thank you. Steve Volkman, Jefferies, Christopher P. Davis at Hudson Value. Thank you. That's it on the watch list. I'm Nicole Petalides. Thanks for being with me. Download our free Schwab Network app. It's available in the Apple App Store. Keep it right here. Market on Close with Oliver Rennick next.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Ethan! How's my favorite client?
Great! I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
I'm Oliver Rennick. Get ready to cut the cord. Market on Close is coming up. Welcome to Market on Close. We're heading into the weekend with a lot of strength. Stocks are in really good shape. Today's basically going exactly as how you would want it to go, with the participation across the board, a lot of breadth. Yesterday's move in the Russell still holding in, and we got the NASDAQ bouncing back alongside S&P's, new record high for S&P's too. So continuing with strength after a bizarre session yesterday, an intense rotation, but now one that the market looks like is arguing can be sustainable. So it was extreme in the size of yesterday's tectonic shift, but perhaps logically underpinned. So the magnitude that was quite eye-popping, not quite as big today, but definitely encouraging to see everything up together. This is really more of an everything rally than we've seen all year. We've had a few fits and starts like this, but usually we end up losing the non-AI, non-tech stuff. This time, maybe it looks like it could be real here, as we've got continuation of strength and new multi-year highs in the Russell, finally cracking through to the upside after so many rejections over the past year. Still not at a record. The small caps still a ways off from that, but a big breakout to the upside. Equal weight is doing well again today. Everything generally looking is exactly as how you want it. To see that type of real frothy market activity that's been kind of lingering. We've been wondering if it's going to kick in, and took a negative month-over-month print for CPI to do it. So if you're looking for inflation to be an overall positive catalyst for the market. This is definitely what you want to see after yesterday. It looked like it came at the price of profit taking in tech, getting it bounced back. Crucially, the Magnificent Seven, the MAG's fund up 1.5%. Yesterday's move was pretty violent, though. If you look at the chart, there's still a tiny bit of technical damage that we're going to have to work through, and that's kind of the only thing here that might be hanging over the market just a tad as a one big candle, but a candle that did encompass basically 4.5, 5 days of trading. So bounce back of 1.5%, not going to get you close to the highs for the Mag 7, but looking at the chart here, of course, over the last 3 months, you can stretch it back to its beginning, and dip buying has always been the right move. So maybe it's just a matter of time. We'll see. So that's really kind of what you're thinking about in big tech right now. Next week, we'll get Taiwan Semi to give us an early look, really before the rest of the chip makers report, which is in a couple of weeks. So Taiwan Semi going to be important, probably the stock of the week next week as far as the AI theme is concerned. Semiconductors having a real nice bounce today, 3%. TSM chart still looking good. We checked it out this morning on MTL, and there's a little chop here, but that kind of makes it easy from a technical standpoint. Can it move higher? Does it break down after you've had sideways consolidation? The move that takes place after, usually a pretty important one, so that's going to be a key chart for next week. But right now, going into the close, there's still an hour left. The question is, are we going to ramp it up? Kind of seems like that's the path of least resistance, is a little softness a couple hours ago just didn't manifest into anything. Markets just confirmed right back up. Dollar's been down all day. Greenback getting hit after yields dropped pretty substantially here this week. Seeing the dollar and yields both lower, generally clearing the pathway to risk on. But we're also still seeing some preferences be made on the margin. Gold's outperformance over Bitcoin over the last month still has a good bit of breathing room for the classic precious metal versus the high-risk BTC, which is finding some buyers off the weekly lows, but it's still a difficult chart. Gold, I think, showing you more that when you start rallying risk assets because the economy slows down a little bit, because you're looking for cuts, then some things get left behind. And so in the high quality chase that we've gotten, Bitcoin hasn't been a part of it, but gold looking pretty good, pretty steady again, despite a little softness here today. Kevin Hanks kicking things off with me here in the studio, host of Fast Market. That was quite a week, Kev, but it's not over because we could get some action into the bell.
I think the last 2 days from opening bell to closing bell today, pretty epic.
Yeah,
in
definitely.
terms of a summer trade, it was a ripper. I mean, it was not for the meek, and it was, think about this. Try to put it, sometimes, if you try to apply common sense to a market, it does nothing but frustrate you, right? Yesterday, you could argue pretty soft inflation data, right? Bonds, yields crash. Dollar, stays firm a little higher, and the Nasdaq sells off hard. Today's data, worse, much worse,
right,
and the market rallies off PPI. Consumer sentiment, I don't know, it seemed to fuel it a little more, but wow, I discount a lot of what I see in the summer as a summer trade, and thin and whippy and overreacting to stimulus and data.
Fair.
But man, that was a 2-day ripper in both directions.
And it really was a tectonic shift with the participants that had been absent now trying to lead again today. Key that the Russell's been able to hold multiple days of strength when we got so used to seeing the small caps fade basically right around lunchtime, anytime they tried to rally before. So it definitely sets things up, I think, with a different tone as we get into the meat of earnings.
You mentioned next week Taiwan Semi, also Netflix will be another important one. We'll get more banks, more airlines, and then we set up for large cap tech coming at the end of the month. And Oliver, those are not just chips slid into the middle. There are piles of chips slid
stacks.
into the middle. It's like
even a bankroll.
It's like a James Bond Casino Royale type chips pile slid into the middle.
Everybody's got full houses.
Yeah, so I mean, we're gonna live and die and trade off every little nuance of these earnings.
Yeah.
Like digital ad spend, right? I mean, think about how many stocks in the next 30 days are going to be dependent on digital ad spend a lot.
Yes.
So, we're going to get news from Apple. We're going to get news from Nvidia. Unfortunately, it frustrates us. It's later in the earnings cycle.
Yeah, we gotta wait.
But boy, the
Taiwan Semi will be a really good insight into that, though.
And Taiwan Semi, remember, it'll be a little precursor. That sector of stocks will trade off Taiwan Semi. They'll get a look from that. And you know what? And honestly, once you develop or identify a sector of stocks like that, they do move in unison. All the airlines moved off Delta this week.
Yeah.
We'll get United next week. They'll all move off that. So,
and one kind of exception to that is that financials actually put in a one-year high on a sector basis today, even though JP Morgan, Wells Fargo were all down. Citi too. I thought that was kind of interesting because there's quite a bit of bid activity in actually the regionals, some of the smaller kind of loan-centric stuff.
And the question that comes into my mind is,
despite Wells Fargo,
is that the precursor? Because look at the charts on all those stocks; they've all had great runs, and then it gets if the bar's high, it's easy to disappoint when the bar's high.
For sure.
And are we setting up for this earnings season being that the bar just too high for these earnings to get over? So, it's going to with where we are in terms of valuations. I mean, we covered Apple today, 35.9 PE. Never been higher.
I know. The top 6-7 companies are all at least basically double of the historical average for the forward PE. They're all at least like 35.
We are the air's thin up here.
Right. Well, now some of the other stuff just got a little richer too, because I mean, this move in the last 2 days for some of the value stuff has been explosive. So it does also kind of shift some of the conversation there, where you really need to see supporting evidence now of the optimism that really hit the market, which I described this week as sort of pricing in like an immaculate landing, not just a soft landing, but that we're going to cut and we're going to do it without having being forced to do it because of recession, which is like, all right, that's kind of the thing that doesn't really happen.
Soft landing is a great theory. It just never really has happened ever.
Right.
We talk about it. We envision it.
One could argue it's been the last 8-9 months or so. This is kind of all part of it.
Well, all right, you know what? That's a fair point. You can mention that we're landing now, and this is pretty soft.
Yeah.
This would be a first one.
But then still when you land, right, that's still landing, even if you land it smoothly. So, all right, good stuff. Thanks, Kevin Hanks. Appreciate the analysis here and good stuff this week. Helping us figure out where to start and where to close the session. And right now, stocks are looking strong into the bell here. Joining us is Ben McMillan, who's a founding partner and CIO at IDX Advisors. Ben, what'd you learn this week?
Well, I mean, I think it's been an interesting week. I think the biggest standout to me, aside from kind of all the obvious stuff with the CPI prints and things like that, I think Powell's messaging on Monday coming into this week, I was very focused on Powell's messaging this week. And, it was interesting that he said we've shown some modest further progress. And the fact that he used the word modest, he's definitely messaging that, one good week of data doesn't necessarily make a trend. It's headed in the right direction, but, inflation is going to be a bumpy path. So I think market discounting, rate cuts in September, potentially again in December, is probably about right. I think it'd be excessive to discount, 3 rate cuts. The other thing that stood out to me this week was the kind of the broadening out of the equity market, which we've seen, which I think is good. It's been, very concentrated in the Mag 7 for pretty much all this year. And, the bid that we've seen, kind of the sustained bid we've seen in small caps, I think is very encouraging. For equity markets in general. So I think it was a good week. There's still a lot of wood to chop, but it wasn't bad.
Yeah, I like the point about Powell's terminology there, because it's exactly the same takeaway I had. That doesn't sound like a man ready to cut, and usually he's pretty face up when he's getting to that direction. It's not a big mystery when his language turns, and it seems reasonable because he's got Jackson Hole in August, but no meetings, so it seems like he should kind of still leave some optionality on the table, and we've got a good chunk of calendar ahead of us before September.
Well, exactly. So we've got, earnings season, coming over. We're just getting into that, so it's going to be all eyes on earnings now, especially for the equity markets. Because things are looking good, but valuations are still high. So, there still needs to be good data coming in off the back of earnings. And, you know, one thing we've been saying from the beginning of this year is keep an eye on the consumer, keep an eye on the unemployment rate, because, you know, that's when, you know, historically when rates have been cut, the question is, well, why are you cutting rates, right?
Spies that support.
All year is, you know, we have to see, you know, excessive, you know, weakness in the labor market.
562
you know, labor
next.
numbers are definitely softening, and if you look under the hood, you know, there's a lot of yellow flags there. And so, again, to your exact point, last thing I'll say too is the yield curve is starting to de-invert. And again, historically, it's not the yield curve inversion that has been the catalyst for recessions. It's when it, you know, de-inverts, and that's the period that we're at right now. So, you know, the Fed is definitely trying to thread a needle as it relates to the soft landing. I think it's all eyes on earnings, all eyes on the consumer.
That line right there, that blue one.
Continue to see this kind of broadening out of the equities market. I think that actually bodes well.
They could be adjusted. No, no,
What type
perfect.
of data do we need to support that broadening now? Do we need to see the creep in unemployment stop? Do we need to just see earnings bottom out? What will kind of justify this move here?
I mean, I think it's, you know, it's really small caps. You know, that's what you want to see. When you look at the kind of the delta between small caps and large caps, it's, you know, it's at historic, historic levels. And so, you know, obviously, you know, declining interest rates or declining rates are generally good for small cap companies. Those are the companies that don't have big balance sheets, that don't have the access to capital. And let's also not forget, you know, the majority of the U.S. economy is driven by, you know, small to mid-sized companies. And so just for, you know, general health of the U.S. U.S. economy, you want to see strength there. So, you know, I think you'd want to see equity investors are going to want to see, you know, good earnings, but also kind of good messaging going forward. You know, we've had a couple of this year, you know, there's been some kind of notable earnings where, you know, Walmart comes to mind, where they talked about, you know, they're seeing higher end consumers starting to shop at Walmarts, and, you know, things that we associate with kind of the 08 era of you know, potential recession. And so, you know, it's definitely, earnings are going to matter. I think sustained strength in small to mid-sized companies is going to matter. And then again, you know, unemployment, that's something you don't want to see, you know, go off the rails. And last thing I'd say as it relates to that, you know, one thing we've kept a close eye on all year is, you know, charge-offs. You know, there's a lot of debt out there, not just public debt, but private debt. And, you know, we're seeing, you know, bankruptcies elevated. We're seeing charged off consumer debt elevated, you know, auto debt.
Won't sound good, Schwab.
Action from the last few days here on rotation. We're going to talk some more about that. Lies on it. Thanks, Ben McMillan, IDX Advisors. And we're also going to dive into a couple of themes and some stocks, too, when we come back. And we're watching equities in a serious rally mode into the close. Russell up 1.3%. We're not too far off the highs of the session, but it's more kind of the NASDAQ type of leadership at this point, just in the last 3 hours, given the Russell's pull back from the highs around breakfast, lunch. So we'll come back as we watch the market and talk some more ways to pivot if the market's really true about this.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Forty more minutes.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. Let's continue to talk about ways to ride the momentum shift in the market. Vance Howard joins us, portfolio manager, CEO at Howard Capital Management. Vance, welcome back to the show. It's been quite a week here, and we're seeing stocks and trades and themes that hadn't done anything for a long time wake up. So how do you capitalize on that?
I think it's been a great week. You know, when we saw small caps break out, we took a position in small caps, I guess about 2 weeks ago, as we started to see it break above an HCM pivot point, and that's been a good trade for us. You know, yesterday was the first time that we've seen in quite a while that Magnificent Seven moved to other areas of the market, which is, you know, you're talking to your last guest a minute ago, how productive and good that is for an ongoing bull market. So we're seeing a shift into other areas, biotech, small caps. So it's pretty exciting. I think you've got a really strong bull market here. Pullbacks are all viable. We were a little top heavy, so you know, yesterday's sell-off probably shouldn't have been any surprise to anybody. But I think if you're not bullish in this market, you should get bullish pretty quick.
Vance, looking at your notes, talking about cash on the sidelines, you tag it at $6 trillion. Where do you get that number? What kind of data is that?
Well, you know, we pulled that off of a couple of different sites. That, you know, you can look at money market holdings and you can look at the cash on the sidelines. But you know, Oliver, you and I, every time I'm on the show, we talk about cash buildup because cash buildup is incredibly important to the ongoing sustainability of a bull market. Because that cash, as it gets put to work, markets continue to move higher. But that $6 trillion has been sitting there and really hasn't backed off any, even with this bull market we've had for the first 6-7 months of the year. And you would think that some of that would be pulled off and put into the market. So that lets me know that there's a lot of buying power out there to move this thing higher. And there's a lot of great stocks that are undervalued now because the Magnificent Seven's been clearly carrying, the market. There's no doubt about that.
Yeah.
And I think that's why you're seeing biotechs move higher. I think you're seeing small caps move higher. So I think it's any pullback's viable right now.
Get to some of the sector stuff in a sec, but I think part of the reason that $6 trillion is not moving so much is because people are getting 4.5–5% in there. I mean, it's not a negligible trade, a decision, right? So is that going to be as fungible as it was when it wasn't earning anything?
If he starts to reduce rates, I think you'll see that money come off the sidelines reasonably quick. And I think that's one reason, like we were looking at DVY, the ETF of the high dividend paying stocks. I think that's the reason you saw that move much, much higher yesterday is people sort of anticipating that money market income decreases, they're going to look for other opportunities to try to keep that stream of cash flow coming in. So it's an interesting thing, to watch what's happening with money markets, what's happening with cash. And also when you look at the 1 to 2 to 3 month treasuries, if rates starts to come down, you're going to see them sell those bonds and move that back into decent, areas of the market.
Okay. So biotech you mentioned, small caps as a whole. And does this week kind of give us clearance to just buy those groups en masse, or do we still have to be aware of where there's debt burdens, where there's lack of profits? Because a lot of that stuff does fall into the lower quality from a factor definition camp.
I think that if you look at it from a technical standpoint, Oliver, and I know you look at technicals just like I do, you had that nice breakout, in small caps, you had that nice breakout in biotechs. And they've just been trading sideways for so long, they're about to bore you to death, and they've really done virtually nothing. And they've been very, very dependent on interest rates. Like your last guest was talking about, small caps especially are very interest rate sensitive because that really affects their earnings. And what's driving this market is earnings.
When you look at this coming season, what are the most important? I mean, I feel like AI, obviously, right, they've got to live up to the valuations. But if we're looking for insight on the real economy, not the secular trend, which sectors, what do we look for, Vance, that tells us, yeah, things are good or bad?
Well, you got to play tech. I mean, tech's going to still has to be a major part of your holding in just about any portfolio out there, because with AI, that's going to be the most impactful right there. I think small caps could benefit from tech because if they can reduce their cost by way of artificial intelligence, that's going to be another, a place that their earnings could increase. So I think it's pretty much across the board. And I think I'd stay away from utilities. I'm not too interested in that. But other than that, technology, I think consumer discretionary, I think that You're looking at small caps. I think this. Hey, here's another thing, Oliver,
Mm-hmm.
that people are missing. We were watching the convertible bonds today, like CWB. They broke out today to a 2-year high. So if you're looking at a good place to look at the bond market, convertibles are looking pretty attractive also.
Interesting. And where do those slide into the strategy, Vance, between equities and fixed income?
Well, we trade that in our bond portfolio. So
Okay.
we'll either scale into 1 to 3 month treasuries, long-term treasuries, or I love trading convertibles when they're working. When they're not working, then we stay away from them. I look at any stock or ETF just like a rent house. As long as it's paying your rent, keep the renter. When it quits paying your rent, fire it and get you a new one.
Yeah, all right, nice, good. Like that ticker, CWB, one for us to watch. You mentioned biotech, IBB, mentioned the big tech in there, the healthcare side, Merck, Regeneron, Moderna, you like. One other pick before we let you go, Vance, is Salesforce. Tell me about that, because I think that's a really interesting story as kind of the leader of cloud, but so many of those cloud companies have been dragging while the rest of tech rallies.
Well, they've got good earnings. They've got good management. They had one little hiccup in their last earnings and revenue release, which they got pounded 20% in a day. So I think that's a screaming buy with the overreaction. And when that happens, Oliver, you and I talk about this too. That was quantitatively driven. That wasn't mom and pop, and that probably wasn't even fund managers. That was quant systems just selling the Salesforce. But Salesforce has the ability to really benefit from AI if they apply it effectively and can build out different mechanisms to use AI. That could be a real beneficiary for them.
Okay. Vance, good to catch up, and we'll watch the themes, we'll watch the stocks, and I think if Salesforce does turn around, then you've really got a kind of pickup in a sector here that's been left behind. So good ones to watch, like the convertible bond reference too. Thanks, Vance.
Yeah, thank you all.
Vance Howard, CEO, Portfolio Manager at Howard Capital Management. Stock options, and let's talk market maker levels when we come back as we go to the close. The Russell high from earlier this morning, probably not getting there, but who knows what could happen in the NASDAQ S&Ps. Got Kevin Green for one more look at the options flow and the gamma levels into next week.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
All right, time for the options corner. It's Mr. Alex Coffey today here with me in studio, host of Next Gen Investing. We got time here, Alex. It seems like anything's possible. What are you watching into the bell?
Yeah, so all else equal, there's a tons of things that can happen, right, outside of option flows that can influence what we're going to do in the next half hour plus, because it's been a big week.
Yeah.
We know that there's a lot of action that takes place outside the options world. It's the end of a week, and we got a weekend and things to contend with. So we've seen big moves into close, but I have suspicions that you may not get that. At least not to the upside to some extent. I'll explain why. It's probably best explained by a picture.
Okay.
I think our base assumption, if we were just taking into this account, would probably be pretty close to 56.50 for a close, and I'll explain why. You can see in the bottom right, I have a key there as far as what these lines mean, but I'll also explain it for those who are following along here. The very top of our graph here, which is a line at 56.50, is a solid line. That has been a large, major open interest position in calls throughout the session, throughout the week. That can act as a pretty critical level, almost like a magnet if you get to it, especially into expiration, which of course we're getting to for the weekly options. But you'll see those dashed green lines, Oliver. Those were heavy points throughout time today where there was heavy call options volume. And you can see it's been a steady stair step up until it met the heavy open interest. So, said another way, there were large outstanding positions at 56.50 in the calls, and now there's a lot of intraday positions that have built up. And so there's incentive for market makers who are on the other side of that to kind of work towards that level, kind of compress that volatility because they're exposed if they get in the money, but then also as they fall out of the money, some of those hedges that they maybe put on as it got tested are not necessary anymore either. So it can kind of act like a magnet at that point as they're going to be essentially working with it. Now that we're working away from that,
which
again,
actually we just did.
Those hedges they aren't necessarily going to need. So that's why I said the big move may not happen to the upside. If it were to happen, if there was going to be one, it would be this kind of a move. Now, we still got 30 minutes left. This could have been one big trade that kind of spooked the market in the futures world, and it could easily work its way back.
Sure. And is that because that big open interest kind of pin, if you will, though, can also kind of act almost like a resistance, kind of hard to push through there?
Yeah, well, if we assume the majority of the options trading are bought calls, so the dealer would be on the other side, they'd be short those calls, they're going to be exposed on the short side. So as it's tested, they're going to be buying futures to basically hedge off that risk. And at expiration, it's all or nothing, right?
Yeah. Whereas if we start to dip, then they're fine.
Then those hedges, they don't need anymore either, so they actually sell into that. So another thing we also talk about is the gamma level. So on that, you can see we've been above that yellow dash line, which is the gamma level, in the positive territory, and all else equal, you kind of say, oh, positive gamma, don't expect a bunch of big swings because the dealers are kind of selling into rallies and then buying into dips because that's how the exposure sort of works on their end. And it explains why today's been kind of a stair step. We've kind of gone level to level.
Yeah,
if you've been bullish, this has been like a dream in terms of how this is basically went from one level to the next. And you can see how it's almost followed those major open interest or major volume points, I should say, which are those dashed green lines. We basically stair step from, let's call it 56.10 to then 20, 30, 40. For hitting 50, that was also at a huge established open interest position that we talked about, which almost made it, let's say, even more monumental. That was sort of your line in the sand that the dealers have to deal with then if it gets there. You can see we peak above it for about 5 points. It's quickly undone, and then we've kind of treaded around that level until we didn't. And then momentarily, and this has happened while we've been on air, we've pulled back just a little bit to, okay, now we're 10 points away. That changes the dynamics again the other way, which is, okay, well, that's not as much in play from 10 points in a VIX at 13 as it is, 2 or 3 points. It's not as binary as it was if we're right on that line.
Okay. A lot of what we've seen the last two days, I mean, it's been in a wide range, but it also has been in a range, with S&P just peaking above yesterday's high today. I imagine then that market makers in the small cap world got pretty squeezed yesterday. I imagine that's probably part of the reason of what happened, right? Like to see a massive index move like that with no real precedent to it after kind of months of being kind of dead money.
One would assume, but volatility in the Russell has been consistently higher as a result. So they're not going to be as offsides as maybe it would be in an 11 VIX. But these are some of the smartest market participants, shrewdest market participants on the planet. They're as neutral as they can be at any moment. They're prepared for all circumstances. So, yeah, they can get caught off guard. They can add fuel to the fire at times. And maybe you saw that more probably in the NASDAQ yesterday to the downside than even the Russell to the upside.
Yeah, because it was like once we opened the door on the NASDAQ, it just didn't stop for the rest of the whole day.
But I would say, that the volatility was greater yesterday in the NASDAQ intraday. The swings were more rapid. When we make a recovery be 10, 15, 20, 40 points in a clip, and then it undo, where the Russell was just steady all day long around 3.5%.
Yeah.
The NASDAQ was certainly more intraday choppy. Today's the opposite though. Today's a stair step across the board in all of them, although the Russell did give back some of that, and I'm sure we'll talk more about that later on when I join you after the bell.
Yeah, okay. As far as visibility into positioning flows for next week, too early to tell, or do we know where is it mostly kind of going to be consistent with the levels we're looking at right now?
Well, it'll probably be more 5,700 going into next week. Typically, as you look at, and I'm just going to pull up the chain real quick and take a look into next Friday's expiration, which is a monthly expiration. So you're going to have a lot of open interest when it comes to those options.
Yeah.
As I look here, the biggest lines are the one that we're at right now, 56.50 that we talked about. And then it's actually a little bit more, balanced than I would have guessed, around 5,700. Of course, those big round numbers tend to exist longer, so you'll tend to see in the case of the SPX maybe $50 wide strikes, then $10 wide strikes, and as we get closer, $5 wide strikes added. So that's why you'll tend to see bigger numbers around those bigger round numbers, because those positions could have been established for longer periods of time. But right now we're looking at 18,300 or so. Open call options at the 5,600 line for next Friday's expiration, and 15,144 for the 5,650 line next week. So pretty big relative. Biggest line I see on the board though is on the put side at 55.50, 26,734 for the ones that are maybe realistically within range, because the expected move based off a 10% implied volatility. Keep in mind, pretty quiet week next week on the macro and earnings front. Only 61 points for the S&P 500.
Oh, really?
Very, very small.
Boy, okay. Well, if we're going to recover lost, ground and more with a fresh breakout today, it seems like...
And this is after 3 50-point moves in a row. There's still
bizarre.
no uptick in volatility.
Yeah. We had a little bit of VIX up stocks up on Wednesday. All right. Good stuff, Alex. Nice. Good assessment of the next 20-ish minutes or so, and then also for next week. And we did just pull back a tiny bit there as NASDAQ now up less than 1%. One thing I was watching was Bitcoin coming off in the last hour. Kind of gave you a little hint that we were losing some of the bid and risk, but we're in okay shape. When we come back, our weekly check-in with Mr. Phil Striebel. It's a fun chat about some of the other stuff we haven't hit yet. It means gold, it means BTC, and more. We'll be right back.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Ethan! How's my favorite client?
Great! I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
All right, stock's a little bit of a hit there in the last 10 minutes, but we're hanging in. But yeah, it's kind of coming off a bit. Phil Striebel joining us for Blue Line Futures, Chief Market Strategist, my go-to man on Friday. Phil, we're fading a little bit. What happened?
Yeah, we're fading a little bit. I feel like it's a battle like that South Park episode with the World of Warcraft. And it's a couple people, you know, the little South Park characters fighting that one guy. So
yeah,
that's how
me here. I'm doing it right now. The Cartman playing World of Warcraft.
There you go. I mean, that was an incredible breakout to the upside. Definitely caught me off guard yesterday. I thought that number would have came in a little bit hotter than expected. So we were shorting, you know, some of the Russell, at least I was, but it was balanced with like long gold, long silver, things like that. So just a really surprising move there, and just a massive squeeze to the upside. So we'll see if it can hold on there. I mean, it looks really good right now, the Russell to the upside.
Okay. Yeah, the small cap move, I mean, just wild stuff, right? Awakened and now walking again. Is it a zombie, or what do you think, Phil? Should you ride with it?
That was the argument that when you start looking at like third-party independent research, their big argument is
it's
that
two-thirds zombie.
High inflation environment, you know, high interest rate environment, small caps are not the play at all. That's that's what, you know, they recommend to short, things like that. They want to be long momentum. They want to be long, you know, mega cap growth and things like that. So it was just a big rotation yesterday. People are trying to front run, you know, the next kind of narrative or the next like few quarters out. And they really believe that the Fed's going to cut rates. I mean, it's a 90% chance, even after today's PPI number, that the Fed will make its first interest rate cut at September 18th.
Yeah. Okay. And as that sort of firms up, then, you know, I guess Jackson Hole becomes important as kind of like Powell's opportunity to lay the groundwork.
Yeah. I mean, you got Jerome Powell on Monday. Tuesday, you have retail sales. We got industrial production on Wednesday, along with Beige Book, and then initial claims in Philly Fed. So more Fed speakers next week. We don't have any big, like, you know, I'd say I'm going to be watching kind of that retail sales and, again, Jerome Powell. Those, I think, are your two biggest things. So, you know, today was interesting in a lot of the metals, like gold futures dipped below 2,400 at one point. Silver was down about $1. They were able to really claw their way back. And I think what they're looking at is they're looking at like 2-year treasury yields breaking down, and also the dollar index had flushed below the 50-day moving average, and it's really staged a pretty good sell-off. You got a breakout in the euro, the British pound, and some of the other foreign currencies.
Yeah, the dollar really got clobbered, but even so, no ramp in BTC. You know, everything seemed to come together here. So, Phil, what's going on, man?
Bitcoin hasn't really moved. It hasn't moved in 4 or 5 days since that big flush out down below 55,000. Since then, we've consolidated. I think from, if you're going to risk manage it, you're going to have some tight stops, and it's got to be just right around 56,500 because we haven't closed below that level. We've probed below it a few times. 60,000 has just been like hardline resistance on it. We get a break above there. I think we go back into a consolidation phase around 62.5, but at least it's holding this area. It's not as volatile as some of these other asset classes.
Yeah, what do you think happens if it does break, or I guess the kind of flip side, not to insert my own maybe bias there, but how would you know if it's going to flip back higher then?
Yeah, it's tough. It just doesn't, there's just not a lot of flows into it at the moment. That's the same thing. We ask the same questions with like a lot of different markets out there. Like two questions that every gold, should be on every gold trader's mind is how much of the interest rate cut is priced into the market, and then when will ETF investors flow back in? And it's, gold makes new all-time highs. The ETF investors come back in, they chase momentum, they start broadening out, they buy silver and things like that. On Bitcoin, it's got to be a break back above some of these, higher levels. We got to get back over like 65,000, which is the 50-day. 70,000 will change the dynamic of it, and they're just not there. It's just not the party to hang out at.
Yeah, it's true. It's the AI party. Now, to that point, Phil, I mean, what happens if the tech slam that we took yesterday returns? Because then it's like if Bitcoin couldn't rally when tech stuff and growth themes were ramping up, I mean, what happens if that trade unwinds? Like, I mean...
Well, yeah, I was kind of... That was something I was watching yesterday. It was like, what is the reaction function to some of these big sell-offs? And it looks like it is just primarily focused around, some of the indices, and it's not really affected other things like where people are going to, start liquidating some of these other asset classes. I mean, gold was able to rally, and really if people are going into the small caps, you think they'd be taking much more risk on, because frankly, I got more confidence in something like NVIDIA or Apple versus some of these, tiny small caps. But it is nice to look into your portfolio and see these couple dollar stocks that were kind of left for dead starting to get, a little bit of being revived a bit.
Yeah, the Lulu trade, the solar trade, like some of that stuff that was way down there.
Not an endorsement, but my favorite one is SoundHound, because NVIDIA announced they had some holdings in it. It's a few bucks. It pops up.
I kind of thought that was a fun trade too, because I'm a big voice to text guy, and they've got the best technology for that.
Yeah. So I love that too. I mean, again, not an endorsement. I just think it's fun to watch and play around with.
Yeah, went from $4 to $6. Good call. I missed that this week. All right, thanks, Phil. Have a great weekend.
You too, bud.
Phil Striebel, Chief Market Strategist at Blue Line Futures. We got a great big picture panel coming up, including a little election preview for markets. Starting to get to that time, almost. I argued earlier this week that the bond market was telling us election still ranks third as a market catalyst behind AI #1, macro 2. But our next guest might have some other thoughts on that. Mike Townsend's going to join us on our panel, get a little taste of what's going on in D.C. Plenty more ahead here on Market on Close.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network anytime, anywhere, on any device, for free. Schwab Network.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
All right, turning into an interesting little close here. This week just has a whole bag of tricks. One more left.
Ooh, nice.
There's a fade. Started with Bitcoin easing off. Of course, earlier on, the Russell did too, but now it's including
Look
big
at
tech
that.
names. So we're watching that, but we're also talking about some big picture themes. Cooper Howard with us to talk bonds, alongside Michael Townsend to talk some political impact on markets. Mike is the managing director of legislative and regulatory affairs. Cooper's director of fixed income strategist. Afternoon, gentlemen. Great to have you both here. It's been a heck of a week in markets, Mike, so forgive us if we missed some of the DC haps. What happened in your world this week?
Oh, it is a crazy time, obviously, with all the angst over whether President Biden should step away from being the nominee. That's gone back and forth. I feel like it changed directions about 5 times during the course of the week, and that's still ongoing. It's going to continue into next week, I think. But also next week, of course, we get the Republican National Convention. So former President Trump, who's been kind of laying low over the last couple of weeks, which, you know, strategically makes a lot of sense when Democrats are fighting with each other. He's been kind of laying low. Well, he'll be back in the spotlight. He's going to pick a vice president, and he's going to formally accept the nomination in Milwaukee at the convention. So between that story and the ongoing Biden story that's going to play out over the next week, I think next week is going to be a crazy political week.
Wow. Mike, how would you characterize sort of the status of their economic discussion at this juncture in the race versus kind of what is standard or previous races? I don't really know what they're proposing economically. Have I missed something?
Yeah, you know, Albert, I think that's exactly right. This race is not about policy, right? It's about character. It's about these two people that everyone has an opinion about already, and that's all kind of baked in. But we've seen really small discussion of actual policy. And, you know, when I'm going around the country talking to investors, they're asking me about stuff like the federal deficit and the national debt. What are we going to do about that? You know, what are we going to do about taxes next year? We've got a debt ceiling fight coming up in 2025. You know, there's more interest, I think, among investors in some of these policy discussions that just aren't
Big knife here.
at the campaign level. So hopefully we'll get through this next few weeks. And
Oh my gosh,
some of the
the
actual
puts.
policy issues, because you know these two candidates have.
They went to 243.
Things should go.
Okay, so that's reassuring to hear. So I'm not totally out of the loop. But that was kind of like, but then again, you're right.
I didn't buy them.
For so many characters right now, okay. They're challenging each other in golf. Nobody's talking about the economy, I guess. Cooper, does it make your job difficult at all in the research center, trying to like look beyond, you know, what do we have, 3-4 months?
Not really, because we have an expert in our research center, Mike, so we turn all the political questions over to him. He makes it a lot easier for us. So Well, we're lucky to have him on our team.
What do you think about how bonds have steepened down the curve? Because some have argued there's a little political role in there. Do you think any of that is showing up at this point?
Yeah, I think when you look at the steepness of the yield curve or the steepening of the yield curve, because we are still inverted, it's important to look at kind of what part of the market is moving or where is the market moving. And if you look at today's moves, the 2-year yield is actually moving lower, and that's what's causing the steepening in the yield curve. So I think that that's more related to the outlook on Fed policy than it is anything else. If we saw the long end of the yield curve moving higher, that'd probably be on more growth prospects. So I think the steepening of the yield curve is likely because what we got from yesterday's CPI report, we knew we saw that was pretty much broad declines across the board. So that was probably something that was being chaired by Chairman Powell. The other thing with the PPI number, if you look at the kind of surface level, that wasn't great. It accelerated. But if you dig under the hood a little bit, some of those subcomponents, Oliver, that feed into PCE, which is the Fed's preferred measure, those showed a little bit of it slowing down. So might be that PCE comes in a little bit better than expected. And again, that's more good news on the inflation front which is what the Fed wants. So I think that's the reason why 2-year yields are moving lower, why the yield curve is steepening today so far.
Okay. But I'm not hearing much about like growth potential for the back end, right? I mean, that's why, this is a bull steepener. It's coming down everywhere.
Yeah, we'll see on the growth potential. I think that if you kind of look at growth potential, one thing that you have to watch is what's happening with the labor market. A couple weeks ago, or 2 weeks ago, I should say, it seems like a couple weeks ago at this point. But if you look at the labor report, I think what was notable there wasn't necessarily the unemployment number nor the non-farm payroll addition. I think what was notable was the subtraction, the 2-month net revision of jobs. So that shows that the labor market's slowing down, shows that potentially the economy is slowing down. Looking forward, I also think that it'll be interesting to watch what comes of retail sales next week. That's kind of an indication of what the consumer is doing. So that'll be another big important report to watch going forward.
Okay. I can't help but think in some ways the market also is considering Powell's role going forward. Mike, is it a given that if former President Trump becomes next President Trump, that Powell is definitely out? Is that like assumed in the circles or what?
It's important to remember that Powell's term does not end until well into 2026. In fact, no member of the Fed Board of Governors that their term ends before 2026. So, they could leave ahead of time, obviously, of their own choosing.
Right.
But I get asked all the time this whole question about whether, if Trump was elected president, could he fire Powell? And that is a really, really complex.
That's what I was about to ask.
And I don't think anyone knows the answer to exactly how that would work. So, I think he's around for a while, even if the presidency changes.
Okay, that's a really important point then. So you think Powell would choose to stay?
Well, I don't know. I can't speak for whether he'd choose to stay. I just think that he can stay.
Right.
And, I sort of expect that he would probably want to, keep doing what he's been doing and continue to see this transition that the Fed is going through or going to start going through probably in September with the rate cutting cycle. And he'll probably want to see that through. So, I, of course, have no particular insight as to what he might do inside his own thinking. But I try to remind people that there's no mechanism until 2026 to force him out without really, I think, entering into a legal quagmire.
Great stuff. Okay, really good information, guys. Thanks. Excellent teamwork, Mike Townsend. Cooper Howard. So next week, possible VP unveil and retail sales. I bet I can guess which is going to get more coverage when we come back. Really, thanks to Mike Townsend and Cooper Howard there. Good conversation. All right, Bell. Stocks came off kind of substantially.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know.
Ding, ding, ding. All right. Well, it is Friday. Another good week. There was a couple of days where it was kind of hard, but I stuck with my plan. Sometimes timing's not perfect, so the more or less you get involved, I mean, as in and out, buying and selling, the better off you'll be. You'll know when it's time. You can overtrade, that's what I'm trying to say. Like today, I could have, I had to put set. I don't know what I was doing. I walked away and forgot about it, and I don't even remember doing it and looking at it, but thing was up 150% by the time I got back and looked at it. So that's that. That was once you broke, I know when I was talking about it up here, as it started to break that trend line, that blue trend line. I got that from this morning. Well, this here flag, see? Off that flag, off the bottom of that flag. So that's that. Don't forget to try to help donate to my vacation. It'll really yield good use. I kind of like the vacations where you're down there inside with the people, so I might thinking more closer to Legends, but we'll see. Matter if I just want to relax and not deal with the prostitutes and the drug dealers. Okay, well, I'll catch you later. Have a great weekend. Be safe. Don't drink and drive. Try to remember that if you ever get a little drunk and you're really, when you're too drunk to drive. Some people can handle it, some can't. And oh yeah. Never mind about that. Woo! Charts, patterns, and moving averages. That's what you got to study. Be persistent. Keep your watch list and keep the same stocks and watch them over and over. Eventually your Apple or your Lily or whatever you have on your watch list will be ready to have you a little buy trade. Make a deal. 2 or 3 times a month. Same ticker like Tesla or SPY or the SPX or the IWM or the QQQ or the SQQQ or the TQQQ or the MU or the BU or the Boo Boo or the Baba and just the regular old Ba. Boeing, is a criminal, so people want to buy the stock. Convicted felon. Boeing. I don't feel too sorry for Ronda Rousey. At one time I had a big crush on her, but not no more. Ronda Rousey. Okay, well that's it. Everybody have a great day, great weekend. Don't forget about my vacation fun. I want to go and lay out in the sun. Hey man, that's pretty cool music, brother. Damn. Who taught you how to sing? Well, my grandma taught me how to sing. She said, "Sit here, son, you're going to sing Glory Hallelujah." I said, "What?" Glory Hallelujah. Oh.